and welcome to this one-day seminar on clause-by-clause discussion on Union Budget 2026. I request Chairman Bangalore Branch Manjunath M. Hallur to please escort today's speakers, CA Padamchand Khincha sir and CA KK Chythanya sir, to the dais and greet them with a floral bouquet. A round of applause, members. Thank you, Chairman. I request Chairman to give his welcome address.
Good morning, everyone. Respected dignitaries on the dais, esteemed members, my management committee members, regional council members, dear delegates, good morning and namaste once again. On behalf of Bangalore branch of SIRCF ICAI, it's my proud privilege and honor as chairman to warmly welcome you all to this full-day seminar on the class-by-class analysis of Union Budget 2026 on direct taxes. The Union Budget is not merely a financial statement, it is a roadmap for economic direction, policy intent, and professional responsibility. Understanding it clause by clause is essential for us as chartered accountants who stand at the intersection of law, compliance, and nation building. We are truly fortunate to have with us two towering stalwarts of our profession, CA Padamchand Khincha sir and CA KK Chythanya sir, whose depth of knowledge, clarity of interpretation, and practical insights will undoubtedly enrich our understanding of the direct taxes proposals. I heartily welcome you both, sir. Thank you so much for taking us through this. This enriching program has been thoughtfully coordinated by CA Prashant GS, sir. And we sincerely appreciate his dedicated efforts in bringing together such insightful learning platform from our members. Can I request our Vice Chairperson, Kavita, to escort him onto dais and then give him a floral bouquet. I think he is doing this since 2017. Thank you so much, sir. Prashant ji, sir. Thank you, ma'am. I'm confident that today's deliberations will not only enhance our technical understanding, but also empower us to serve our clients, profession, and the nation with greater competence and confidence. With these words, I extend warm and heartfelt welcome to one and all, wishing you a highly enriching, engaging, and enlightening day ahead. Thank you. Jai Hind, Jai SCI.
Members, I feel proud and privileged to introduce our today's speakers, CA Padamchand Khincha. CA Padamchand Khincha is a commerce graduate from the University of Bangalore, securing 5th rank at the university level. He holds a bachelor's degree in law. He qualified as a chartered accountant in 1982 by securing 25th rank. CA Padamchand Khincha is a partner of HC Khincha and Co. Bangalore with over 40 years of experience in corporate and international tax regime. He has spearheaded the income tax consultancy and litigation practices. He has represented large corporates in some of the high-profile cases before various income tax tribunals across India and has been associated with several landmark decisions too. CA Padamchand Khincha is a prolific writer on various topics in income tax. He has co-authored Tax Holiday under Section 10A and 10B, an analysis, Tax Treaties of India, a compilation, capital gains of non-residents, tax deduction at source, concepts of indexation under capital gains. He was instrumental in making a crucial analysis of the direct tax code as a member of the team constituted by ICAI on the request of CBDT. With that brief introduction, I present before you CA H. Padamchand Khincha, sir. A round of applause, members. I do take the privilege of introducing our second speaker, CA KK Chythanya. KK Chythanya is a commerce graduate and a law graduate and a fellow member of the Institute of Chartered Accountants of India. KK Chythanya, sir, has secured 8th rank from the Karnataka state in the PUC second year, first rank in BCom from Mysore University, 47th rank in CA Intermediate All India level, and 15th rank in CA Final All India level, topping Karnataka state. He has done his articleship with BWC Bangalore and industrial training from Hindustan Lever Limited, Bangalore. He had practiced as chartered accountant for 14 years and has been in advocacy for over 17 years in various high courts, Supreme Courts of India. He has been designated as senior advocate by the Honorable High Court of Karnataka on 14th December 2021. He has lectured in Indian Institute of Management, ICAI and DTC of Income Tax Department and various other forums. He has presented papers on income tax at various metro cities and other cities at forums of ICAI, BCAS, CTC, Mumbai, IFA, Society of Auditors, AIFTP, BCIC, etc. He was a member of the study group of ICA for framing guidance notes on transfer pricing. He has co-authored books on tax holidays under Section 10A and 10B, decoding Section 5, mysteries of MLI. With that brief introduction, I present before you CA KK Chythanya, sir. Members, as a tradition, we are going to light the lamps and followed by motto songs. I request all the committee members, management committee members, regional council members, and including Prashant GS to join us on the dais for inauguration of them.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता
Thank you all. I just hand over the stage to both the speakers. Sir, you can take it up.
Me and Mr. Padam would join thanking Bangalore branch for continuously giving this opportunity for the last couple of decades to be part of this kind of a deliberation. Both of us would place on record the immense assistance and participation of G.S. Prashant, who's been putting up with us for the last couple of weeks on this. And unlike in the past, as we were preparing for the today's seminar, we had to struggle extraordinarily, having to flip between the 1961 Act on the one side, the amendments proposed to 1961 Act on the other side. On the third side, 2025 Act originally enacted, and on the fourth side, amendments proposed to 2025 Act as originally enacted but yet to take effect. You can imagine a difficulty in having to move from one document to another document, and in the course of which it became a little complex for us to really digest as to what is it they're trying to convey. So this exercise could happen maybe 1 or 2 years going forward, and thereafter I hope the life would settle with 2025 Act. It wouldn't be surprising if you would notice that there would be constant cross-references to various sections of multiple documents, and at times it could cause confusion as to which provision are we referring to, because we have time within which we'll have to cover the critical aspects. We tend to at times speed up and would keep making references to these multiple documents. So at times it could cause some confusion. Kindly bear with us. And as usual, we would keep interchanging between ourselves, and we continue to miss Mr. Ram Subramaniam, who'd been part of this deliberation for more than 2 decades with us. We missed him even during our preparation as well, because his presence would have added enormous value to our discussion. So with this, we will now proceed. And some of our thought processes may not be immediately appealing to you, but we nonetheless thought we will have to share the same with you, irrespective of whether we are eventually found correct or not, because we are making presentation to an equally competent audience who are more capable than us, at times successfully disagreeing with us. So kindly do not think whatever we state here is the final thing. Please apply your mind and then take an independent decision. Now you should see the finance bill, more particularly section 1, subsection 2, clause A of the finance bill of 2026. It would state that sections 2 to 113, section 2 to 113 and 136B and 140 shall come into force on the first day of April 2026. If you would notice these sections 2 to 113, it would principally consist of amendments proposed to 1961 Act, maybe up to section 26 or whatever, 27 onwards, amendments proposed to 2025 Act. Unless it is contrarily stated elsewhere, these provisions would come into effect from 1st of April of 2026. Now, if you go to section 2, subsection 1 of the finance bill, it would deal with charge of tax for the assessment year 2006-2007, previous year 2025-2026, the last of the assessment that would happen under 1961 Act. It says, subject to provisions of 2345, for the assessment year commencing on the first day of April 2026, income tax shall be charged under the provisions of Income Tax Act of 1961 at the rate specified in Part 1A of the first schedule, and such tax shall be increased by surcharge, whatever. This gets in a charge under the Finance Act. If you go to section 4 of the Income Tax Act, it says, subsection 1 says, wherein a central act enacts that the income tax shall be charged at any rate or rates, income tax shall be so charged at such rate or those rates on the total income of the previous year of every person. If you would understand the nature of charge under section 4, it requires convergence of section 4 and the Finance Act. That is why section 4 says, wherein a central act enacts. If the central act does not enact, section 4 would fail to operate. Section 4 gets into play upon enactment by the Central Act. Now, Central Act in terms of section 2(1), which I have just now read out, and in terms of section 1(2) clause A, will come into effect on 1st of April 2026. However, in terms of section 536 subsection 1 of 2025 Act, Income Tax Act of 1961 stands repealed. So when the charge of Finance Act gets effective on 1st of April of 2026, section 4 does not survive. And when section 4 survived, the Central Act did not come into play as it. Section 4 survived up to 31st March of 2026, and it died thereafter. Till it had its last breath, the Finance Act had not come into play. And when the Finance Act would come into play, you would have section 4 dying. It's like a life savior going to a body which has already lost its life. There's nothing to save there. So ideally what they ought to have done is to have made section 2 subsection 1 operative on or before 31st March of 2026. So this, according to us, is a serious flaw and lack of taking elementary care in respect of as important a provision as charge of tax. So they have to have taken appropriate care. Now, if you run through some of the other clauses, particularly those that would relate to 1961 Act, you would see most of these amendments are made effective from 1st of March of 2026. Why are they made effective from 1st of March of 2026? Obviously for the reason that you cannot make an amendment effective 1st of April 2026, by which time the 1961 Act would have been repealed. So that is why you will notice several of the amendments, for example, like if you see amendments to penalty provisions, amendments to like section 92 CA and various other amendments would have been either made effective 1st of March of 2026 or would have been made still retrospectively. And even those amendments would be valid only if the presidential assent is obtained by 31st of March. Because in respect of a repealed act, you may not have power to keep making amendments. So even those amendments would survive ideally if the presidential assent is secured before the 1961 Act dies. So this is one aspect. You may kindly apply your mind as to the correctness or otherwise of this statement. Now, if you would see certain other provisions, you will have to independently apply your mind as to whether these provisions would save. For example, if you look at section 535 of ITA 2025 Act, which will give the power to the board to pass orders to remove the difficulty in implementation of 2025 Act, and subsection 2 would permit the board to suggest adaptations and modifications in respect of the repealed Act. Now, the board has power, even after the Act is repealed, to make adaptations and modifications for the repealed Act. But the power of the board under 535(2) is only springing from their ability to issue removal of difficulty order insofar as implementation of 2024 Act is concerned. So there has to be a need felt for them to suggest such modification or adaptation that cannot be there insofar as the serious lapse of charging provision is concerned. Likewise, you'll have section 536(2)(c). Section 536 subsection 2 will provide for continued effect of the repealed Act in the various circumstances which are enlisted in A to V. Clause C of 536(2) of the ITA 2025 would say that in respect of tax year, that is 25, 26 and earlier, the 1961 Act would continue to apply. But that is as regards the repealed Act. The repealed Act, irrespective of its repeal, would continue to apply. So the charge which is now sought to be brought in from 1st of April 2026 will become ineffectuate for the reason that there is no convergence of section 4 and section 2(1) of the Finance Act whenever it becomes so, because it will come into effect from 1st of April, by which time the Act would have been repealed. So this 2(1) would not affect the repealed Act, and application of the repealed Act will not revive the charge that has been lost. So even according to section 536(2)(c) of the 2025 Act, which will allow the continuance of the repealed Act, would not save the flaw in the charging provision. So there are certain other provisions which we will not at this point in time get into, except naming those provisions. Before we move to, so you'll have to keep in mind the provisions like section 536. You will also have to keep in mind section 294 of the Income Tax Act. Anyway, it is not going to save because it will die along with the ITA Act of 1961. So with this, we would now look at the tax rates. As we have many points to discuss, we will not run through these slides except stating that the tax rates as such have not undergone any change. But if you would see section 2 of the Finance Bill, particularly subsection 3, it makes it little complex reading because you are dealing with the new Act of 2025. The references to sections look very alien and foreign, so it becomes a little difficult for you to be spending time in respect of these. But we have carried out first-hand analysis and found that there is no change in the tax rates, surcharge rates, etc. for all the persons who would be liable to tax, except in one case where the MAT rate has been reduced from 15% to 14%, and you will have attendant consequences like the surcharge and the cess being applied on the reduced 14%, which in greater detail we would discuss when we go to the MAT provisions. And how do we propose to go about is, we would not go seriatim in the finance bill, because you would notice that some of the amendments made to 1961 are also reflected in 2025. For example, 292BA amendment that is carried out in 1961 Act, you would find a parallel amendment also made in 2025 Act. 92C3A, 144C amendments, certain amendments to section 153, you will have the parallel amendments have been carried out in 2025 Act. So therefore, what we do is, wherever there are overlapping amendments, then we would deal with them together. Like for example, 92CA 3AA, if we discuss, we'll also be discussing the parallel provision under the 2025 Act. I'm skipping this because there is no change here in respect of any of these rates and the rates of tax, rates of surcharge, rates of cess. Now let's move to the amendments. To 2025 Act. First is the case of an amendment to section 21 within brackets 5. We have just juxtaposed 1961 Act on the left hand side, on the right hand side 2025 Act as originally enacted. And later on we would then move on to originally enacted 2025 and the proposed amendment. You may wonder, why have we done all this? This has been done to protect ourselves from the onslaught of questions from your end. Should the questions arise and should we get lost as to which provision we'll have to refer to, we should have in place all the statutes. That's why we have the 1961, wherever possible, 1961, 2025 as originally enacted, and 2025 as is proposed to be amended. Interestingly, you will have 2025 yet to come into effect from 1st of April 2026. Some sections which were there in the original enacted 2025 have now been omitted. So as the Act kickstarts, you will have some missing clauses, missing sections, very unique. For example, section 443, you will find a gap as the new Act comes into play from 1st of April 2026. Some clauses also you will find missing. Now, this deals with the residential property held as stock in trade, any property held as stock in trade, house property held as stock in trade. You had the decision of the Honorable Delhi High Court in Unself Properties case, where the Delhi High Court held that even if you have held these house properties as stock in trade, there is still an annual value that would be attributable to it, and you'll have to pay capital gains tax, rejecting the argument of the taxpayer stating that as I've held them as inventory, they should be considered as occupied for the purpose of business. So the Honorable Delhi High Court did not agree, but we have the contrary decisions as well. In the meanwhile, they brought an amendment to 1961 Act, which amendment they continued in the originally enacted 2025 Act with one error. They have said that shall be nil for 2 years. They gave a relief saying that, okay, if you're holding this as inventory, we will give you a cooling period. Let's say you are a builder, you have built apartments and you are wanting to sell them. Some of them have not been sold. As it is, you are struggling to sell them, you have cash flow issue. If the unsold apartments annual value will have to be taken as the house property income, will have to end up paying tax in respect thereof as well. That will mean additional cash outflow for you. So they said, okay, we'll give you a cooling period of 2 years. 2 years from the end of the financial year, the completion certificate is obtained. We will not regard it as will not regard it as house property for the purpose of levy of charge. So they stated that it shall be nil for 2 years from the end of the financial year in which the occupation certificate is obtained. As soon as this was read, Mr. Padam immediately pointed out, oh, it shall be nil for 2 years. What if the year in which the property is constructed, let us say completion is over sometime in May, 2 years holiday will end, will start from end of that year. What about from May till 31st March? So they overheard our discussion and later on carried out, saying that it shall be nil up to 2 years, meaning if the property's completion is over in May, then from May till end of that year as well as next 2 years, the cooling period would apply and you do not have to pay the notional tax on its annual value is all the amendment that is carried out here insofar as 21(5) is concerned. Now, this is an important amendment. Section 24 dealt with giving you certain deductions. 24 clause B dealt with interest in respect of capital borrowed for the purpose of construction, reconstruction, purchase, renewal, repair of your house property. Then this section 24 had some provisos thereunder and also an explanation. And it stated that if you have had pre-construction period interest, meaning you had borrowed the property and kept using the borrowed capital, kept using the borrowed capital for the purpose of construction, that would take some time, the property is yet to come into existence, but you had been suffering interest. So whatever interest you had suffered during the period prior to the year in which the property's construction is over, that would be captured as pre-construction period interest. 1/5 of that would have been allowed for a period of 5 years, commencing with the previous year in which the property's construction is over. So apart from, once the property is ready and its income is offered to tax, apart from the current year interest, you could have added 1/5 of the pre-construction period interest. This you could have done it for 5 years. But then there was a proviso which stated that if it is a self-occupied property or a vacant property, the overall interest deduction would not exceed 30,000 or 2 lakh as the case may be, right? So this 30,000 limit or 2 lakh limit as the case may be applied to whole of interest, which could be both current interest as well as 1/5 of the pre-construction period interest, and the cap would have been for the entire interest, right? This was the understanding of 1961 Act in terms of section 24. When they brought 2025 Act, they somehow thought, some like divine thought process went into their mind saying that these provisos are bad, explanations are bad, they should not exist. So what did they do? In the 2025 Act, you will not find a proviso, you will not find an explanation. All these have been converted into either subsections or subclauses. See, the provisos and explanations would always played a subservient role to the main body of the section and stayed within the overall control of the main body of the section. So they had a special role to play. It is not that they were a waste or they were a drag or whatever. They had a special role to play. Without realizing these, all these provisos and explanations have been cut into subsections. When they did so and enact 2025 Act, they separated the normal interest, year-on-year interest that you pay from the pre-construction period interest. Are you able to understand? Separate clauses, independent clauses. And when they brought in this limit of 30,000 or 2 lakh, they referred it only to the regular interest and they missed making a reference to the pre-construction period interest. In fact, this has been pointed out by us, saying this is the difficulty that you would encounter when you recklessly convert a proviso or an explanation to subsection without taking adequate care, whereby the position became such that you will have, in the case of a self-occupied property or a let-out property, you will have that limit of 30,000 or 2 lakh only for current interest And pre-construction period interest, whatever be the amount, you can claim it separately. This would have been the position that they have realized now, and therefore they have now proposed an amendment to this particular section. Now, I will show this to you, what they have sought to do. Look at this. Now, earlier they said the aggregate amount of deduction under subsection 1B, which referred only to the current interest. Now, they have said aggregate amount of deduction under subsection 1C shall not exceed. So, whereby they have now put this cap of 30,000 or 2 lakh not only to the current interest, but also to the pre-construction period interest, and accordingly they have amended it. Now, but as they took care to amend, they forgot to amend section 202 of the ITA 2025. What is 202 of ITA 2025? It corresponds to 115 BAC, that is the default regime. If you look at 202, subsection 2, subclass A, subclass 5, it would continue to make a reference only to 22(1)(b), which deals with the current interest. It does not make a reference to the pre-construction period interest of 22(1)(c). They have taken care to amend section 22, but they have not taken care to amend section 202. So typically, if you go to 115 BAC kind of a situation, you are not eligible to claim any deduction in respect of any interest insofar as it relates to vacant property or a self-occupied property, not even that 30,000 or 2 lakh, nothing would be available to you. So the way it looks like, when you come under 202, that's a default regime, you are barred from claiming only 22(1)(b) interest, which is current interest. You are not barred from claiming 22(1)(c) interest, which is the pre-construction period interest. Unless they hear us now and carry out the amendment as they get this finance bill enacted, they'll have to bring out the amendment next year. Now, this would create some problem. The problem that would create is that when you are in a 202 situation, meaning 115 BAC situation, you would not claim 22(1)(b). So let's say current interest is 50,000 rupees. 1/5 of installment of pre-construction interest is 1.8 lakh. So together is 2.3. As long as you stay under section 22, your overall limit will be 2 lakhs. However, if you are under 202, that is 115 BAC in the default regime, you ought not to have got any deduction, not even 2 lakhs limit. But because of this goof up, you can claim pre-construction period interest as you stay under 202. But don't be too happy, because how much of amount you can claim is one question, and will it mean ultimate benefit to you is another question. How much can you claim? Your 50,000 under 22(1)(b), your 1.8 under 22(1)(c), that is pre-construction period interest in my example. Now 202 says you don't get anything under 22(1)(b), call it as 0. Then what you can do is 22(1)(c), how much is it? 1.8. So one school of thought is that you can go ahead and claim whole of 1.8. However, as you go a little down, if you would see section 202, subsection 2, clause B, subclause 1, it will not allow you to have the loss under the head house property set off against any income under any other head. Are you able to get me? Now, by doing this computation, you had a loss of 1.8. Under 202, you will have had loss of 1.8 in the house property income. But you are not allowed to have it set off against your other income. So therefore, the benefit that looked available to you may not in substance be available to you later on, because if you have just one self-occupied property and a loss of 1.8 would arise, if by virtue of section 202 2B you are not allowed to set it off, it goes waste. Then you don't get the benefit. But even then there is still a small ray of hope. What is the ray of hope? I have a self-occupied property. I have also another let-out property, wherein I have income of 5 lakhs. After all the computation, because I do the source-wise computation. House property 1 is self-occupied, house property 2 is let-out. House property 2, I have 5 lakhs. In house property 1, because of this exercise, I end up having minus 1.8. What 202 bar says, inter-head set-off under section 71 kind of a situation. It does not bar intra-head set-off. Therefore, when you have another house which is let out and you have a positive income, and you have this house property wherein you will have negative income because of pre-construction period interest now being available thanks to goof up in 202. So you are allowed to set off the loss under house property 1 as against the gain under house property 2 by doing an intra-head adjustment, although you are barred from doing inter-head adjustment. So it looks a little complex, but go back home, work out these numbers and figure out as to how it will operate. Now let's go to certain other amendments. Section 58. Section 58 is analogous to 44 AD, AE, AF, etc., where you will have in section 58(11) a definition of who the eligible assessee is. Now, if you look at the left-hand side, 2025 originally enacted, you have clause 1, has not claimed any deduction under 144. 144 is analogous to section 10 AA, SEZ benefit. If you go to next clause, has not claimed any deduction under chapter 8C, which is analogous to chapter 6A, except that what was 10 AA coming as part of chapter chapter 3, and not as part of chapter 6A, in the 2025 Act, it is no more a chapter 3 kind of a situation, it is moved as one of the deductions under chapter 6A kind of a situation. It's not remaining in chapter 3 now. So therefore, 147 is now part of chapter 8C. Now, as it is, there is a bar. You ought not to have claimed any deduction under chapter 8C. They did not realize this. When they enacted 2025, they were making bland comparison with 1961. Or 10 AA is coming separately, so we will put the parallel section, that is 147. Chapter 6A is coming separately, so we will put chapter 8 here, without realizing the change they themselves have carried out, that they have moved SEZ deduction from an exemption provision to deduction provision, and therefore it became a surplus to realize this. Therefore, what they are only trying to do is, they are omitting reference to section 144 because it is already part of chapter 8C. So, you may wonder, why am I explaining this? I took time to explain this because there are several, at least half a dozen amendments where reference to section 144 has been removed. So sometimes it, tempt you to understand, okay, claiming SEZ is not a bar for claiming so many other benefits is the impression you may possibly get into. That is not the answer. The answer is that because section 144 is already covered in chapter 8C, they have found reference to 144C as a surplusage, and therefore they are removing it. This has to be very, very clearly understood. And later on, we would only make a very passing reference to the similar amendment which is carried out in other sections in the 2025 Act. Now, this is an important provision. You know how you have been checkmated by checkmate decision, right? You have had a checkmating, you have suffered checkmating going backwards by checkmate decision, going forward by Finance Act of 2025 amendment, which stated that employees' contribution to the provident fund, etc., if not remitted within the due date as is given under respective statutes, you would not get the benefit of deduction, and this deduction is lost forever, unlike in other items that would come in 43B cases, where if you don't pay now, you could always pay up to the due date for filing the return of income for you to be eligible to claim the deduction in the relevant year. And if you miss out that as well, in whichever year you pay, on the basis of year of payment, you would have got the deduction. So 3615A got amended retrospectively by 2025 Act. Likewise, they brought in similar provision in the 2025 Act also. Look at this language here, 29(1)(e). You would get the deduction of employee contribution if it is credited by the assessee to the account of the employee in the relevant fund of funds by the due date, and in subsection, in clause 2, they seek to define what the due date. Due date is the date as is applicable under the relevant statutes like PF Act, ESI Act, etc., and not the due date for filing the return of income. Now, they seek to amend this. They find that this is not too good for the taxpayer. He should not be said that he would have lost the benefit forever. He has to be given some relief, and they have amended clause E to say that on or before the due date of filing the return of income under section 263(1) of the tax year. Mind you, this is an amendment only to 2025 Act. They have not made amendment to 1961 Act. So 3615A of 1961 Act remains unamended. So those of your assessees who have suffered the disallowance because of a minor delay of a day or whatever, those are stuck with the disallowances. It's only going forward in the 2025 Act, in respect of these contributions that are received from the employees, you will have the ability to remit the same into the respective funds on or before the due date for filing the return of income. However, at the same time, you will have to understand that they have not amended section 37 of the 2025 Act. This section 37 of the 2025 Act corresponds to 43B of the 1961 Act. Section 37 subsection 6, section 37 subsection 6 says, nothing contained in section 37 that would permit you to claim the deduction on the basis of payment would apply to employees' contribution to recognized provident fund. That is referred to in section 29(1)(e). So, in sum and substance, what is the takeaway for you? Insofar as employer's contribution, insofar as other statutory payments is concerned, you would have section 37, which is analogous to section 43 capital B, that would allow you to claim the deduction. In the same year, if you remit it up to the due date for filing the return of income, if not, in any other year in which the amount is actually paid, irrespective of the method of accounting you're following, that would not apply to employees' contribution to the fund, which will have to be invariably remitted on or before the due date for filing the return of income. If you miss it by a day, then you would have lost it forever. So you'll have to be mindful of this aspect, that section 37 subsection 6 is not amended. So the benefit of this particular section would not extend to employee contribution to recognized provident fund. Now this is a consequential amendment 36(1)(14) versus section 66, where commodity transaction tax was there, but they had not defined certain terms like taxable commodities transaction. So we'll not get into too much of a complication there. They just seek to define what is a commodity derivative. That was missed out, which they have carried out here. Now, let's go to a very interesting and hot topic of buyback tax, which has now come with a different avatar of top-up tax for promoter taxpayers. Top-up tax. Now, what are the amendments that they're seeking to make here? Section 2 within brackets 22 of 1961 Act would define what is dividend. It would say dividend include. Clause F of 222 provided that the payment on buyback of share or security is also a dividend. That is clause F. So when they enacted 2025 Act, 2 within brackets 22 came in the form of 2 within brackets 40. So what was clause F of 222 has now become clause F of 240, whereby they included buyback as part of the dividend even in the 2025 Act. This was creating a lot of issues in as much as under section 46A, subsection, there's a proviso to 46A, which stated that whenever there is a buyback, the full value consideration shall be deemed to be nil, which meant at one place you would have paid on buyback amount tax as dividend on the entire amount that you received, including the price that you would have paid to acquire the security on the entire amount. And in 46 capital A, to the extent of your cost, it was made an artificial capital loss, which benefit you could have got if and only if in the subsequent years or in that year you have had capital gains against which you could have set up this capital loss. This meant a significant cash outflow issue to you and an extremely uncertain, situation of whether you would ever be able to set up this loss, artificially created loss. This kind of dichotomy of treatment of buyback dividend at one place and creating artificial capital loss is something which is unheard in the tax literature. Finally, they have realized that this is not the right thing to do. So what they are now doing is to remove clause F. So clause F is now sought to be removed. So what they are trying to do is to remove this clause F and also carry out an amendment to section 69 of 2025 Act. Now, there are some minor issues that would arise here. Now go to section 222 of the 1961 Act. There, before they brought in clause F to tax the buyback amount, there was an exemption clause called clause 4. There was an exemption clause called clause 4. Clause 4 exempted buyback amount from being called as dividend. There was nothing to particularly deem buyback amount as dividend. However, there was a clause exempting it. You may wonder, why is a clause exempting it? Then you would start wondering, will it otherwise be dividend in the existing clauses? Like for example, any distribution, 222 clause A, any distribution which entails distribution of, any payment which entails distribution of accumulated profits would fall within the meaning of dividend. So because this clause existed, one would wonder, otherwise it would have come under 222A. right? Subsequently, as you know, they brought clause F into it, specifically putting buyback amount as part of dividend. And as they brought clause F, they omitted clause 4 exemption. Are you able to follow me? They brought in clause F, and obviously having brought in clause F, they had to omit reference to clause 4. Now, in section 2 within brackets 40, clause F is removed. They have not brought in a clause similar to 222(4), which would specifically exempt buyback from being regarded as dividend. So now, we will not be surprised if the revenue would now, despite the omission of reference to clause F, stating that it would come within the generic clause A, because the moment there is a buyback, the company would have parted with some of its accumulated profits in favor of those who have opted for buyback, and therefore it would come in the generic clause of 240 within brackets A. Can they take such an argument? Now, the answer to this question would be that clause 4 that gave an exemption is more a measure of abundant caution. With or without the exemption, it couldn't have been otherwise charged to tax, because in the case of buyback, it is a case of purchase of shares by the company from those shareholders who opted for it. It's a purchase consideration. It cannot be called as a payment that will entail distribution of the accumulated profits. This is point number 1. Point number 2, if existence or non-existence of clause 4 could have decided taxation of buyback as dividend, when in 2025 the amended section 2 within brackets 22, they could have just omitted reference to clause 4, they need not have brought in clause F. See, by removing the reference to clause 4 exemption would have been sufficient, but why did they have to bring in clause F separately? If you read all these together, that would convey that merely because an exemption provision exists or it does not exist, that would not result in creation of a charge. You have ITR 48, ITR 222, H.H. Divecha's case. The Honorable Supreme Court has stated that the exemption is not the one that creates charge. Exemption is an exception to charge, that's it. If at all such a charge existed, so exemption or an exception doesn't create the charge. So therefore, mere existence or non-existence of a clause similar to 222(4) should not make any difference, and therefore you will not have to be unnecessarily worried about non-existence of a clause like 222(4) in 2 within bracket 40 of the 2025 Act. Similarly, if you would go to section 46 and 46A of the Income Tax Act of 1961, compare that with 68 and 69 of the 2025 Act, section 46 relates to liquidation of a company, which is analogous to section 68 of the 2025 Act. What it says, when there's a liquidation, section 46(1) says, the company that liquidates and it distributes the assets or sum to the shareholders, company is not liable to pay tax. Instead, under 46 subsection 2, the receiving shareholder will have to pay tax, not to the extent which is deemed to be dividend in terms of section 2 within brackets 22 clause C. So what it did is, it carved out what would have been dividend, and the rest alone would have been charged to tax under the head capital gains. Under 46(2), in the case of liquidation, similar carving out is not there in 46A or in section 69. So therefore, when you receive money on liquidation, the treatment will be a portion of would be charged to tax as dividend, another portion would be charged to tax as capital gains. However, when you receive any money on buyback, no portion would be charged to tax as dividend. In entirety, it would be charged to tax as capital gains. So this is how you'll have to see the position in respect of the buyback tax. Now, section 7 of 2025 Act corresponds to section 8 It is just a consequential amendment because the omitted reference to clause F buyback. The consequential amendment is carried out in section 7.2 as well. It would not matter much to us at this point in time. Now let's go to the top-up tax. And before we go to the top-up tax, typically whenever there is a buyback, now after the proposed amendment, it would be like a case of transfer of the shares held by you or the securities held by you. It wouldn't be regarded as dividend. You will have to pay the capital gains tax. The computation would be like how you would have computed had you directly transferred it to somebody else. There's absolutely no difference between a typical transfer and a buyback for all the taxpayers. The promoter taxpayers also would be liable to pay this tax which I and you would have paid. Who are promoter taxpayers? We'll come to it little later. The promoter shareholders, non-promoter shareholders, the basic tax doesn't remain, does remain change. It doesn't, it wouldn't be different. It is just the same. Only difference is the promoter shareholders, apart from the normal capital gains tax what they pay, would also have to pay top-up tax, in respect of which the provisions have been brought in. Now look at this. You have 46A of 1961 Act, and on the right hand side you will have 69 of 2025 Act as originally enacted. This provided for basic levy under the head capital gains in respect of buyback. As I said earlier, subsection 1 is same as 46A main body and subsection 2 was corresponding to proviso which created an artificial capital loss in the originally enacted 2025 Act. So now they are seeking to amend 2 and 3 by bringing in subsection 2 and 3, completely substituting what they originally enacted in the 2025 Act. What is that they are trying to do? Look at this. They say, in respect of capital gains referred to in 69(1), that means the normal capital gains which I and you would have paid in respect of buyback, where the shareholder or holder of the specified security is a promoter shareholder. In short, we will call them as promoter shareholder. Then aggregate of income tax that he has to pay on such capital gains. Hear me carefully, such capital gains, meaning computation also is just the same. Computation is just the same. Then, what tax does a promoter shareholder have to pay? A. The income tax payable on such capital gains in accordance with the provisions of this Act. Normal tax on capital gains, which I and you would have paid, which is maybe 196 of 2025 Act, short-term gain, 197 long-term normal, 198 you will have the listed securities, etc., which are analogous to 111A, 112 and 112A of the 1961 Act. This is normal tax which you would have paid on capital gains on this security. You pay the tax A, and they say an additional income tax in respect of capital gains specified in column B of the table below, computed the rate specified in column C or D of the table below. So top-up tax has to be paid. So they are given the top-up tax rates, whether it is short-term or long-term. How is this top-up rate structured? It is structured on the basis of, on your normal income, what tax at max you would have paid. You are a domestic company, what maximum tax you would have paid? 22%. You are not a domestic company, what maximum tax you would have paid? 30%. Now, whenever, let's say you are a promoter shareholder, there's a buyback, you opt for it, you pay the normal capital gains tax, depending on short-term, long-term regular, long-term specified under 198. It could be, say, for example, 20% if it is short-term. If it is long-term, it could be 12.5%. Then depending on what's the maximum rate that you have to pay tax at 30%. So the differential tax is captured here. So if you are a shareholder and you are a promoter, if you are a promoter shareholder, then you are liable to pay tax if you are a domestic company at this rate, if you are a promoter other than a domestic company at this rate. Now as you move on here, they define who the promoter is. If you are a company whose shares are listed, then there is a SEBI buyback rules. As per 2K of the SEBI buyback regulations 2018, if you are a promoter for this purpose also. So in all listed company shares, you will have to see the definition of promoter under 2K of the SEBI buyback regulations of 2018 and apply the same here. And please don't ask me SEBI buyback regulation 2018 whether you are a promoter or not, because honestly I have not had time to go through that. Next, if you are not a listed company, then if you are a promoter as defined in section 269 of the Companies Act of 2013, or what matters to us would be or. If you are a person who holds directly or indirectly more than 10% of the shareholding in the company, then you are called a promoter shareholder. And if you would opt for the buyback, you will have to pay the top-up tax, depending on whether you are a domestic company or a non-domestic company. Now, certain issues do arise here. Some issues are common to even 1961 Act. For example, when you pay tax under 69(1) and 69(2), normal tax as well as 69(2), the top-up tax, would you get the rollover benefit similar to section 54, whether you get or not? Because when you go to the charge of section 45 of the 1961 Act or 67 of the 2025 Act, what is saved, those rollback sections are saved only insofar as 67 is concerned. Insofar as 69 is concerned, it would not be subject to saving. Likewise, section 45 only would say save as otherwise provided in section 54, etc. 46A does not say that. A question would arise as to whether benefit of rollover similar to 54 EC or whatever, whether it would be applicable to you in the case of buyback capital gains, whether it is normal gain or the top-up gain which you will have to pay. That is one question. But see, if somebody would seriously dispute your claim for it, that you are not eligible for rollover, then you should put a counter question to it saying that you are not liable to pay tax at all. Why are you not liable to pay tax at all? Because section 2 within brackets 109, which defines what an income is, it makes reference only to capital gains referred to in section 67. It would not make capital gains referred to in 69. So I would argue that capital gains are not incomes. Similarly, when you go to section 224 of 1961 Act, clause 6 or whatever which refers to capital gains, it makes only reference to capital gains as referred to in section 45. It would not refer to capital gains as referred to in section 46A. So therefore, you should be ready with a counter question if the department would not give you the benefit of rollover, to say that, look, if you don't give me the benefit of rollover, I will not pay tax only because it is a capital receipt. Capital gains are income by exception, not by rule. Capital gains are income by exception, not by rule. They are, an exception is created in terms of amendment to section 2 within brackets 24, like here in section 2 within brackets 49 of the 2025 Act. It would make reference only to 67, it would not make reference to 69. And you will have another question. See, typically in the case of unlisted shares, the full value consideration is benchmarked with the fair market value in terms of section 79 of 2025 Act, which is analogous to 50 CA of 1961 Act for unlisted shares. When you transfer the shares, then you will get a consideration that has to be benchmarked with the fair market value, applying 11 UA rules, and then if the fair market value happens to be more than the actual consideration, the fair market value shall be deemed to be full value consideration. Now, will that apply to 69? See, the answer is, if you go to section 69, that is made subject only to section 72, and it is not made subordinate to section 79, which corresponds to 50 CA. Therefore, it is possible for one to argue that 69 subsection 1 is a code by itself. It is at the most subservient to section 72, that is analogous to section 48, but it is not subservient to section 79, that is analogous to 50 CA. Therefore, you have a good case to argue that section 79, which is analogous to 50 CA, would not apply to buyback gain. Now, they have said the promoter shareholders will have to pay the top-up tax if they do the buyback. Then you will have some tax planning devices which the promoters may seek to do. They may do the gift within the family and wouldn't suffer the tax. And later on, the other persons who have been gifted may not be fitting into the meaning of promoters. It is only stated that a promoter is a person who directly or indirectly holds, not along with the relatives. It is not stated, but as they overhear us, I'm sure they're going to bring in an amendment to it, and they would state that promoter would include the relatives, and they would say 10% aggregate holding by promoter and his relatives. They're going to definitely make this amendment. Otherwise, it would be easy for the promoters to have the shares transferred to somebody else, which other person would then go for buyback, pay the normal tax, and would not pay the top-up tax. Now, the language is you are a person holding directly or indirectly more than 10% of shareholding of the company. The language is that you are holding directly or indirectly more than 10% of shareholding of the company. Several questions would arise here. Firstly, what do you mean by indirect holding? If Mr. Padam holds it directly, and if I hold it indirectly, can they consider this in the hands of both the persons? For which we'll have to first understand what is the meaning of indirect holding. So, indirect holding could be a situation where shares under demat, for example, depository is the registered shareholder, but the beneficial shareholders are all the persons whose shares have been put on demat. It could be a case of saying that you are holding it beneficially, depository is only holding it as a registered shareholder. Otherwise, in all cases, depository would have to pay the top-up tax. Next is a case where shares are held through nominees, where you hold the shares through nominees, not being Benami, only nominee, not being Benami. So, when you hold them through nominees, it would be a case of indirect holding. Now, the question that I posed to you is, can a share be held directly by A, indirectly by B? If it were so, can this be taken for counting both for A as well as B? So, in our view, when they say directly or indirectly, if it is taken into consideration on the basis of indirect holding insofar as B is concerned, it would not be right for them to reckon it insofar as A is concerned, for the reason that if somebody is said to be indirectly holding, then the other person who is only ostensibly holding is in fact not holding, is only ostensibly holding. Therefore, it's like, you have the decision of Supreme Court in Jodamal Kutiala 82 ITR in the context of deemed owner under section 27, where I am the legal owner, Mr. Padam is deemed to be the owner. Then if he is deemed to be the owner, Deeming him to be owner is excluding anyone else, including the legal owner, from being called the owner. So it's not permissible for them, in our view, to include this both in the case of A as well as in the case of B. Then they have not said, they only said 10% of shareholding. They have not said what is the type of shareholding. In a company, you will have preference shares and you will have equity shares. Let us say the capital structure is such that 60% is preference shares and 40% is equity shares, then lot many would escape this, because 10% will have to be reckoned with aggregate of share capital including preference shares. Here also they are going to bring an amendment. Then they would bring an amendment stating that 10% of that class of shareholding to which the buyback is applied is how they are going to bring an amendment very soon. Otherwise, if you consider aggregate shareholding, then like people get left out in a given situation, people may get included in another given situation depending on the type of the capital structure. We have some issues. Take the case of mutual funds, take the case of alternative investment funds, take the case of business trusts. For example, take the case of a business trust. So typically a business trust will hold shares in SPV, whereas the unit holders will hold units in business trust. And business trust is transparent in some respects, opaque in some other respects. Business trust is transparent in so far as it relates to interest income, in so far as it relates to the dividend income, in so far as if it is a real estate business trust, in so far as it relates to rental income. It is passed through. These three incomes will be charged to tax in the hands of the unit holders. The rest of the income in the hands of the business trust would be charged to tax in its own hands. And in respect of capital gains, business trust is called an opaque entity. It pays tax. It is not a transparent entity. Now, a business trust holding shares in an SPV most likely exceed holding 10%, because funds are pulled into it through the unit holders. So unless and until they bring a clear clarification stating that it is the unit holders who are said to be holding shares indirectly in the SPV, otherwise, in all situations of business trust would end up paying top-up tax. And because it is opaque, business trust itself will have to pay this tax. So similar problems could arise in the case of mutual funds and alternative investment funds. We'll have to see how it works out. Next is, you have to be a promoter. The law is silent as to when you have to be a promoter, any time during the previous year or at the time when the buyback is made. Because the law is silent, it is apt to understand that whether you are a promoter or not will have to be seen at the time when the buyback is made and the payment is made to you, not at any other point in time. Now, one interesting thought process, like how you have 115B to BAC in the 1961 Act, you have 199 to 202, 199 to 202. Like you can go for 25%, you can go for 22%, you can go for 15%. If you would go to any of these sections, it would override whole of the Income Tax Act, except parts A, B, and E of chapter 13. I'll repeat again. Let's say you are a company, you opted for 22% tax, meaning it is a section 200 company, which is analogous to 115BAA of the 1961 Act. So you are a section 200 company. How does section 200 apply to you? It says, notwithstanding anything to the contrary contained in the entire 2025 Act, but subject to A, B, and E of chapter 13. If you go to A, B, and C, then you will have section 190 to 195, 196 to 190. Look at part B. You will have these taxes at, like short-term, long-term, and long-term listed. These are the sections that come there, 196 to 198. So therefore, you may take an argument stating that if you are a section 200 company, section 200 is subservient only to these parts of this particular chapter, it will override rest of the act, which will include section 69, and therefore, such cases, you don't have to pay the top-up tax. Are you able to get me? So, unless they amend section 202 to also say that this particular section, so will override even 69(2). Otherwise, top-up tax is considered as subsumed into the tax that you would pay under 196, 197, 198, which override section 200. So you pay 22% on normal income. On your capital gains, you pay tax under 196, 197, and 198, as the case may be, at 20%, 12.5%, or whatever. The top-up tax comes under section 69(2), which you would say it is overridden by section 200, and therefore you are not liable to pay the tax. Next would be certain questions. If it go to 69(2), please go back to section 69(2). Look at this. I think we'll have to see 69(1) first. Subsection 1 says, shareholder or holder of other specified security receives any consideration from any company. As you could see, there is no distinction between residents, non-residents, domestic companies, foreign companies. It looks like 69(1) would apply to every shareholder. Now, if you go to 69(2) as is sought to be amended, that would apply to shareholder or holder of other specified securities, where he is a promoter. Then you come to the case of table. Table, you have two columns. First is a case where promoter is a domestic company. Second is a case where promoter is other than a domestic company. This would mean foreign company, non-residents, all will get captured here. And a foreign company, the highest tax rate is 35%, whereas the top-up rates which are captured here are aligned to 30%. Would it mean that it's a favor extended to foreign company is an issue? Because top-up rate, when you add it to the normal rate, would match to 30%, whereas the foreign company pays tax at 35%. So it may not achieve their intent of reaching the max tax rate at which you are liable to pay tax, is one situation. Another situation is, if a non-resident covered by DTAA, is he allowed to argue that 69(2) will have to be subsumed into the applicable provision of the DTAA? Answer should be yes, because if you look at 69(2) language, what is it you are liable to pay for a promoter shareholder? One, aggregate of income tax payable on such capital gains. Look at these words carefully, in accordance with the provisions of the Act. Then, additional income tax in respect of capital gains. Again, capital gains. So, both 69(1) tax and 69(2) tax qualify to be called as tax on alienation of a capital asset. And hence, all the taxes are to be regarded as taxes under domestic law, to be juxtaposed to tax that you would pay under treaty law, and in terms of section 90, if it is more beneficial, 90 subsection 2 will have to apply. Subject, of course, to GAR provisions, subject, of course, to extraordinary GAR provision introduced in Tiger Global case. You can also examine the effect of this buyback on people who are now wanting to internalize, reverse flipping that is happening, where they would want to move the holding companies located elsewhere to be located in India. For them to have the holding company to be located in India, in order to achieve this, they may invariably have to go for buyback. Because buyback is one route where you could reduce the shareholding without diluting your stake. So buyback is one such, sought after route. And if they were to do it now, and if the promoter companies, they will have the additional liability that would, come on them. You'll have to keep that in mind. Are you okay to hold on for a while before we break for tea? Yeah. Now, sovereign gold bond. The earlier position was that if you would have it redeemed, it would be exempt. Howsoever you would have acquired it, you would have originally acquired it or you would have bought it out in the market. As long as when you transfer, it has to be by way of redemption. Not even redemption on maturity, redemption. If you typically look at the sovereign gold bond rules, after 5 years you have an option to redeem, and after 8 years compulsorily to be redeemed. So the Government of India issued sovereign gold bonds at the rates at 4,200, 4,500, 5,000, 6,000. Now the gold rates have shot up to, it went up to 17,000. I guess now it is hovering around 15 to 16,000 or whatever, which will mean, I was told that the liability is close to more than 1 lakh crore for the Government of India. So they would want this, like they want possibly to mitigate this, or want to take a portion of the gain that, according to Government of India, we are unjustly making. So therefore, they brought in an amendment to suggest that it will be exempt if it is held by an individual from the date of original issue till maturity. So two aspects. One, those who are bought out in the open market would not get the benefit. Those who are originally bought but would offer for redemption when they are allowed to do also would not get the benefit of exemption. That means after 5 years you have an option to go for redemption. No, you don't get the exemption. It's only redemption on maturity. That would happen only end of 8th year. So therefore, if you want full exemption, then it is necessary for you to be the original allottee and you have to hold on to it. Most unfortunately, they have to have grandfathered it. They are not grandfathered it. It's a breach of promise because they held a promise upon which premise you would have invested. And at least if they would want to change the law, they should change the law prospectively. This is completely contrary to the assurance made in 2014 by Mr. Arun Jaitley, stating that this government would not want to do retro law. But if you look at the amendments, particularly to the Income Tax Act of 1961, out of 26 amendments proposed, at least a dozen of amendments are retrospective. Unfortunately, they have committed this breach of promise without having grandfathering. Now, there are some amendments to section 93, particularly in respect of dividend income. I would only explain you briefly 2 amendments, and the sum and substance of these 2 amendments, which are made to section 93, is that on dividend you get no deduction whatsoever. Ease of living, right? See, otherwise you will have reasonable collection charge. Then you go to 93(2), which would state that you will get interest deduction not exceeding 20% of dividend, all complications. So the ease of living is that no deduction. So all the dividend that you would get, you will have to pay tax. So I will not take you through the split reading of this provision for want of time, because we have already taken enough and more time on this. But the sum and substance of amendment to section 93(1)(a) and 93(2)(a) and (b) is that you don't get any deduction whatsoever in respect of dividend income from shares, mutual funds, which are referred to in Schedule 7, item 20 and 21. That is SEBI registered mutual fund and mutual funds set up by the public sector banks and the public financial institutions, or those which are authorized by the RBI. So with this, we will break for tea. We will get back after tea for how long?
We get into amendments made to 139 of the 1961 law. The corresponding provision in the 2025 Act is 263 onwards. First is the amendment regarding the due date for filing the returns of income. One change has been introduced for those assessors that have business income but are not required to get the accounts audited either under the Income Tax Act or under any law for the time being in force. under the current regulations, they were required to file their return of income by 31st of July. The government says that we would like to give them some more time for the purpose of preparation of their accounts and filing the return. And therefore, for these people who are carrying on business, who are not required to get the accounts audited, either under the Income Tax Act or under any other law for the time being in force, time of 31st of August has been introduced. Actually, this was the time that was already prescribed once upon a time earlier. Now they're reintroducing that, and that's the new slot that has been created. Otherwise, the slots for the other dates remain the same. So for a firm or the partners of such firm who are not getting their accounts audited, you will have 31st of August as the due date for filing a return of income. If you look into the memorandum explaining the provisions of the finance bill, they've also said trusts are also required to file the return of income by 31st of August. There is a mention made. You don't find a mention of that in the due dates as prescribed in the finance bill, but the memorandum makes a mention that trust will also, who are not required to get their accounts audited, either under this Income Tax Act or under any other law, will be required now to file the returns of income by 31st of August. The provisions of 139(5) are sought to be amended to provide for furnishing of a revised return of income within a little extended time. Currently, 139(5) mandated that you file the revised return of income by or within a period of 9 months, that is by 31st of December of the assessment year. 139(4) also had a similar timelines. Therefore, a person who filed a belated return, the 139(4), towards the fag end had hardly any time for the purpose of revising his return. They said that we would like to give these assessees some more time for the purpose of revising their return. And therefore, the law has been, the proposal is now that we will give you time to file a revised return of income for up to the end of the relevant assessment year. That means a period of 12 months from the end of the financial year. That will be the maximum time for filing a revised return of income. This is subject to the fact that you are liable to be subjected to a fine or a fee that will be levied under 234I of the Income Tax Act. So if you are filing your return of income between 139(1), no consequence. If you are filing a return of income under 139(4) up to December, then the question is, you are liable to pay a fee under 234F of 1,000 or 5,000, depending upon the quantum of income of the assessee concerned. A person who has filed a return up to December, either under 139(1) or 139(4), if you would like to revise his return now under 139(5), then he will be liable to be paying this fine under 234I, which is again a sum of rupees 1,000 if the income is less than 5 lakhs, and it's going to be a sum of 5,000 if the income is above 5 lakhs. A question naturally arises where a person has filed a return of income under 139(4), that is after the 139(1) time limit, he is called upon to pay 234F fee by December, and this fellow who wants to file a revised return of income from January onwards, what will be the position concerned? Would he be liable to pay 234I in addition to the fee that is payable under 234F? If you look into the proposed section 234I, it says, without prejudice to the other provisions of the Act. That means we don't in any manner impair, impact, in any manner change the application of any other provision of the Income Tax Act. That means 234I would be in addition to the liability to pay a fine or a fee under 234F. So a person who has filed a return of income before December, a belated return, if is now required to furnish a revised return of income beyond December up to March, he'll be called upon to pay both 234F as also 234I fee. A revised return is not permissible under particular circumstances under other provisions of the Act. For example, under 158 BC 1, the fourth proviso says if you're filing a return of income under the block period concerned, you're not permitted to file a revised return of income. Those provisions under other sections of the Income Tax Act, therefore, have not been amended. They remain as it is. You may be also called upon to file a modified return under particular circumstances. When there is a TP adjustment that is happening, a secondary adjustment is happening, or under 170 capital A, there is a reorganization that is taking place which mandates us to, or assessee to file a modified return of income. That modified return of income will be governed by those respective provisions. They are not in any manner impacted by the amendment to 139(5). They remain as it is. This is as far as the revised return of income is concerned. We then move to an important provision of an updated return. And important for us to therefore initially analyze what are the changes under the Income Tax Act 1961. Then we will go into whether those changes are there similar or the impact is dissimilar under the 2025 Act. If you go into 139(8)(a) of the Income Tax Act, they permit you to file a updated return of income, whether or not you have filed a return of income under 139(1) or 139(4) or 139(5). You may have filed a return or you may not have filed a return. You are, by virtue of 139(8)(a), allowed to file an updated return of income within a period of 4 years from the end of the relevant assessment year. That is the opening portion of 139(8)(a). It's important for us to understand the structure of 139(8)(a). There's only one section with a number of provisos. There were initially 5 provisos in 139(8)(a). Finance Act 2025 brought in 2 provisos. They were inserted as the 4th proviso and the 5th proviso to 139(8)(a). As a result of this change, they became 7 provisos. The Finance Bill 2026 is now proposing to introduce an 8th proviso. It's important, therefore, to bear in mind that 139(8)(a) has 8 provisos if you take into account the proposal in the Finance Bill 2026 as having been enacted. What do these provisos tell us? Take, for example, the first proviso to 139(8)(a). It says the section shall not apply in the following circumstances. That means the section relatable to an updated return will not be applicable in the circumstances mentioned in the first proviso. 3 circumstances are mentioned in the first proviso. The first circumstance is where the revised, updated return is a return of loss. That is the existing provision. Therefore, if you are wanting to file an updated return, but that shows a return of loss, then by virtue of the first proviso, you are barred. 139(8) capital A itself is not applicable. You cannot file an updated return. They are proposing a change here to say, I will allow you to file a return of loss provided it leads to a reduction of your original loss return. Is the proposal made. So the first proviso, which has a bar, is sought to be amended by saying that, yes, I will allow you to file a return of loss as an updated return, provided this return of loss is ultimately showing a lesser loss than what was originally filed by you. Or if the return of loss is converted into a return of income, I'll allow you to file the updated return. Where there is a reduction in the tax liability of an assessee, or where is an enhancement of the refund due to an assessee, then these are other 2 circumstances as mentioned in the first proviso to 139(8)(a), which bars the applicability of this section itself, and therefore, under these circumstances, that means a return of loss, save those specific circumstances you know introduced now, to say where there's a reduction in return of loss, that will be one exception. Otherwise, generally a return of loss or something that results in the reduction of a liability or enhancement of a refund are circumstances under which the section itself will not be applicable. Having laid out this disability is concerned, the second proviso were to list out 4 other circumstances under which a person, if he is met with those specific situations or circumstances concerned, will be barred from filing an updated return. And interestingly, In these circumstances which are mentioned in the second proviso, you will be barred for filing a return of income for that year as also any preceding assessment year. There will be an absolute bar. And what are the circumstances? For example, an action under 132 has been initiated against an SSC. If that action is initiated, then the SSC concerned is barred from filing an updated return either for the year in which the search has been initiated or for any preceding assessment year itself. A survey has been conducted, a requisition has been made, or you are a third person for a search is happening about in some other else's place, and there are certain documents, undisclosed income relatable to the SSA concern, who now becomes a third person. He will therefore be barred from filing an updated return. These are 4 circumstances as mentioned in the second proviso. You are barred because of these specific circumstances. You will be not permitted to file an updated return for that year or for any preceding assessment year. There is a third proviso. We'll therefore lead to the third proviso also and then try and discuss some aspects on this matter concerned. Third proviso says there's be a specific bar for that assessment year if you're falling in the circumstances as mentioned out in the third proviso. The first is where you've already filed an updated return. Where you've already filed an updated return, you will not be permitted to file a second updated return. There's a bar. Second is, if in case your assessment proceedings have been completed or are pending, you will be barred from filing an updated return. Third would be if information is given to the department and a particular enactment concerned, an action has been taken under the PMLA Act or the Black Money Act or certain other enactments concerned, then that SSC will not be permitted to file an updated return. Fourth would be where information under 1990A of the Income Tax Act has been received from some other country concerned. Then, in relation to that particular person for that particular year for which information has been received, you will be prohibited from filing an updated return. Where prosecution provisions have been initiated, that is Chapter 22 has been initiated against an SSC concern, then that person will be prohibited from filing an updated return or any other circumstance or any other person that the central government may by notification say. So under the third proviso, 5 conditions have been laid out. You are prohibited from filing an updated return for that particular assessment year. One circumstance I mentioned was that where the assessment is completed or is pending. To this situation, an exception is now proposed now that even if the assessment is pending or the assessment has been completed, if a notice under 148 has been issued to an assessee concerned, then we will permit him to file an updated return. So that's the proposal made. With these 3 provisos, and first thing is therefore, it's important for us to understand that these are all provisos to 139(8)(a). A proviso therefore creates an exception to the main body. The provisos ultimately go on to fulfill a single underlying theme. And if therefore you're having situations concerned where there is some sort of a in clash between the provisos concerned, question then arises, what will be the way in which you're going to resolve this dispute? For example, the law is now making a statement that if there is a notice issued under 148 of the Income Tax Act, and that notice prescribes a time limit within which you are required to file a response to that, then instead of filing a return in response to the 148 notice, we are permitting you to file an updated return within the time as mentioned in the 148 notice. So the law is now visualizing that by the 8th proviso and by some sort of a modification to some clauses of the 3rd proviso, they are making a statement that in situations concerned where a 148 notice has been issued to you, we will permit you to file an updated return. When you have this 8th proviso, you will automatically look into the 1st, 2nd, and 3rd proviso. You will automatically come to a lot of questions concerned as to how and what will be the interplay between the 1st proviso, 2nd proviso, 3rd proviso with the 8th proviso. would they, with the eighth proviso, now which permits you to file a return of income in pursuance to 148 notice, that is fine. We are also permitted to file an updated return in pursuance to this notice concerned. Will that permission now to file an updated return overpower the restrictions or limitations as given in the first proviso? For example, the first proviso would say you cannot furnish a return of loss in pursuance of, you cannot file a return of loss as an updated return. You cannot file. Now, when I get a notice under 148 and I'm allowed to file a updated return in response to that, logical question that arises is, can I file now a loss return in pursuance to this notice, which is now a specific provision given to me under the eighth proviso? Will this eighth proviso, therefore, overpower, will therefore supervene over the first proviso, which has certain limitations by itself? Now, when they introduce the eighth proviso, saying that I'm going to allow you to file an updated return, it means that the Parliament was aware of the earlier 7 provisos when they introduced the eighth proviso. They knew about the existing bar available in the first proviso. Despite that bar being available, if they are now permitting you to file an updated return, there are no qualifying conditions in the eighth proviso. So will the eighth proviso now permit you to file a return of loss in pursuance of a 148 notice? Can be a moot point. A person has been raided, a survey has been conducted in this case, and therefore he is a person concerned who is now falling in the second proviso. Therefore, he is prohibited from filing an updated return for that year or for any earlier year. A person who has been, therefore, searched, or a person who has been surveyed, that will be a better example, a person who has been surveyed, if he is issued a notice under 148, now, will the bar under the second proviso be overcome and will he be now permitted to file an updated return under the eighth proviso? Same logic, same answer, because there is a clash between the second proviso and the eighth proviso, and the government consciously has introduced the eighth proviso despite the existence of the second proviso, despite being aware of the conditions or limitation under the second proviso. It will be logical to make a statement that, and possible to make a statement that, yes, I should be allowed, I should be permitted to file a updated return in response to a 148 notice. Similarly, to the third proviso, they said you have filed an updated return. I will not allow you to file another updated return. So I filed an updated return. But for that year now, I have issued a 148 notice. Can I now file an updated return in response to this 148 notice? Again, clash between the eighth proviso and the third proviso. Possibly the same resolution would happen by saying that in this clash concern, eighth proviso should be allowed to prevail over the third proviso limitations also. You have to therefore go further up and ask questions. What is the maximum time available for you to file a updated return? By the main body, it says a period of 4 years. From the end of the relevant assessment year shall be the period within which you can file an updated return. The eighth proviso says, I'll allow you to file an updated return in pursuance to notice under 148. What is the maximum period under which 148 notice can be issued to you? 5 years. So now I'm getting a notice under 148 for the 5th year. If I'm getting a notice for the 5th year, will I be permitted to file an updated return in response to the notice for the 5th year? You can go further up to say, under 150 subsection 1, I can get not more than 5 years. I can go beyond 5 years also and make a statement concerned to say, it might be 6th, 8th, 10th, 12th year also, and I issue a 148 notice for you. Will you be now permitted to file an updated return in response to this notice which has been issued to you beyond the time available under 139, 8 capital A, which is maximum 4 years time. This gives rise to another interesting question. Added question would be, once you are allowed to file an updated return, it comes with a consequence. The consequence is you're liable to pay additional income tax at 25%, 50%, 60%, or 70%, depending on 25% if at 12 months, that is 1 year after the end of the relevant assessment year, 50% for the second year, 60% for the third year, and 70% of the fourth year. That means the amount of tax and interest payable, you'll have to accumulate them, add surcharge to this also, to the basic tax, find out the amount of tax payable, add 25% or 50%, 60% or 70%. This is the normal tax that you're required to pay as an updated return. If you're filing an updated return in pursuance to a notice under 148, to this 25, 50, 60, 70, add 10% more. 25 will become 35, 50 will become 60, 60 will become 70, 70 will become 80. That's the amount of tax and interest you're required to pay for you to have the ability to file a updated return in response to a notice under 148. So the maximum is 80 for a period of 4 years, 70 plus 10. Now, when I come to a 148 notice, which is issued for the 5th year, where I'm required to, therefore, I am possibly allowed to furnish an updated return. What is the manner of discharge of tax? Because the law is only saying 70% up to the 4th year, there is no rate of tax prescribed for the 5th year. Can I make a statement, therefore, since no rate of tax is prescribed, I'm only required to discharge the 10% additional tax. Normal tax plus 10% additional tax is the maximum tax required to pay, and therefore for the 5th year, I should be permitted to file an updated return by paying only the normal tax and 10% of additional tax that is now prescribed under the new dispensation. So we'll have a lot of difficulties in terms. It's very easy for me to make a statement that yes, since the law is not making any prescription of the rate of tax, that whole thing will fail. Therefore, 10% should be the maximum tax you're required to pay. If these limits or limitations are pointed out, I don't think the government is going to come out with a solution in favor of the taxpayer concerned. They're going to make an amendment to the 8th proviso now to make a statement that this 8th proviso will apply only for a maximum period of 4 years. Therefore, the limitation of 148 notice will have to be built into the overall time frame of 139(8)(a). Only then you'll be able to make this functional, otherwise you'll not be able to make this functional. As on date, the existence of the 8th proviso and its clash within the other provisos concerned is giving rise to a lot of gaps, which gaps therefore are appearing to indicate a lot of loopholes or gaps in the entire reconciliation of the law concerned. Therefore, there could be a lot of difficulties in giving effect to the provision as they have introduced. We stopped at the 3rd proviso. There is a 4th proviso, which says that if a notice under 148 capital A has been introduced or has been issued to an assessee concerned, then I will not allow you to file an updated return beyond 36 months. So normal time for filing an updated return is 48 months. But if the notice under 148 capital A has been issued to an assessee, therefore you're beginning an interaction with an assessee where he issues a notice to say that there is some income escaping assessment in your case, and therefore I'm inviting you to certain questions and answers, give some information before I come to a conclusion whether it's a fit case to issue a 148 notice. So where a notice under 148 capital A has been issued to an assessee concerned, the 4th proviso, I would say, that you will be barred from filing an updated return for the 4th year. Up to 3 years, I'll allow you. So 148A notice has been given to you, 1st, 2nd, 3rd year, I'll allow you to file an updated return. For the 4th year, I'll not allow you to file an updated return. The 148 capital A is logically followed by a notice under 148. When I therefore get a 148 notice after the entire procedure under 148 capital A has been accomplished, then will the doors of the 8th proviso come into my rescue to say, look here, a notice under 148 has now been issued to me, as a result of which, therefore, I can file an updated return even for the 4th year. The answer possibly should be yes, that once 148 notice has been issued even for the 4th year, having completed the procedure under 148A, the bar there under the 4th proviso should yield to now the mandate available under the 8th proviso concern. 148 capital A mention also gives you some sort of an indication concern that when 148 capital A notice has been issued to an SSC, whether the assessment is said to be pending. If the assessment is said to be pending because of the notice under 148 capital A, then the 3rd proviso will tell you that if the assessment is pending or has been completed, you are barred from filing a updated return. The 4th proviso makes a statement that if a notice in 148 capital A has been given to you, I'll allow you to furnish an updated return for a period of 3 years, indicating therefore that 148 capital A is some sort of a tentative inquiry, assessment is not yet said to be pending. That may lead to a conclusion that income is escaping assessment, or may lead to a conclusion income is not escaping assessment. That by itself does not mean that the assessment proceedings are pending. If the assessment proceedings are therefore not pending, you will be permitted to file an updated return. Therefore, there will be no bar, and 148 capital A notice therefore does not tantamount to a case where, a situation where assessment is said to be pending, it not therefore pending, the bar under the 3rd proviso will not be attracted, you will be allowed to furnish an updated return. 5th proviso is a consequence of the 4th proviso, not very relevant at all. The 6th proviso earlier said that yes, I'm allowing you to furnish a return of loss provided that results in a lower loss or that results in a translation of the return of loss into a return of income. And the 7th proviso earlier said that if you have filed an updated return for a particular year, and then the loss carried forward for the subsequent years gets reduced, or the carried forward credit under 115JA or the MAT credit or the AMT credit is now therefore reduced for the subsequent years concerned, then for all subsequent years, there shall be a mandate of filing a revised return, updated return. For all subsequent years, therefore, when there's an impact of a change in a particular year concerned, a cascading effect will have to be given effect to by filing a mandatory updated return for subsequent years concerned. Small changes happen there. That will be because of the changes in the MAT. Chythanya will explain to us after my session is over on the MAT credit concern. So they have made certain changes to the carry forward of MAT credit under particular circumstances for a domestic company and for a foreign company concerned. How, under what circumstances can a domestic company claim a credit? Under what circumstances a foreign company can claim a brought forward credit of MAT taxes concerned? Some changes have been made there. Those changes we'll have to wait for Chythanya to explain to us. But what is important is, subject to those conditions of a domestic company and a foreign company being fulfilled, you'll be able to carry forward a MAT credit. And that MAT credit, if it's been impacted by virtue of an updated return for a particular year, then the returns for the subsequent years will have to be mandatorily filed all over again. So for the 8th proviso, therefore, we have a number of situations concerned where there is a lack of coordination between the situations contemplated in the 8th proviso vis-a-vis what is there already in terms of a specific bar or a restriction or a limitation in the 7th provisos preceding the 8th proviso. That gives rise to a lot of difficulties concerned. Some of these difficulties are gotten over, are not visible in the 263 amendments made. That means section 263 of the new Act, 2025 Act, deals with the concept of a return of income. Subsection 6 thereunder deals with the updated return. Subsection 6 says, I'll allow you to file an updated return for a maximum period of 4 years. This is a statement made under limb A of 263 subsection 6. Extremely important for us to notice this, that under 263A subsection 6, limb A is a very clear mention to say that you shall be permitted to file an updated return for a period of 4 years only. Now, the 8th proviso we're talking of in 139(8)A is inserted in terms of 263 subsection 6 clause B. Just following clause A, clause B is now sought to be inserted by having two clauses there. substitute, there is one clause B already there, which having one subclause today. That subclause B is sought to be substituted by having two subclauses concerned. And those two subclauses, very important to note that the provisions of clause A shall continue to apply in these situations concerned. So, the clause B that is sought to be amended now would indicate that I may be permitted to file an updated return in response to a notice under 148. That is the permission granted to you under the amendment made to 263(6) by amending clause B. This clause B would say the provisions of clause A shall continue to apply. When it says that it shall continue to apply, it means that the limitations made under clause A will continue to apply despite the changes made in clause B. Clause B therefore is saying, I'll allow you to furnish an updated return in pursuance to 148 notice, and this would indicate that, yes, the overall time limit which is available under clause A shall continue to apply even to this notice under 148 issue. The corresponding notice to section 148, I'm making a reference to 148 because we're very familiar there. So if a reassessment notice is issued under the new act, by virtue of the overarching superiority of clause A, you will be allowed to file an updated return only for that 4 years maximum. So as compared to the provision that is there in the 8 provisos, we find the new act is a little better structured in terms of this condition concerned. But as far as the other conditions is concerned, in terms of the provisos interplay itself, we saw that under the 61 Act, when there is a clash between the 8th proviso, which is the 3rd proviso, or the 2nd proviso, or the 1st proviso, we made a statement that these are a part of the single scheme itself. Therefore, when you're going to look into the provisos concerned as being a part of a single theme, single idea, single underlying objective to be achieved, you will therefore have to interpret them in a manner that which best suits the purpose concerned. And therefore, we make a statement that the 8th proviso should be allowed to prevail with the other provisos concerned. Under the 2025 law, we don't have provisos. We have 263 subsection 6, which has subclauses. We have seen subclause A, we have seen subclause B. We now come to subclause C, we come to subclause D. So subclause C and subclause D of 263 subsection 6 incorporate the various provisos and the restrictions of 139(8)(a). So the provisos of 139(8)(a) are available to us under subclause C and subclause D of 263 subsection 6. So when you have them as subsections independently under 263, then the question arises that these sections are going to have their independent role to play. They'll have their independent existence. They are not therefore yielding to any other proviso, because unless there is some sort of a linkage to these provisos concerned, say that they shall yield to a particular overarching condition concerned, they will have their independent role to play. They'll therefore have to be given their independent existence. So when you therefore have the clauses C and D making a reference to the various limitations concerned that were originally available under the various provisos to 139(8)(a), then the question arises, if there is a clash now under the new act between the ability to file a return of income in pursuance to 148 notice, when some existing clauses already bar you from filing a return in response to that notice, under the 2025 dispensation, it may be that much difficult for us to overcome the limitations already. For example, clause C would say, if you have filed an updated return already, I will not allow you to file a new updated return. Now, if you are having a 148 notice being issued today, and you would like to file an updated return in response to that notice under 148 under the new dispensation, possibly 263(6)(c) will bar you from filing an updated return in pursuance to this 148 notice, for the reason that there is a specific bar which says that having filed an updated return already, you will be prohibited or not be permitted from filing a fresh updated return. So the same conclusion that may be possible under the 61 Act because of the entire change in setting of the 2025 Act may not necessarily carry forward, may not necessarily carry through under the 2025 Act. We have to be mindful of the entire setting of the 2025 Act, where the updated return is now classified into, and the functions are now being classified into various subclasses concerned, and accordingly you will have therefore a case of the disability or inability to file an updated return in a file in response to a 148 notice. The law also would say that if a notice under 148 has been issued, you can file an updated return, and this filing of an updated return will preclude you from filing a return of income in any other manner whatsoever. So you will not be therefore able to file a regular return in response to this 148 notice. You're prohibited. Once this is done, you will not file a return in any manner whatsoever. Possibly, I will not allow you to file even a second updated return within time available to you under 148 notice. Because there will be a preclusion, there will be a prohibition. You will not be permitted to file a return in response to this 148 notice once you have filed an updated return in response to this 148 notice. How do you file an updated return? Because a normal return is filed under Rule 12 of the income tax rules. Updated return is filed under Rule 12AC of the income tax rules. So when you file a return in response to this 148 notice, how do you call it as an updated return? When you have two different rules that deal with two different types of returns. Possibly, therefore, they'll have to make a change to the rules also. Now to make a statement that I'll allow you to file an updated return in Form 12AC also directly in pursuance of a 148 notice. 148 notice, subsection 2, and the main body and the proviso thereunder says, when you are issued a notice on 148 and there is a return in response to that 148 notice, it shall be treated as though the return of income is a return filed under 139, and all consequences of the act shall apply accordingly. Possibly even that will have to undergo a change because once I'm filing a return, an updated return in response to the 148 notice, we'll have to make a statement that this return shall be covered by the subsection 2, and therefore this return, updated return, shall also be regarded as an updated return in response to the notice under 148. And all provisions of the Act shall apply accordingly as though it is a return required to file in accordance with 139. We also have to be mindful of, once the return is filed in response to this 148 notice, an updated return is filed, what are the time limits for completion of assessment? If you go into 153, that deals with the time limit for completion of assessment, we have 153(1) capital A, that deals with a particular time limit for completion of an assessment where an updated return has been filed by an assessee. I am having a situation where an updated return is being furnished in pursuance to a 148 notice. 153 subsection 2 says an reassessment shall be completed within a particular point of time. There is an apparent clash. There is a lack of symmetry between the time limits available under 153(1) capital A and 153 subsection 2. 153(1) capital A gives the time limit for updated return. 153(2) gives the time limit for a reassessment notice that has been issued, and what is the time limit for completion of the assessment concern. So which will be the time limit that will be applicable? If you read 153(1) capital A, which talks about an updated return and the completion of assessment, it says, an assessment under 143(3) or 144 shall be completed in the manner as provided under 153(1) capital A. Now, I am not into case of a 143(3) assessment or a 144 assessment. I am into a 148 assessment. Technically, therefore, 153(1) capital A shall not be applicable in my case, although it is an updated return, for the reason that 153(1) capital A only deals with a 143(3) assessment or 144 assessment, does not deal with 148 assessment or 147 assessment. Therefore, what will be the time limit applicable will only be 153 subsection 2, which says that every reassessment shall be completed within a period of so and so time from the end of the relevant assessment year in which the notice under 148 has been issued to an assessee. We saw the fact that 148 capital A procedure can be adopted before we go to 148. But there are particular circumstances where I don't have to go through 148 capital A. I may directly go to 148 itself. Under the 1961 law, I can go to a 148 notice directly in a situation where the action or information is taken under 135 capital A. When that happens, I don't have to go through the entire procedure of 148 capital A. I may issue a notice directly under 148 of the Income Tax Act. Under the 2025 Act, this 135A is retained and two more circumstances have been added. Those are GAR cases and where information under section 90 or 91 has been obtained from another country concerned. In these situations or circumstances concerned, I don't have to go through the 148 capital A process. I may directly issue a notice under 148. So in those situations concerned, therefore, there's obviously no question of a clash between 148A and 148 because directly I'm issuing a notice on 148 and subject to what we have discussed, if a 148 notice has been issued to an assessee concerned, he'll be allowed to file an updated return on this matter concerned. 266 will deal with the payment of self-assessment tax and 267 will deal with tax on updated return. We've already seen how the tax has to be paid by an assessee concerned, 25, 50, 60 or 70%, plus 10% is the additional amount of tax you'll have to be discharging if an updated return is filed in pursuance to a notice under 148. This 10% that has been now paid, this type of income on which you're paying this 10% will be saved from the levy of penalty under 439. We'll have an occasion to refer to that a little later, but you have to be mindful of the fact that having discharged this additional 10% under 140 capital B or 267 of the 2025 Act, you'll be saved of the penalty on the same income concern. But this is the amount, save that position concerned, and save for the changes in relation to MAT calculation that we are going to see now after this portion of the session is over. We'll be able to make a statement that the balance of the tax will have to be discharged in accordance with 267. And this updated return in a filing will have to be a situation where possibly the interplay with 234F, 234I, as also the 140 capital B will have to be looked into account on a consolidated basis for the purpose of overall discharge of tax. If you're therefore having a situation where you're called upon to pay 234I, you may therefore be called upon to pay 234I, plus also will be called upon to pay the additional tax as mandated upon under 140 capital B of the Income Tax Act. So these are certain changes in relation to the return of income. We'll now go into the MAT tax. The Chythanya will take us into the next section.
There are some very important amendments in the context of minimum alternate tax going forward. Fortunately, this amendment is carried out only in 2025 Act and not in 1961 Act, although it would have impact on accumulated MAT credit up to 31st March of 2026 under the 1961 Act. So one good thing is I wouldn't have to keep making reference to analogous provisions of two statutes. Section 206 of 2025 Act, we will have to look at the changes that are proposed to be made. The first and the most important change is the MAT rate stands reduced to 14%. And this 14% is a sunk cost, no carry forward. I am referring to tax year 26-27 onwards, new act 26-27 onwards. If you are liable to pay MAT, you pay MAT at 14% and that's it. No carry forward, nothing. You are stuck to the tax. However, if you are a unit of IFSC, International Financial Services Unit, the MAT rate, which was at 9%, continues to remain at 9% now, because you would have exemption here in terms of section 147 of 2025 Act for a good length of 20 years. But you end up paying MAT, but the MAT rate is reduced at 9%. Then there is some change made to 206(1), clause 1, subclause 2, which is analogous to 115 JB 2D, which amendment I will explain later, because this is in relation to where you have an APA adjustment or a secondary adjustment, advance pricing agreement entered into, or a secondary adjustment, which would mean significant credit to your books in a particular year. They will allow it to spread it to past years to reduce the burden, right? So there are some changes made in respect thereof, but you would better appreciate these changes after I first explain the material change that is otherwise carried out in section 206. So I skip this for a while. I'll come back to this provision of 206(1)(1)(2) a little later. And should I miss this for whatever reason, kindly remind me. I'll have to come back to this provision. Now, one another change before I go to major changes in MAT is that certain foreign companies are eligible to presumptive tax. You may have known 44B, 44BB, shipping company, aircraft, exploration of oil. All these are subject to presumptive tax, 5%, 7.5%, 10%. All these are now put in the form of a table under section 61, subsection 2. There are about 6 line items. When 2025 Act was originally enacted, they spared only 4 items from MAT. Now, to bring in uniformity, they are saying that as long as you're a foreign company coming in any one or more of those 6 line items in table under 61, choosing to go for presumptive tax, you don't come under MAT. So this is one amendment that is carried out. See, earlier, for example, those who were spared from MAT are serial number 1, that is shipping business, 3 is operation of aircraft, 4 is civil construction in a turnkey power project approved by the central government, 5th is a case where you are in the business of providing services or facilities for extraction or production of mineral oil. They have added 2 more items, business of operation of cruise and business of providing services or technology in India for the purpose of setting up electronic manufacturing facility. These 2 are also eligible to go for presumptive tax, but were subject to MAT. Now they are out of MAT. This is one important amendment, possibly to encourage non-residents, to tell them that, look, get into these 2 businesses, you don't have to come under MAT. You can remain with presumptive tax without the fear of MAT. Now, this is an important amendment. Section 206, subsection 1, when it got originally enacted in 2025, it allowed the carry forward and setup of MAT credit, like how we are used to it in 115JAA. So how were we getting MAT credit in the past? In any year, I pay MAT tax. Then I will be eligible for credit. How much of credit? Excess of MAT over normal tax. The delta would be available as a credit, right? What I'll do with the delta? I'll carry forward this delta to subsequent years and set it off in those years where I have reverse delta. What is reverse delta? Excess of normal tax over MAT tax. And I could have done it for how long? 15 years. Similar provision existed in section 206 when it got originally enacted. Now what they're seeking to do is, there are 4 clauses, MNOP. MNOP clauses are now omitted. So as the Act takes birth from 1st of April 2026, you will find a jump of 4 clauses. MNOP don't exist. Meaning, going forward from 1st of April 2026, whatever 14% MAT tax you pay would be sunk cost, because MNOP are not there. This is one important amendment. Then, next would be, what would you do with the MAT credit accumulated up to 31st March of 2026? If you go to section 536, transition provision, subsection 2, clause L, originally enacted, provided that whatever accumulated MAT credit you had under the repealed Act, 1961 Act, would be carried forward to the new regime of 2025 Act, would be allowed subject to compliance with the corresponding provisions of 2025 Act. Now they have removed MNOP. So there are no corresponding provisions for you to comply with. That could create a situation where either you would argue there are no corresponding provisions or conditions are deemed to be complied with, allow me full credit. Our department may say that there are no corresponding provisions, I would not allow it to you. To address this and to provide for a different type of carry forward of accumulated MAT credit, they have inserted section 206 subsection 3. Now what does this section provide? Firstly, subsection 3 of 206, as is proposed to be inserted, is made applicable to a domestic company which has exercised the option under section 200, subsection 5, or 201, subsection 2, for a tax year beginning on or after 1st of April 2026. What does it mean? If you are a domestic company, you had the accumulated credit up to 31st March of 2026. If at all you would want to carry forward and set off any portion of that into the new regime of 2025 Act, you should have opted for section 200 or 201. What are these sections? 200 is similar to 115 BAA where you pay 22% tax, and 201 is 115 BAB, new manufacturing company, you pay a tax at 15%. Look at this, they are nudging you to move into 22% tax, lest you would have to forego the brought forward MAT credit. So if you are a domestic company, you have a huge MAT credit as of 31st March of 2026, you move into new Act, but you don't opt for 200, your MAT credit accumulated would go waste. For you to get the benefit of MAT credit, what the law would require you to do? You have to come under subsection 3, because MNOP are gone, you have to come under subsection 3, and for you to come under subsection 3, you shall be a domestic company who has opted for 200 or 201. So when you opt for 200 or 201, two implications would entail. First, whatever MAT credit that you had in the past would be available to you in the manner provided in subsection 3. 2, because you move to 200 or 201, you don't come under MAT going forward, because companies who are covered by 115 BA and BAB are out of MAT. Likewise, companies who come under 200 or 201 are outside MAT. So this has to be very carefully taken note of. Then, how are they allowing you the MAT credit? Whatever accumulated MAT credit you had, legacy credit under 61 Act, 115 JAA, such credit shall be brought forward to be set off in any tax year to the extent of 25% of tax that is liable to be paid in that year in which you seek to set off. The remaining credit will be carried forward, and carry forward would not be allowed beyond 15 years from the time it is first computed under 115 JAA. Because anyway, question of carry forward of MAT paid under new regime does not arise. Because as I said earlier, new regime 14% dead and gone. So now, unlike earlier, where the delta would be allowed to be carried forward to be set off against the reverse delta, which I explained to you earlier, here there is no such complication. Whatever be the MAT credit, you carry it forward. And how much can you set off? 25% of the current liability. Let us say current liability is 100. Carried forward is 200. How much can you set off? 25 rupees. So balance 175 could be allowed to be carried forward for next 15 years. And needless to say, that's at another condition, that if you are a domestic company or if you are an unlisted company or a private limited company, you have converted yourself to become an LLP in 1961 Act, then whatever MAT credit you had as a company would be gone. There are provisions in 1961 Act, and they have similar provisions here as well. And whatever I have explained now would apply only to the domestic company. Insofar as a foreign company is concerned, whatever the method of MAT carry forward we have had earlier will continue without a change. Meaning earlier we never had the distinction between foreign company and the domestic company insofar as method of carry forward under 115 JAA is concerned. Whatever I explained about the delta to be carried forward, adjusted against reverse delta, that would continue to apply for foreign company. It's only for the domestic company where they will compel you to go to 200 and 201. Of course, a foreign company doesn't have an option of section 200 or 201. The 22%, 15% scope is not applicable to a foreign company. It is available only to a domestic company. So all these restrictions are made applicable only to the domestic company. Insofar as foreign company, suffice it to understand that the position existed in the 1961 Act would continue without change. Likewise, the alternate minimum tax for a non-corporate, the system we have had earlier in the 1961 Act would continue without change. So it's only for the domestic company we have this issue. Now, you will have to take a decision as to whether in the new regime, do you have to take section 200 or you will have to not move to section 200. It depends on whether you are eligible for any tax holiday, if so, to what extent. Let us say you are a startup, you are eligible for full tax holiday, or you are a unit in an IFSC where you are eligible for 80 LEA benefit, or you are an offshore banking unit eligible for 80 LEA benefit. And in the new regime, you will continue to get the benefit under newly recast section 147, you get the tax holiday for 20 years if you are a OBU, overseas banking unit, or if you are a unit in an IFSC, you get it 20 out of 25 years. So you are in a tax holiday regime. Arithmetically, to be simple, let us assume you don't have any other income. All your income is subject to tax holiday, and you have good amount of MAT credit. So what will you do? If you move to the new regime, and you don't go for section 200, then what will you do? You will get as a startup complete tax holiday, but end up paying MAT at 14%. So that's your cost. Instead, you move to the new regime of 22% under section 200, whereby you end up paying tax at 22%, and we had the MAT credit, and you can knock off 25% of 22%, which comes to about 4.5%, which effectively is about 17.5%. Now we compare 14% tax with 17.5% tax. So you may be better off continuing without having to move to section 200, because all of your profits are tax free, you come under MAT, you pay tax at 14%. Because if you move to 200, you would have lost the tax holiday benefit, you end up paying tax at 22%, maximum you can set off is only 25%, which will effectively come to about 17.5%. So you have to compare 14% and 17.5%, and you may be better off staying here. It depends on what kind of tax holiday and otherwise what is the MAT rate that you are liable to. Like for example, if you are a company eligible for 147 relief, where you get 100% tax holiday for 20 years, and MAT for that IFS unit is only 9%. Now you decide what you have to do. So you come to the new regime, In the new regime, even you are not liable to pay MAT. If you go to 200, and if you are in 200, you can continue to get the benefit of section 147. You will continue to get the benefit of section 147. So therefore, it would not create you any problem moving into new regime, adopting section 200, get the benefit of section 147, because unlike other deductions, 147 deduction is not withdrawn when you go to section 200. So lot of these things would have to be kept in mind by you before you decide whether you should go for section 200 or not. Sometimes what you may do is, you may stay in the normal tax for a while, as you accumulate, preserve your accumulated MAT credit, and after a few years, you decide whether you will have to move to section 200 and use the accumulated MAT credit going forward. Possibly when the tax holiday ends, it may make sense for you to go and take section 200 and pay tax at 22, and hoping that you would still have had portion of 15 years left, and MAT credit being available to you, then knock off 25% of your tax by way of set off of the MAT credit. Now, let us take a case where you are a domestic company, you had MAT credit, but for some reason, in 1961 Act itself, we went in for 115 BAA. Are you able to get me this? For 1 or 2 years, you would have been in 115 BAA. So you would have lost your MAT credit. Now, you move to 2025 Act. If you go to section 2063, it says it would apply to a person or a domestic company who would go for option of section 200 for the tax year commencing on 1/4/26 onwards. On the basis of this language, the CBDT in FAQ has said that those who had opted to go for 115 BAA or BAB had already taken a call and had assumed that the MAT credit had become their cost. We would not extend the benefit to them. See, it's like early mover, rather than getting discount, will have to be paying a penalty. Are you able to get me this? Hope you understood what I'm trying to explain. So this understanding of the board is incorrect. you can contest the understanding of the board through the FAQ is incorrect, because if we go to section 536, transition provision, go to subsection 2, look at clause F. What it says is, any election declaration made or option exercised by an assessee under any provision of the repealed Income Tax Act and in force immediately before the commencement of this act shall be deemed to be an election or declaration made or an option exercised under the corresponding provisions of this act. Meaning, whatever you had exercised an option under 115 BAA shall now be deemed to be an option exercised under 2063. And obviously, when it is deemed to be an option exercised under 2063, it applies to which year? Tax year 2006-07 onwards. On the first principle itself, you would qualify. So therefore, our view is that those domestic companies who had for some reason moved to 115 BAA, 115 BAB, and had given up their MAT credit, when they moved to 2025 Act, they are still covered by 2063 because of section 536(2)(f), which will deem that whatever option you had exercised under 115 BAA shall be deemed to be an option exercised under 200 subsection 5. So therefore, the effective given by the board is completely erroneous. You shall be eligible for the benefit of this. Now let me come back to what I had skipped earlier. See, if you are a company in the new regime, we are talking about new regime, you have two options: stay with regular tax and subject yourself to MAT, or move to section 200, that is 22% tax, and you don't have MAT. So now take the case of a company which is in 200, section 200, going forward. Anyway, it is not liable to pay MAT. Let us say there is an APA entered into or a secondary adjustment happening. As a result of which, huge amount stands credited to your book profit. Are you able to get me? Because APA will have applicability for the rollback as well, last 4 years or whatever. So income will have to be restated. Restated income would result in a big lump sum being credited in your books, which will mean significant hike in your book profit. But you don't have to worry about MAT because you have taken section 200 and you don't have MAT. Now, this is one example where this APA would not really trouble us, or secondary adjustment would not trouble us. Take a case where you are a domestic company, you move into 2025 Act, and you don't go for section 200. You stay in the regular tax regime of 30%, 25% or whatever. And there is an APA happening or a secondary adjustment happening. If an APA or a secondary adjustment is happening to you in the 2025 Act where you are liable to MAT and a huge amount stands credited to your book, as a result whereof your book profit swells, right? Then section 206 will give you an ability to spread this credit to your books to the past related years, like 89(1) kind of a relief. You are allowed to have it spread. If you are allowed to have it spread, it will taper over a period of longer period, and therefore you may not end up paying significant MAT, or you may not end up paying any MAT in those past years. And the current lump credit which comes to you also would save you from tax. Correct? Now, what they have done is they have made a cosmetic change here and a consequential amendment here. Because going forward there is no MAT credit. MAT credit is available only when you move to new regime. That anyway is not applicable to, because you are not gone in for new regime. For you to have this benefit of spreading the credit to the past related years, there is a condition. The condition is, for any tax year 25, 26 and earlier years, you ought not to have utilized any MAT credit. You ought not to have utilized any MAT credit. Meaning, whatever 115-day AA credit you have had, you ought not have utilized it. Then only you are allowed the benefit of spreading this lump sum credit that happens in the current year to the past years and save burden of extraordinary MAT tax that may arise to you in the current year. So this is the amendment that is carried out here. Rest of the amendments made in section 206 are cosmetic changes. That's about the changes that are carried out in MAT. There are some changes made in section 536(2)L. These changes are consequential to what I've explained. Should we stop now or I'll go on for some time? Before we break for lunch, another 10 minutes, we would try to deal with some provisions. One that would relate to IFSC, I would not deal with it because it may, though important, may not really matter to the crowd here. So if time permits, we will go to the taxation of IFSC and how section 147 will come into play, how section 218 will apply. So it's an interplay of like 147, it will give you tax holiday, and once the tax holiday ends, you continue to pay tax at a much lower rate of 15%. All this we would discuss only if the time permits in the end, because it's our presumption that not many may be dealing with the cases of IFSC here. Likewise, there's an amendment to the meaning of dividend in section 2(40), where for group entity treasury operations that will take place in the IFSC, incidentally there could be borrowals and it will have the trapping of dividend under section 2(40). They would want to spare the group entities which are engaged in treasury operations of the global conglomerate, but treasury operations are carried out in an IFSC in India. Typically it would have attracted deemed dividend, so they made some corresponding changes there to just fine-tune the kind of exemption you get from being treated as dividend. So that also we will not discuss right now, except that we have made a very brief mention of it. We will now move to some other provisions before we break for lunch. So all this is about IFSC, like big chart we made, but don't bother about it right now. Now we'll go to section 144C amendment, DRP. You will have amendments made to overcome the decision of Madras High Court in Roka Bathroom, Bombay High Court in Hexaware and shelf drilling, and the split decision we have received from the Apex Court, wherein the courts held that the internal time limits of 144C DRP, you had one time limit under subsection 4, where you chose not to go to DRP in the case of a draft order, or where you chose to go to DRP, another time limit under 144C13. The courts held that these internal time limits of 144C subsume into the overarching time limit of section 153. Though it's a decision that favors the taxpayer, it's a little perplexing as to how one could have given such a decision, for the reason that 144C4 and 144C13, of course with utmost respect to the respective courts, very clearly state that notwithstanding anything contained in section 153 and 153 capital B, by no legal reasoning it could have been ignored. But nonetheless, the assessee has been able to get a favorable decision, and now they would want to reverse the decision by making amendments to section 144C as well as the corresponding provision section 275 of the 2025 Act. We will just try to deal with that very quickly. There are some amendments to section 266 which will deal with 140 capital A. They are consequential to amendment to MAT. So the references to MAT provisions have been amended to be in line with how we have just now understood the MAT will be dealt with going forward. So there are only consequential changes. Section 270 subsection 1 capital A clause 6 corresponds to 143(1) adjustment, where they could have denied you the benefit under chapter 6C if return is furnished beyond the due date. So it's an interplay of 80 AC. Now there was a reference to section 144 earlier. That reference is removed because it's already covered by chapter 8C. So it's like surplusage, which I explained earlier. Now let's go to this amendment. See, in 144C, subsection 4 gave a time to the assessing officer to pass the final assessment order, where the assessee chooses not to go for DRP within 1 month from the end of the month in which the assessee conveys that he is okay with the draft order or he does not do anything. And as I said earlier, this subsection overrode section 153. Now, because the courts have held that this is an overarching time limit, they have brought in two subsections, 4A and 4B. See, they are paranoid about court further striking it down. So that's why they did not want to bring one subsection to deal with both case of regular time limit of 153 as well as the search assessment time limit under 153B. So they are very scared now. So that is why what they did is they brought in two subsections. Subsection 4A is brought in to address the case of time limit of 153, and subsection 4B is brought in to address the case of time limit of 153B. They have been brought from two different retrospective dates. Very strangely, 153 has been brought in, the 144C 4A has been brought in with effect from 1/4/2009, whereas 144C 4B has been brought in with effect from 1/10/2009. You may ask me why. Because 153B was inserted into 144C within brackets 4 from 1/10/2009. That is why they are seeking to bring in subsection 4B with effect from 1/10/2009. Anyway, it would not really matter to us, except that in our office somebody asked why are two dates taken. Then I spent some time not to answer him, but should a question arise now, I should be able to answer. So then we figured out that 153B was inserted into 144C 4 and 13 with effect from 1/10/2009. That is why they would have inserted these sections from these dates. Now, look at this 4A. What is that they are trying to say? Notwithstanding anything contained in any judgment, order or decree of any court or section 153, for the removal of doubts, it is hereby clarified for the purposes of subsection 4 that where a draft of the proposed order of assessment under subsection 1 is forwarded within the time period allowed under section 153, further time period available to AO to complete the assessment under subsection 3 shall be governed and shall be deemed to have been governed by the provisions of subsection 4. What is that new thing they are trying to say? This was stated in subsection 4 already, notwithstanding anything contained in section 153. They are restating the same thing by merely stating notwithstanding anything contained in any judgment, court or decree. See, you have to be aware that in state of Tamil Nadu versus state of Kerala, the constitution bench has held that you can't bring in an amendment to law to negate the decision of the court. Parliament is not empowered to bring in an amendment to negate the decision of the court. You can do it indirectly. How do you do it? By removing the basis upon which the court would have rendered the decision. Remove that statutory base. After all, what court will do? Court will interpret the law on the basis of law, how it existed. So, you have the plenary power to retrospectively remove that basis, whereby the judgment would then become invalid. But you can't negate the judgment. So, they should have amended this properly. What they should have stated is that the time limit available under subsection 4 shall be this, irrespective of anything contained in section 153. So, they should have structured it properly. Rather, what they have done is they virtually restated what is there in 144C4, just that they are trying to negate the decision of the court. So, therefore, again, there are assessees, there are counsels for the assessee who have paid for it to challenge this. And we will have a challenge, some court would agree, and after a few years there are going to be amendments, again retrospectively with 2 different dates. So, similar amendment is carried out in subsection, by insertion of subsection 4b. This is in the case of a search assessment where 153b is the time limit, so that seeking to amend that. Likewise, you will have another internal time limit, that is 144C13. Assessing officer, upon receipt of the DRP directions under subsection 5, will have to pass the final order without hearing the assessee, within a month from the end of the month in which the assessing officer receives the directions of the DRP, or DRP directions are issued. So, DRP itself has an internal time limit to issue the directions. That is 9 months from the end of the month in which the draft order is forwarded. So, that is the internal time limit under 144C12. Now, there is another time limit for the AO, that is a month from the end of the month in which the DRP directions are received. So, now they are seeking to now amend that by bringing in 13A and 13B on the same lines as 4A and 4B. Same thing, same mistakes continue to occur here. So, they would want to ensure that the time limit of 13A and 13B read with 13 is paramount and would apply notwithstanding anything contained in section 153 or 153B, as the case may be. Now, one positive development of this is that as they seek to amend and by bringing in new subsections, see, earlier there was no law which strictly stated that the draft order should be passed within the time limit of 153(1). Look at 144C1. Where there is a variation in the case of an eligible assessee, what the AO has to do? He has to pass a draft order. Section 153 time limit never dealt with the case of a draft order. It dealt with a proper order. Draft order is not an assessment order. So, people were arguing that there is no time limit for issue of the draft order. And it is only after the draft order is issued, the further time limit of 144C would kick in. That would mean it could have been done after 10 years, 15 years, 20 years. Fortunately, better sense prevailed in the council who argued in Roka Bathroom's case from the revenue, where revenue itself conceded in the course of its argument that so far as draft order is concerned, it has to be made on or before the due date for completing the assessment under section 153. Now, that has been sanctified now, point number 1, because 144C, 4A, 4B, as well as 13A, 13B would say that whatever we are trying to override would apply only if the draft order is forwarded within the time limit of section 153. Are you able to understand? So statutorily now they have brought in that the draft order under section 144C1 should not only be made but also to be forwarded on or before the time limit set in section 153. Now go to the decision of CIT versus Mohammad Mir and Shahul Hamid's case, 438 ITR 288. Supreme Court, without referring to precedent case laws, in the context of 263, held that word made should not be understood as issued, because 263 there is a time limit for commissioner to revise. That is 2 years from the end of the financial year in which the order sought to be revised has been passed. Supreme Court understood the word made as just making, not it losing my control. See, contrary to all the precedent case laws, when an order is said to be made, what the precedent case law suggests is, order is not made just because I make, I sign, I keep it in my drawer and hold it during my pleasure. The order is considered made when it loses my control. That is when the order is said to be made. But somehow, for some reasons, in Mohammad Miran's case, the Honorable Supreme Court did not refer to any of these past decisions and simply held made should not be understood as issued. It was a case where issue took place later, beyond the due date. Now, we can use the statutory amendments which have inserted 4A, 4B, 13A, 13B to understand that order is not only to be considered as made, but also to be considered as forwarded. So that is a positive development. So you'll have to keep this in mind, these amendments, whenever department would argue in a given case of limitation by relying on Mohammad Miran's case. Whatever amendments were discussed in the context of 144C, similar amendments have been carried out in section 275 of 2025 Act, which is analogous to 144C, except that fortunately they don't have to override the decisions of the court which may come later on. Otherwise, no wonder our ministry is capable of even, like making some clarificatory amendment to preempt any court from holding so later on. So fortunately, because Act is yet to be enacted or be implemented, we do not have to have the law to say, notwithstanding anything contained in any judgment. Now I think we will meet post lunch, because we'll have to now go to phaseless versus jurisdictional assessing officer in the context of reassessment, and some changes which are carried out to section 153 time limit. There are very important changes that are carried out to 153 as well as the corresponding 2025 Act, which we'll discuss post lunch. Before lunch, we discussed certain provisions relating to 144C and section 275. Continuing with the same, there is another provision which we missed out in the morning, is amendment to 92CA. You are aware that under 92 CA, subsection 3 capital A, the TPO is expected to pass his TP order 60 days prior to the date for completion of assessment under 153. So in computing this 60 days, department miserably made lot of avoidable errors. They did not understand the language 60 days prior to the date. So if 31st December is the expiry date, prior to 31st December would not include 31st December. It only started counting backward from 30th of December. So several of the TPO's orders came to be quashed by the courts on the premise that it did not give clear 60 days gap between the last date for passing the assessment order. Because TPO's orders were quashed, consequently, the variations did not apply. Because variations did not apply, assessee no more became the eligible assessee. So the department, on the basis of all this, would have passed the draft orders, time bar. So these resulted in several of assessments being quashed basically on the jurisdiction of time limit. And these decisions have started coming not yesterday or day before yesterday. These decisions have started coming good 4 or 5 years back. Nonetheless, it took 5 good years for the revenue to bring out an amendment to negate the decision of the courts which have dealt with the computation of 60 days. How are they seeking to negate it? They seek to bring a new subsection to 92 CA. Look at how this subsection is worded. Notwithstanding anything contained in any judgment, order, or decree of any court, for the purpose of making order under subsection 3, the calculation of 60 days shall be made and shall be deemed to have been made in the following manner, namely, they are saying, for the purpose of making order under 92 CA3. What is 92 CA3? 92 CA3 is the ability of the transproposing officer to pass the order in terms of 92 C3. Notwithstanding anything contained in any judgment whatsoever, they say, for the purpose of making order under 92 CA3, the calculation of 60 days shall be deemed to have been made in the following manner, namely, they say, where the period of limitation expires on 31st March of any year, not being a leap year, the order under subsection 3 may be made up to 30th of January of that year. Where the period of limitation expires on 31st March, being a leap year, the order under subsection 3 may be made up to 31st of January of that year. Then they say where the period of limitation expires on 31st December of any year, the order under subsection 3 may be made up to 1st November of that year. So by this subsection, they are themselves giving a calculation of what is 60 days. By stating, if it were a leap year, then it has to be done of 31st of January. If it is not a leap year, by 30th of January, where the limitation would end on 31st of March of any year. They think they can overcome the decision of various courts. But what they miserably fail to understand is, the courts, when they gave the decision, they did not see subsection 3. Subsection 3 of 92 CA did not consist of any limitation. Where is limitation contained in 92 CA 3A? So what they should have done, they should have referred to 92 CA 3A. Look at the amendment. For the purpose of making order under subsection 3, the calculation of 60 days shall be made. They should have said for the purposes of computing limitation under section 92 CA 3A, which means the basis of decisions of the court not being 92 CA 3 but being 92 CA 3A remains intact. The basis is not removed. As the basis is not removed, the starting part of this subsection to say notwithstanding anything contained would go waste. So this is a simple arithmetic which any person in the business of drafting law should understand. Anyone who has gone through any of these decisions would have understood that courts are interpreting 92 CA 3A, not 92 CA 3. So when the framers of law missed this elementary understanding of law and the basis of law upon which the decision is rendered, mistakes like this are bound to take place. So therefore, the basis of decision not being removed, subsection 3A still remaining in the statute book, courts having interpreted subsection 3A, all the old decisions cannot be negated. So this is a serious flaw in the way they have gone about amending 92 CA, bringing 3AA. And interestingly, if you look at one more flaw in 92 CA 3AA is that, look at this. They are saying for the purpose of computing 60 days limit, they are giving a formula where the limitation would expire on 31st March or where the limitation would expire on 31st December. There are many cases where limitation would expire on certain other dates. For example, if it is a case of 153 subsection 6, where there is a finding or direction contained in an order of court, then the assessment or reassessment will have to be completed within 12 months from the end of the month in which the order of the court is received. So court is not bound to give this decision in a manner where 12 months from the end of month would lapse on 31st December or 31st March. In those cases where the limitation would not necessarily fall on 31st of March or 31st of December, this amendment will fail to operate. Take another case where there could be some stay, there could be some information sought in terms of treaty under 90 or 90 capital A, there could be a search and there could be a time interregnum between the search authorized party giving the seized documents to assessing officer of your jurisdiction. In all these cases, as you are aware, explanation to section 153 would extend the time limit, So whenever the time limit would get so extended, it would not lapse necessarily on 31st March or 31st of December, in which case the subsection which is sought to be brought in would fail to operate and therefore it will be ineffective. This is another aspect that has to be noted in terms of 92 CA 3AA amendment. Now the other question is, now that they have said notwithstanding anything contained, is it permissible for the department to file a miscellaneous petition, rectification petition, either before the tribunal or before the High Court? Now, what is important here is that this particular amendment, though retrospective, when you go back to the court, what are you going to tell the court? You are going to tell the court that, look, 3AA has been brought in. The court would say, I have not decided on the basis of 3AA, I have decided on the basis of 3A. Show me what has happened to 3A. Then you will have to show 3A as it existed. That remains unchanged. Then the court would say there is absolutely no mistake apparent from the record in the judgment, and therefore it's not a fit case for rectification. As you're aware, rectification and review are different. Review is where you recall your decision and redo it. There is a case of deciding on the same set of facts, possibly coming to a different decision altogether. But here is a case where either under 254(2) or under 154, they are having something called rectification, which has to be a mistake apparent from record and nothing else. So therefore, suo motu rectification is not permissible, and we have a lot of decisions in this regard. Subsequent superior court's decision cannot be a ground for correction of the order. You have the decision of Supreme Court in Sela Solutions case in the specific context of 254(2). The Bega Foundation versus Justice Puttaswamy's case also, wherein they have said that subsequent change of law is not a fit case for the review of the decision already taken by the coordinate bench or the superior court. And in the particular context of Checkmate's decision of 3615A, employees' contribution, the decision of Bombay High Court in Vaibhav Maruti Dombale's case has held that because Checkmate decision has come, it is not permissible for the tribunal to recall its decision and change its decision on the basis of the Supreme Court decision that comes subsequently. So it's not possible for them to be carrying out any of these corrections. In section 166, which corresponds to 92 CA, similar amendment has been brought in terms of, so look at the language original enacted 2025 Act on the left hand side. It is similar to 92 CA 3A, whereas what they are now proposing to do is on the right hand side through this finance bill of 2026, they say where a reference was made under subsection 1. You have to read this carefully because we'll have some very interesting development later on when we go to the amendment to section 286, which corresponds to section 153. Where a reference was made under subsection 1, an order under subsection 6 may be made at any time before 1 month prior to the month in which the period of limitation referred to in section 286 or 296 for making the order of assessment or reassessment or recomputation or fresh assessment expires, and accordingly where such period expires, 31st March of any year, the order under subsection 6 shall be made on or before 31st of January. Where it expires on 31st of December, the order under subsection 6 may be made on or before 31st of October of that year. Look at the difference in the language here, and you could notice that it is better worded in as much as they don't use 60 days. They just say that may be made at any time before 1 month prior to the month in which the period of limitation would expire. So they are not gone about computation of 60 days. 1 month prior to the month in which the limitation would expire. They should have stopped there. They should have stopped there, but they go on to say, accordingly where such period expires on, they are trying to give an example. So 31st March, 1 month prior to that month means exclude 31st March, that month where the limitation falls. 1 month prior to that also would exclude, that means February would exclude. We'll have to do it by 31st January. Anybody else would have understood the same way. I'll tell you the problem that is created by adding these extra words. Now look at next one, 31st December, where the period expires on 31st December. In our own computation, it has to be done 1 month prior to the month of expiry. How would we have understood? We would have excluded November and December. We would have done it on or before 31st of October. Now they are trying to explain this. You may ask me a question, why not leap year here? Because in 92 CA 3AA they have done the leap year. They have not had the word of leap year. For the reason that here there is no reference to number of days. Here there is a reference to 1 month prior to the month. That is why rightly they are not referred to the leap year. Then a question that would arise here is, they say, and accordingly where such period expires. So as I have said earlier, if they have stopped before getting into illustration, that would have dealt with all the cases. Now take a case where, like I gave you some examples of the orders being set aside by the High Court. If the High Court sets aside the order on the basis that principle of natural justice is not followed, then it would not be a case coming under 153.3, it would be a case coming under 153.6. In such case, as I have said earlier, 12 months from the end of the month or 9 months from the end of the month, so it would not lapse on the specific 31st March or 31st December. Now, if you recall me, when I explained you 92 CA 3AA, I had told you that the provision would fail if it would lapse on any other date. Now, whether similar understanding can be applied here or not is to be examined. There they are very clearly stated where 60 days, for computation of 60 days, it has to be done this way. Now, where the date would expire on a day other than 31st March or 31st December, if this provision would not apply? Can you argue? Can the department argue? Oh, there is no time limitation, and when there is no limitation of time, that would apply to orders which would lapse on a date other than 31st March or 31st December, then it has to be done within the reasonable time. See, the courts have held, if time limitation would not apply, then it has to be done within the reasonable time. In which case, you may escape the time limit itself, thereby it will help the department to sustain the orders which are otherwise passed beyond the limitation. So therefore, the argument what you are taken for 92 CA 3AA may not really help you in the context of 166 subsection 7, even if the cases that would not fit into where the due date would expire on 31st March or 31st December could still be sustained within the main body of the section as long as it is made 1 month prior to the month in which the due date would expire. Take an example. Let us say because of court remitting it, and 12 months from the end of the month, let us say it would expire on 30th of June of 2027. That would not fit into example what is following here. So 30th of June of 2027 is otherwise workable within the main body. 1 month prior to the month in which it would expire. So 30th June it would expire, exclude 30th June. A month prior to that is May, exclude that. So by 30th of April, the order could be passed. So if the order is passed on or before 30th of April, then it would be within time. If the order is passed after 30th of April, then the order would be backed by limitation. So this is how it has to be interpreted when it comes to 166 subsection 7. Now we'll go to the amendment to 1961 Act by inserting 147A. This is another case where Parliament will bring some provision. To implement it, the department would bring a scheme. Its officials would neither follow law nor their own scheme, follow it by breach of it, suffer adverse court orders, keep suffering for a few years, then after a few years get up and make an amendment. See, who invited them to bring in 151A? Nobody told them to bring in section 151A. So Parliament brought in 151A, stating that the procedure of reassessment, which would include hearing you on 148A, as well as issue of notice under 148, shall be made phaseless. Okay, Parliament brought it. Department may have found it difficult to implement. What it could have at least done is not have brought in the scheme. It need not have brought in the scheme. If the scheme is not brought in, section will die on its own. Because unless the scheme is made part of Act, like 144B, phaseless, it is ingrained in the Act itself. It's an integral part of the statute. Here is not so. Section says the central government may notify such scheme as it thinks fit to bring in transparency, accountability, etc. So to bring in transparency and accountability, section was brought in. Then they introduced a scheme on 29th of March of 2022. They bring in a scheme. The scheme also very clearly says, in all the cases of RMS, risk management strategy, as is specified in explanation to section 148, the case of proceeding under 148A and the issue of notice under 148 shall be phaseless. So they brought in the scheme and never ever followed, and the jurisdictional assessing officer kept issuing notices, hearing the assessees, and assessees would participate, and eventually notices are issued by the jurisdictional assessing officer, and thereafter, the phaseless would pick it and start doing it under phaseless in terms of 144B. Assessees challenged it across the country. Assessees challenged it. So Telangana High Court, Karnataka High Court, Madras High Court, Punjab and Haryana High Court, Calcutta High Court all held that the jurisdictional assessing officer has absolutely no jurisdiction. The Gujarat High Court and the Delhi High Courts have held that there is a concurrent jurisdiction, parallel jurisdiction available to both phaseless as well as jurisdictional, and upheld the action of the jurisdictional assessing officer. Two big batches are pending before the Supreme Court. Now, one batch has been now sent back to the High Court after this, proposed amendment is introduced. The other batch is going to come on 17th of February. So this is where it stands now, and they bring an amendment here to say that, look at what the amendment they're trying to bring. The following shall be inserted and shall be deemed to have been inserted with effect from 1st of April 2021. Notwithstanding anything contained in any judgment, order or decree of any court, or in section 151A or in any scheme thereunder. See, we have called Vodafone amendment, the great 2012 amendment itself as so bad, right? We thought that is the ultimate to undo the decision of court, which is hard-earned by the taxpayer, that we thought is the ultimate, because assessee was, made to spend time and energy, eventually win a case in the Supreme Court, and then you bring out an amendment, 2012 amendment. Now, these amendments of 2026 Finance Bill look more dangerous than the Vodafone amendments in terms of its language, in terms of its effect. So it says, notwithstanding anything contained in a judgment, etc., or in section 151 capital A, who has brought that section? Or any scheme framed thereunder, for the removal of doubts, it is hereby declared that the assessing officer for the purpose of 148 and 148A shall mean and shall be deemed to have always meant to be the assessing officer other than NFAC or assessment unit referred to in 144B3, meaning for the purpose of 148 and 148A, the phaseless unit, assessment unit or the National Phaseless Assessment Center shall not be the assessing officer. This is the amendment they have made. It would override the decisions, it would override section 151A, it would also override any scheme thereunder. This is an unfortunate amendment, but then we are all, left to wonder. They wanted to bring in transparency and accountability through 151A. Is it that they don't want it anymore? Look at this, notwithstanding scheme, notwithstanding section 151 capital A. Now, apart from this, you'll have to also appreciate that there is one section called section 130, which is phaseless conferment of jurisdiction. It would deal with conferment of jurisdiction under section 120, 124, transfer of case under 127. All these are to be done phaseless. So there was a seamless exercise of phaseless conferment of jurisdiction, phaseless proceeding under 151 capital A, phaseless collection of information under 135A, and phaseless assessment or reassessment under 144B. All were to go in tandem, all were to follow in an integrated manner, whereby the so-called transparency, accountability, and division of work, optimum use of available resources, all could have been achieved. Now, in this wonderful scheme of things, they're removing one portion off and disturbing the flow. So that is by way of bringing in 147A. Now, likewise, they have also sought to amend section 279, which corresponds to 148 and 8A. This they seek to amend by bringing in subsection 3. Now, what do they say in subsection 3? They say assessing officer for the purposes of section 280 and 281 shall mean to be an assessing officer other than National Phaseless Assessment Center or any assessment unit referred to in 273.3. As I said earlier, here they cannot say that notwithstanding any future judgment. So they have said that the assessing officer for the purpose of 280 and 281 shall mean to be AO other than NFAC or the assessment unit. But there is one catch here. What is the catch here? Look at this. When you look at 2025 Act, there is no provision similar to 151 capital A. There is no provision similar to 151 capital A, which wanted all these proceedings to be phaseless. There is no such provision in 2025 Act. However, there is one section called 532, which says central government may make any scheme. It's an omnibus section, 532. For the purpose of implementation of this Act, central government may make any scheme which will provide for doing such act in a phaseless manner. Then there is a repeal provision, and exception to repeal is found in 536 within brackets 2 within brackets U. What it says is, wherever the central government in the 1961 Act brought out any phaseless scheme, please hear me carefully, this 536(2)(u) says, in the 1961 Act, if the government of India brought any scheme, phaseless scheme, such phaseless scheme so brought in shall continue to apply in the 2025 Act under the corresponding provisions, and if there is no corresponding provision, it shall be deemed to have been made under 532. Look at this. Now, there is a section called 151A, and they brought a scheme on 29/3 of 2022 on the basis of 151A. Now move to 2025 Act. Is there a provision analogous to 151A? No, there is no provision. But then 536(2)(u) says, wherever the scheme was made under the 1961 Act, if in the 2025 Act there is no analogous provision, it shall be deemed to have been made under 532. That means, though 151A is not there, the scheme that is brought in under 1961 Act of 151A shall continue to survive in the 2025 Act under section 532. And now, go back to the subsection 3, it does not override the scheme. Look at 279(3). Unlike 147A, which overrode 151A and any scheme made thereunder, in 279(3), there is nothing which will say irrespective of anything contained in any scheme. So scheme also exists, and 279(3) would also exist. So how are we going to, you will have a benevolent court tomorrow saying that, see, it's your own scheme. It's your own scheme. How could you have not followed your own scheme? In fact, the decision of the Supreme Court, the Constitutional Bench, in Sukhdev Singh's case, where the Supreme Court said to the government, see, you are the one who has brought the sword of procedure. The very same sword of procedure, if not used properly, will perish you. So who's brought this scheme? You have brought the scheme. Who's brought 532? You have brought 532. Who's brought in the repeal saving provision 536(2)(u)? You have brought it. So in terms of it, this scheme is now, scheme still kicks and it continues to kick in terms of section 532. And who has brought 279(3)? You have brought. Do you have anything in 279(3) to override the scheme? No. So follow the scheme. Even as they carry out the corrective amendments, they don't take care. This is a testimony of the carelessness or the carelessness with which the acts are amended. So that's about this. Now we'll move on to time limit to pass the draft assessment order. And see, these are the amendments which are carried out. Like, again, to give effect to draft assessment orders, for which earlier, as I've said, there was no time limit. So they have amended 153(10). But very interestingly, look at how they make the amendment. We just have some fun in the afternoon, because post-lunch would be difficult to, keep hearing. Look at this. They have brought in 153(10). It shall be inserted and shall be deemed to have been inserted. Right? Now, what it says, notwithstanding anything contained in any judgment, blah, 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 then it says, the draft of the proposed order of assessment shall be made and shall always be deemed to have been made at any time up to the time limit of assessment, reassessment, or recomputation referred to in said subsections. What they should have said, the time limit shall be the time limit for passing, the draft order shall be the time limit for passing the order under order of assessment and reassessment is what they should have said. Now they are saying it shall be made and shall be always deemed to have been made. So even if tomorrow they pass an order, whenever the order is passed, it shall be deemed to have been made at any time up to the time of assessment or reassessment. So therefore, see, you have 25, 26 previous year, for which assessment year is 26, 27. In terms of 536(2)(c), the 1961 provision will continue to apply for all these years. So now there is this time limit of 153 would continue to apply for assessment year 26, 27 and backwards. So whenever they do, even if they do it much later, according to law, it shall be deemed to have always been made before the due date. So they would not even know how to carry out a retrospective amendment. Likewise, they have carried out an amendment to 153(b)(1)(a) as well, same thing. Now we'll go to, this is an important amendment, to 286. So we are getting some benefit thanks to their error. What is the benefit we get? 286 corresponds to 153. Now look at section 153. Mr. Padam explained in the morning, 153(1), 1A, 2, 3. You have multiple subsections. For regular assessment, 153(1). Then you have 1A for updated, 1B where the time limit is extended by the board, 153(2) is for the reassessment, 153(3) where the order is set aside and a fresh assessment will have to be made, right? Then you have 153(4). What 153(4) said? Subsections 1 to 3, for the purpose of limitation of subsections 1 to 3, if there is a reference to the transfer officer, then the additional time limit of 12 months would be available, correct? So whether it is a case of 153(1), or case of 153(2) reassessment, or a case under 153(3) where an order is set aside, either by the commissioner under 263 or by the tribunal under 254, then after set aside, if it requires a TP adjustment, you are aware that the courts have held that even a set aside case, it has to be a case of reference to TPO to be followed by the draft order, correct? So 153(4) clearly provided that all these cases, the time limit will stand extended by 12 months, correct? Is that clear? That is how it stands. Now, if you would look at 286(2) originally enacted, 286 subsection 2, which corresponds to 153(4) as originally enacted, that was also very clearly stating that time limit for completion of assessment or reassessment as provided in subsection. So in the subsection, all the cases for assessment or reassessment, wherever time limit is provided, that shall stand extended by 12 months if the reference is made to TPO. So it's in sync with 153(4). Now, they want to substitute it now, 286(2). What they're trying to say is, somebody told them, hey, if you are referring to 286(1), not all cases listed there are the cases of making assessments, reassessments. There are some cases like order giving effect to OGE, etc., like 153(5), etc. Therefore, subsection 2 could not have made reference to whole of subsection 1. It ought to have made references only to that part of subsection 1 which dealt with the time limit for completing assessment and reassessment, not time limit for completing order giving effect to OGE. Rightly suggested. Rightly suggested. So what they should have done? They should have taken proper care. Instead, what they did is, look at this, time limit for completion of any assessment or reassessment as provided in subsection 1. Then they introduced table serial number 1 to 4. Table serial number 1 to 4. In a case where the reference is made to the TPO, additional 12 months would be available to you. That is in clause A. Likewise, in clause B, they have stated that in respect of those 4 items, the draft of the proposed order of assessment shall be made at any time up to the time limit for making the assessment under the Z subsection. 2 things they have stated. One, wherever the reference is made to TPO, you will get additional time of how much? 12 months. Not in all the cases covered in subsection 1. Here lies the catch, but only in respect of item number 1 to 4. Likewise, the limitation for passing the draft order is also in respect of item number 1 to 4. Now, the difficulty here arises because item number 5 in the table corresponds to 153.3. What is 153.3? Set aside case. You go to tribunal would say, I will set aside the order, quash the assessment order, redo. It's a set aside case. Likewise, 263, commissioner, he will set it aside on the basis that there is no application of mind, assessing has not applied his mind. So these set aside cases, which were covered under 153.3, now are covered under serial number 5. Now, courts have held that even if it is set aside, if there is a TP variation, who has to do it? TPO. Reference has to be made. Then you would become an eligible assessee. When you are an eligible assessee, under section 275, what order has to be passed? Only draft order has to be passed. But the time limit of 12 months is not extended. So you won't now get an additional 12 months time in the case of set aside order. They have not realized the kind of mistake that is being committed here. 1. 2, there is another aspect here. If you would see this clause B, they are saying the time limit to pass the draft order in respect of items covered under 1 to 4 alone is the time limit for passing the normal assessment order, right? Now, in a set aside case, what will happen? 2 implications would arise because of this. 1, will the department get additional 12 months time? Answer is no, because it is not contained in serial number 1 to 4. It is contained in serial number 5. So you don't get 12 months time, number 1. Number 2, department has to anyway pass the draft order in terms of section 275. They don't have a choice. That's the mandate. So it will have to pass a draft order. When it passes the draft order, then 275 will kick in, correct? 275, that means 144C kind of a provision will kick in. Then you go to 275 subsection 14 clause B, which is analogous to 144C, 13A and 13B which they have brought in now, to say that the time limit of this section is paramount, it is further time, correct? Where they have stated that would apply only where the draft order is forwarded within the time prescribed under 286(2)(b). Now, if you go to 286(2)(b), there is no time limit prescribed for passing the draft order in the case of set-aside matter. Are you able to get me what I am trying to say? So, in all the set-aside cases, apart from department losing 12 months time, they are giving up on platter. They are giving up on platter what they are trying to recover through other provisions like 144C, 4A, 4B, 13A, 13B. So they will not, it's the perfect case of legalizing loka bathroom case. Then internal time limits of 275 will continue to apply to it. So unless and until they realize this mistake, see, for them it is very easy. After 4 years, notwithstanding anything contained in any judgment, 1 to 4 should be read as 1 to 5, they will say. Serial number 1 to 4 should be read as 1 to 5. So the job is a lot easier. So it is we who struggle to understand where are the loopholes, try to make some, think out of it, get some benefit, and later on only to realize that they can always take it away. That's about the amendment to 286. So with this, We will now move on to Mr. Padam to address such assessments and as well the charitable trusts.
A search may take place, and in that search, material relating to a third person may also be found. The question about when a third person is going to be assessed and the material available to him is not for the entire period of the block, only for a limited period, should he be troubled for the entire period of block? Because the definition of block period now under 301 of the new act is the period of 6 years preceding the year in which the search is initiated. The search is initiated today, let us say under the new act, but I'm giving the date today. On 14th of February, then the year commences from 1st of April 2025 and will therefore be including 5 or 6 years prior to 25. That should be the block period. The search may happen on one person, search may happen on a multiple number of persons concerned, in relation to which material available to a third person may be found. So there should be also a situation as to whether a third person is being subject matter of an assessment and searches have happened on multiple persons concerned, how should we now understand the block period? So we have an existing provision under the statute, and these are provisions that have been amended only the 2025 Act, not much, there's no amendment to 158 BC or BED or BE. So when a search takes place on a particular person concerned, the definition of the block for a third person would be that if there is only one specified person, that is the person on whom a search has happened, a 132 has been conducted, then the block period for the third person will coincide with the block period of that specified person. That is the person in relation to whom the search has been conducted. If there are multiple persons concerned on whom search has been conducted, and in all or more than one person, you have found material belonging to this third person, common third person, then the block period shall be the period referable to the letter of the blocks that are there. So in relation to those multiple searches, depending on the provision of law applicable, compute the block period for each of the person for whom the search has been conducted, which is the later period. That period, block for that person, will be the block period for the third person here. To that, they want to now bring certain amendments. This is a proposal to say that if the third person whose material is found or whose undisclosed income is detected, he has to be assessed. But the undisclosed income relates to a small period or a specified period. Which is a specific period? Two types of period have been identified. One, the undisclosed income refers to the period commencing from 1 year prior to the date of initiation of search till the date of initiation of search. So if the undisclosed income of the third person pertains to this period only, take the example again, that today is the date of initiation of search, 14th of February, 1st of April 2025, plus one more year, 1st of April 2024. So if the undisclosed income of the third person were to pertain only to the period 1st of April 2024 to 14th of February 2026, and for no other year, then you don't have to bother about the entire period as being the block period. The block period shall only commence from 1st of April 2024 and does not end on the date of initiation of search. That's only for the purpose of reckoning for what period the undisclosed income is referable to, but the block period will end on the date of the execution of the last of the authorizations concerned. So let us say the last of the authorization was executed on in the same example, on 30th of April 2026, then from 1/4/2024 up to 30th of April 2026 will be the block period. If the undisclosed income does not relate to this period, but relates to any one of the 5 years preceding this block that we're talking about, any one of the 5 preceding years, then the block period shall be confined to that particular year only, and there'll be no reference to anything else thereafter. So there's going to be a limited period for which the third person is sought to be troubled. So 2 more, therefore, proposals are now being introduced to understand the definition of a block period in relation to a person who is a third person of a search being conducted on a specified person concerned. When they introduced this, there were already an existing provision which says that my block period, that is the third person's block period, will coincide with the specified person. And if there are multiple specified persons, the later of the period as mentioned for those specified persons. So there is a mandate already that the block period shall be a period of 6 months coinciding with that specified persons. Now when they introduced this new provision, they ought to have said, overriding the earlier 2 provisions. They're not done that. They should then said, accepting those provisions concerned. I'm creating an exception to the existing provisions, and now making a statement, regardless of those provisions, regardless of the block period comprising of a defined period of time equivalent to the block period for the specified person, I'm going to create an exception that the block period shall be a truncated period under these 2 circumstances concerned. That they're not done. 1. 2. Between these 2 provisions concerned, that is the year of search or one earlier year, these are also mutually exclusive. That means if you find in one person's case, a third person's case, the undisclosed income relates to 1/4/2024 till today, as also for one earlier year, does not mean that you'll have the ability to use the new provisions concerned. You can't ask for a truncated block period for this block period being 1 under clause C and another block period being 1 year under clause D. You can't do that. You'll necessarily have to have the entire 6-year period of the block period. So these are exclusive, mutually exclusive. If there is undisclosed income only for this limited period, either falling under C, I'll repeat again, is from 1 year prior to the relevant year in which the search was initiated. Only in that period there is the undisclosed income for the third person, or clause D talks about in one of the earlier 5 years period, we'll be able to then make a statement that the block period shall be a truncated period of these small period of recent ones in the year of initiation of search plus 12 months earlier, or one year in the earlier out of the earlier 5 years concerned. What happens in case of a block period situation assessment? The law would say that when there is a block period determined, then any proceeding that is pending in relation to that SSC shall abate, because they want the entire income to be assessed at one period in one point of time. Take a situation that is such happens today, and the block period refers to 1 year. That means the undisclosed income is referable to only 1 year, being 1/4/22 to 31/3/23. That's the only period in which the undisclosed income has been detected now. What happens now? The law would say, or law would try to imagine, that the assessment proceedings, if any pending for that period, shall abate. Now, which are the assessment proceedings that shall abate? Because those were proceedings that were commenced or that were to be commenced under the 1961 law. What the law is now under the 2025 Act making a mention is the proceedings referable to the period post 2025 Act coming into the picture shall abate. So if there is a proceeding that is already pending under the 1961 Act for 23-24 financial year in relation to which the undisclosed income is detected, then the new law which says that there shall be an abatement of the old proceedings may not be capable of being implemented, means that there should be one assessment for the block period now, And the earlier assessment that was ongoing under the old law, since there is nothing that prevents that prevents the action from being taken, the assessing officer possibly will have to complete the assessment even in relation to that under the normal provisions of the Act for the year 23-24. This is going to give rise to some confusion because the law in terms of its coordination to say how and when it shall abate has not taken care properly. We may refer to 536(2)(v), which talks about what happens when the block assessment proceedings have been initiated. Now, 536(2)(v) only talks about block proceedings having been commenced under the 1961 law. If they have been commenced, therefore, under the 1961 law, then those proceedings and that law relating to block assessment shall continue to apply despite the repeal of the 1961 law. But then, if you're looking at a regime of 2025 Act having come into picture and a search having taken place post the 2025 Act having come into effect, then 536(2)(v) will not come to the rescue of anybody because that's not a section relevant at all for this matter concerned. We'll have to look at the law as it is, and the law as it is under post-2025 would say that the proceedings pending under this Act shall abate may not necessarily, therefore, go and impair the proceedings that are already ongoing under the 1961 law. Because 536, the starting section would say that all proceedings in relation to the earlier years prior to the starting of the Finance Act, Income Tax Act 2025 shall be continued and shall be on the basis that the old law continued to operate. They have therefore not been repealed. So we'll have therefore difficulties in terms of understanding how this abatement has to happen when there is an abatement of an earlier year. When the law is trying to give you a limited window for determining the block period, it makes it incumbent upon the assessing officer to come to a very definitive conclusion that the income relates to only this particular limited point of reference. That means every year when the department is trying to make a statement that the income relates to a particular period, the department has to be sure about that conclusion concerned, because if there is a reference to a wrong period in the notice that is given to an assessor concerned, he can challenge to say that there is a lack of application of mine, as a result of which the entire proceedings on the third person may have to be nullified. So now, by virtue of this new two provisions that have been sought to be introduced or proposed to be introduced, the law is making it incumbent upon an assessing officer to come to a conclusive findings to say that these proceedings shall result in an escapement of income, or because of the materials given to me from the seized officer, from the officer who conducted research, it appears to be that the income is referable to only one particular year, that such a conclusion has to be made properly by the assessing officer, and that conclusion therefore would be open to challenge to say that there may be an improper appreciation of the facts and circumstances, and that could be possible in additional reason for the assessors to challenge the block assessment tomorrow. We have under 294 of the new law time limit for completion of the block assessment. The existing law says that the block assessment shall be completed within a period of 12 months from the end of the quarter in which the last of the authorizations has been executed. That is the period where a search happened and you're trying to make an assessment on the searched person concerned. This position of calculating this time for completion of assessment is sought to be changed marginally by making a statement that we are going to change this period from 12 months to a period of 18 months. But then the starting point is going to be changed. The starting point under the existing law as enacted talks about 12 months from the end of the quarter in the last of these authorizations has been executed. So they were waiting for the last of the authorization and then looking at 12 months thereafter from the quarter ending in which the last of the authorization had been executed. Against that, 12 months has become 18 months, fine, but then the start of the 18 months would be the end of the quarter in which the search was initiated, not the execution of the last of the authorizations concerned, from the quarter in which the search was initiated. So that's the change. This is the change that has been sought to be, in terms of the period of 18 months is there, but the starting point for this would be the start of the quarter, the end of the quarter in which the search was initiated. If you go into the language of 158BE, we also had this 12 months from the end of the quarter in which the last of the authorization had been executed, that now trying to make a statement that there are too many searches that are happening, too many group cases are being searched. It's difficult for us to find and keep a track of all of this. Therefore, we are making a statement now that to have some sort of a consistency in understanding the limitation period, we are making it from we are making the limitation to be a period of 18 months from the end of the quarter in which the search is initiated. For the third person, that is the other person, 296 subsection 5 deals with the limitation period. There's no change there. As a result of it, therefore, for the third person, no change in the time limits concerned. We then move on to charitable trust. This is the only amendment in terms of the block period concerned, certain changes to the charitable trust. Section 332 of the Act deals with the procedure for obtaining registration. Subsection 1 deals with the number of institutions that are required to be registered. Out of that, the penultimate item talks about trusts that are required to be registered and those that are required to be complying with Schedule 3 and Schedule 7. Certain charitable trusts who are so mentioned, as mentioned in Schedule 3, some items concerned, and Schedule 7, items number 10 to 17 in the table of Schedule 7. This 10 to 17 of Table 7, Schedule 7, spoke about many institutions, including the PM's Care Fund, the Clean Ganga Fund, Swachh Kosh Fund, PM's Cares Fund, PM's Folk Art Fund. So these were institutions that were not required to be registered under the 1961 law, also under 12AB. Rightly or wrongly, the mandate for these institutions to get registered found its way in 332 when they made a reference to Schedule 7, items number 10 to 19. Now they're making a statement that we are removing a reference to 10 to 17. Only those institutions that come within item table number 17 to 19. So 10 to 16 are not required to be registered. And these are the items, these trusts are that we have made mention of, the PM's Care Fund and the Clean Ganga Fund, Swachh Kosh Fund. Those are all the institutions that are there mentioned in serial number 10 to 16. They are not required to get themselves registered for them to be eligible for the tax benefits. 349 talks about the return of income filed to be required to be filed by a charitable trust, where the charitable trust has income beyond the maximum not chargeable to tax before giving effect to the provisions of exemptions under the Income Tax Act. Then the charitable trust is required to file a return of income. And time, as mentioned in 349, was making a reference to only 263(1)(c). Particular time was mentioned there. The existing Income Tax Act says that a charitable trust is required to file a return of income. Either 139(1) or 139(4) time limits was also available. So they're now bringing a parity now by making a reference to the time limit available under 263 subsection 4 also. A charitable trust therefore may file its return of income within the time available under 263 subsection 4. A charitable trust is required to conduct its activities in a particular manner. If it carries on, especially a charitable trust that is involved in an object of general public utility. This has been a matter of some controversy throughout. We have had an amendment to the definition of charitable trust, charitable purpose under 215 by the addition of the proviso and the amendment of the proviso over a period of time. The proviso as existing now talks about that trust which is involved in an object of general public utility shall not itself involve in any commercial activity unless the commercial activity is required to be carried out in the course of attainment of its object, and the total receipts from these commercial activities are less than 20% of the gross commercial activities. This is the mandate of the proviso to 2 subsection 15. We also have 11(4)(a), which says that a trust, if it were to carry on its business or profession will be allowed to carry on his business or profession only if the business or profession were to be incidental to the object sought to be achieved and separate books of accounts are maintained by that charitable trust. These are two prohibitions on a charitable trust, and these have been incorporated into section 350 and 351 of the new regime. 350 is the same as 11.4a, and 351 is the same. 345 and 346. 345 is the same as 11.4a, and 346 is the same as 215 proviso. Now, under 351, if there are specified violations done, then you may lose the benefit of registration also. It's a particular way of understanding things. In 351, when there are specified violations, then you may be called upon to lose your charitable status. In that situation concerned, one of the reasons mentioned is a violation of 346 could lead to a cancellation of registration. 346, I made a reference again, refers to the second the proviso of 215, which prohibits you from carrying on a commercial activity. You're not supposed to. Under the new act, therefore, if a charitable trust proposing to carry out any object of general public utility was engaging itself in a commercial activity, then it was therefore under a danger of losing its registration, because one of the conditions for cancellation of registration was that this charitable trust is now in violation of the proviso to 215. This was not the position under the 1961 law. 1961 law only told that if you are carrying on a commercial activity, then you may not be denied your registration. You may not only get the exemption, you may be called upon to pay tax. 13 subsection 8 gives you some sort of a protection to say that you will be called upon to pay tax, but your registration is not in jeopardy. The 2025 Act was trying to make a change to this to say that no, the carrying on of the commercial activity by a GPU trust would invite cancellation of registration. They have now said no, we would like to maintain a parity of the reason between the 61 law and the 2025 law, and therefore carrying on of commercial activity by this GPU trust should not therefore lead to a cancellation of registration. Therefore, they are proposing to make a reference, a deletion to the reference to 346. And therefore, only a violation of 345 can give rise to a cancellation of registration among other reasons concerned. For 345, I repeat again, is the same as 11.4a. And if you are therefore violating the conditions of 11.4a, possibly you may be facing a threat of the registration being cancelled. But a person who is now a GPU trust carrying on a commercial activity, if he is therefore falling under the conditions of 346, he may only be called upon to pay tax. He may not have the threat of losing his registration concern. If there are specified violations, you may be called upon to pay additional tax. That is the tax on the accreted income. That happens by 352 of the Income Tax Act. Specified violations are given in 351, and the consequences are given in 352. So we will be called upon to pay tax on a normal income, the normal rates, as also we will be called upon to pay the maximum rate of tax on the accreted income. Therefore, there is an additional income tax levied on this accreted income. This accreted income tax has to be discharged within a period of 14 days from the date of certain notified events in a table that is there below subsection 4. Subsection 4 has a table, and they're giving you timelines, and if there is a timeline that is attracted, you'll be called upon to pay tax within a period of 14 days from the date of those timelines mentioned in schedule. That is there in the table below schedule, the subsection 4. One of the conditions there was a question of where a non-profit organization merges with another non-profit organization. What shall be the conditions subject to which this merger shall be permitted? It shall be a situation where one non-profit organization merges with another non-profit organization which is also registered and which has objects similar to the merging non-profit organization. If that were to happen, then you are allowed to have this merger concern. If that does not happen, so three situations are there where this condition is not said to be satisfied in the table below subsection 4. First is where a non-profit organization merges itself with a non-profit organization which is not registered with the commissioner. So a registered NPO merging with an unregistered NPO will invite the table concerned. You are required therefore to pay accuracy tax also on that within a period of 14 days from the date of this merger concerned. Situation number 1. Situation number 2. Non-profit organization registered merges itself with another non-profit organization which is also registered, and it has similar objects, but there were certain conditions subject to which the registration had been granted, and those conditions of registrations have not been satisfied. So certain incidental conditions required to be satisfied by the organization not being satisfied, it will be a situation where second of the conditions of the table will be attracted. Therefore, from the date of merger, you will be required to pay the accuracy tax concerned. Third is that you are merging with a organization which is charitable, which is non-profit, but has dissimilar objects, doesn't have similar objects concerned. In that situation also, you'll be called upon to pay accuracy tax from the date of merger within a period of 14 days. Actually, the existing provision which is there in the table, if you look into very minutely, very microscopically, it has the very same conditions that the law is now proposing in a tabular form. What is there in the existing table on a very microscopic reading gives you the same sentiment. Nothing new is happening. Possibly, there's a little better arrangement of the flow of the three situations concerned, and these three situations possibly will give rise to a case where some tax will be payable by the institution concerned because the conditions of those tables have not been fulfilled. And we have this tax under 352, which is payable, will not be applicable, as we've already seen, by virtue of a new section that is proposed, 354 capital A, where there's a merger happening between two non-profit organizations which are both registered and which have similar objects. In that situation concerned, it will be a case where the tax on accrued income will not be payable. These are the changes in relation to a block period, block assessment, and also the charitable trust. We'll go back to Chaitanya for
TDS?
Huh?
TDS?
I'll come TDS later.
Okay. What time are we to break? What time are we to break? 4 o'clock. 2:30. 2:30. I'm supposed to start with 195, right? 195 and the penalty. Idu followed by penalty. Followed by penalty. Or what is that one? I'll just check. Important, huh? Important. Right, I'll just check the name. How long TDS will take? Now we'll get to another important amendment. To section 195, which corresponds to 115 BBE, one of the most draconian provisions of the Act. Cash credits, unexplained investments, etc., where the tax rate is kept at 60%, surcharge of 25%, and assess taking it to a very high, close to 80%. Then you will have non-search penalty of 10%. Search penalty could be 30% or 60% as the case may be. And out of blue, they have found that 60% tax is disproportionate, finally. So memorandum says, levying tax at 60% on cash credit is disproportionate. So therefore, they deem it fit to reduce it to 30%. In that effect, they carry out an amendment. If you go to 195 as originally enacted, in contrast to 115 BBE, you will notice the corresponding sections to 68 to 69D here are 102 to 106. Same, otherwise the language is just the same, except on very material change which will come to. So tax rate also was originally fixed at 60%. Now they seek to amend it by saying that it is to be 30%, a very welcome measure, but then there are a few issues which they ought to have corrected. If you recall, the entire process of them enacting 2025 Act is that they introduce a draft, then give it to the select committee of the parliament. The select committee will tour, hear people like us, and give suggestions. And for most of the suggestions given by the select committee, the reaction of the finance ministry is that we do not want any policy change. Their consistent statement for any suggestion is that, no, we are not looking for any policy change, we are only looking for simplification. Right? If they are not looking for policy change, there is absolutely no reason why, while in section 68 to 69D, the word used is may, in sections 102 to 106, it is changed to shall. What is discretionary? Your Noor Jahan's case, 237 ITR 570, the Supreme Court stated that the addition under this is essentially a discretion. It is not mandatory addition. If it go to Mohan Kala's case, 292 ITR 178, the Supreme Court says, in the context of section 68, even if my explanation is not satisfactory about the creditworthiness, bona fide and genuineness of the transaction, identity of the transaction, it is still open to the assessee to satisfy the assessing officer that the so-called cash credit does not represent his undisclosed income. So in the light of these, and keeping in line with their avowed statement that there shall not be a policy change, there is absolutely no reason why this may has become shall. So this is a very dangerous aspect that needs to be protested for the reason that, see, the cash credits, the unexplained investments, they are all essentially the rules of evidence. If you go to 1922 Act, when these sections did not exist, the Supreme Court in Govindarajulu Mudaliar's case held that though these sections do not exist, essentially assessing officer would still have the power to ask for the source of a particular outgoing, and assessee is duty bound to give a satisfactory explanation, and should the assessee fail, despite being armed with any particular section, assessing officer is enabled to make an addition. So essentially it is appreciation of evidence. See, you are found to be in possession of a particular asset, assessing officer would find that no, its value are not recorded fully in your books of account, or not at all recorded in the books of account. He would ask you a question, you will have to give an answer. He will have to weigh the weight of your answer and then decide in his discretion whether an addition has to be made or not. It cannot be a mandatory addition. It is not the normal tax on income. The discretion essentially inherently is carried with the spirit of these sections, but they made it mandatory. So therefore, it is essential that we all will have to carry a very, very cohesive voice to the ministry to have it removed. Otherwise, it could be used by the tax officers to harass the taxpayers. If they do not find anything else, they can just invoke any one of these sections and slap, like tax at 60%, now it will become 30%. This is one aspect. Now, when we go to discuss penalty, which anyway we'll be discussing in a greater detail little later, you will notice that whenever the assessing officer makes an addition under 102 to 106, it will be invariably a case of misreporting. Meaning, no one will have to decide. Your conduct contumacious is not the deciding factor. The fact that he makes an addition will mean it's a case of misreporting, meaning 200% penalty. So which we will discuss a little later. Now come back to this. So what they are trying to do in 195 is that the rate is going to be 30% from 60%. And very strangely, 195 has two components, where assessee himself declares it in his return of income. Second is where the total income determined by the assessing officer includes this income. I am surprised to see as to how assessee himself can offer cash credit. See, section 69 says where the assessee is found to be owning or assessee is found to have made an investment. 69. Or 69A, assessee is found to be the owner of any money, bullion, jewelry or other valuable article or thing. Then the assessing officer would ask a question, assessee will fail to give an explanation, or the explanation which he gives is not satisfactory. Then the value of such money, bullion or jewelry shall be regarded as may be regarded as his income. Now, how as an assessee I find myself to be owning money? I want money, that's it, nobody else. I need not find myself to be owning money, asset, bullion, jewelry. It is somebody else who has to find me to be in possession of money, bullion, jewelry or other valuable article or thing. So the basic edifice of 102 to 106, wherein his sum is found to be credited in the books. Who has to find? I myself have credited in my books of account. Do I find myself that a sum is found credited? The entry which I made yesterday, do I find it out today? See, this is something which is ridiculous to expect the assessee to reflect these incomes in the return of income that he files. But anyway, the law is dash. So, law is the one that would require you to do this. You will have to do it if you have to save the penalties or whatever. So, that is one aspect. Now, when you move to other aspect of 102 to 106, and I will give you some illustrations before we break for tea. Ideally, these illustrations could have been taken after we discuss the penalty, but just to see as to what call you will have to take. So, right or wrong, the law will allow now you to reflect these cash credits by yourself in your books of account if you so choose to do. Now, let us look at this. Situation 1, where you yourself offer the cash credit, etc., in your return of income, in your original return of income. What will then happen? Let us say 1 lakh. Tax at 30%, surcharge 7,500, 25%, cess 4%, your damage is 39,000. I am explaining this so that you can take a call tomorrow. What do you have to do? So, if yourself, suo moto, offer this in a original return, then damage to is 39,000. Now, situation 2. If you would offer in an updated return and you have filed the original return. See, now they would allow you to file the updated return have already filed the original return, you are not included in the original return. You have some sense that, like there could be a notice coming to you, you would want to file an updated return. Then what you'll have to do is to compute interest, compute the tax, interest, then pay additional tax of 25%, 50%, 60% or 70% depending on when you're doing. This is on the premise that you have filed the original return. So then you'll have to pay 234B kind of interest that is computed under 424. For the sake of simplicity, we have assumed that you are filing your updated return at the fag end of the particular window. Like 12 months means we have computed interest up to 12 months. It need not necessarily be so. You can file it in the first month, then the interest would accordingly come down. But I can't be having so many situations here. So 12 months, 24 months, 36 months and 48 months. So tax surcharge will be 39,000. Interest under 424 analogous to 234 would be so much. Aggregate of tax and interest would be so much. Then you'll have to pay the additional tax of 25%, 50%, 60%, 70%. Then the total damage would be, maximum damage would be 60,000, 79,000, 92,000, 106,000, depending on which year you choose to file the updated return. As Mr. Padam has explained, after 48 months, under 2025 Act, you cannot file updated return. While under 1961 Act, thanks to Finance Bill 2026, you can file. Now, this is a case where you file an updated return, but original return is not filed. Meaning 234A interest also will have to be captured here, which is 423. So you'll have to compute 423 interest, you'll have to compute 424 interest, then you'll have to also determine the tax which already determined to be 39,000, add all that, and on that you'll have to pay 25, 50, 60 and 70%. Look at the damage. Fourth year end, if you file an updated return, and your payout will be 1,41,219 for a sum of 1 lakh. But then the advantage in filing updated return is no prosecution, no penalty. Now, this is a case where you get a reassessment notice. Up till here, we have given you two situations where you file updated return without the reassessment notice. Now, if you get a reassessment notice and then file an updated return, in addition to 25, 50, 60 and 70, you'll have to pay another 10%, right? Depending on whether you had originally filed the return or not, your damage will be, look at this, maximum damage where you have not, where you filed the original return is 1,12,000, and where you not filed the original return, it will be 1,49,000. Now, you may want to compare this. I have to pay so much. Should I wait for AO to do whatever he wants to do? If you do that, then he will levy a tax of 39,000, and it will be a mandatory case of misreporting, he will levy you 200% penalty, that will be 60,000, and it's going to be 99,000. But mind you, we are not computed interest here. We are not computed interest here. So depending on the length of time during which you are liable to pay interest, you decide whether you should file updated return or should suffer an adverse order and pay the penalty. Only small risk here is that you face prosecution, which may not be there if you file an updated return. Then, if you do not want to do it, you can now go to, you have another option where you can reduce it. How? They have amended section 270AA, immunity. They have also amended section 440, where if it is a case of misreporting, in terms of an addition under 102 to 106, that is under section 195, you can avoid penalty, get an immunity from levy of penalty as well as from prosecution by paying an additional tax, additional income tax at the rate of 120% of tax on underreported income. So what is your tax on underreported income? 30,000. So you will have to pay 120%, that is 36,000. So look at this, 39,000 is the basic tax, 30,000 tax, 7.5 surcharge, 1.5 cess, 39 basic tax. Additional income tax in lieu of penalty will be 120% of tax on underreported income, that is 30,000. On that 120%, that will make it 36,000. So you will pay 75,000 rupees and you'll get immunity from levy of penalty and also from the prosecution. Mind you, interest is not factored here. So why I have displayed these slides is not that these slides are conclusive. You have to keep in mind whether you'll have to file an you'll have to keep in mind whether you'll have to file an updated return or not, depending on whether you're filing an updated return on the basis of a 280 notice, that a reassessment notice, or CO motu. That is one aspect. Another aspect is whether you will have to allow the assessing officer to do and suffer the damage, or you allow him to do, then go for immunity, whereby you pay not 200% penalty, you pay additional tax of 120% of tax. So depending on these, you will have to take a call, and most ideal call is not to have a situation attracting 102 to 106. So if you have certain business income, rather offer it to tax as business income than offering it to tax as income under section 195 read with 102 to 106. So instead of going for CO motu offer, under 102 to 106 through the return, right? At least choose to do it as part of a business income so that no stigma attaches to your conduct. Otherwise, it will be a case of you exposing yourself, saying that there is some cash credit, I do not know why did I do it, and I am found to have myself, like owning certain money, bullion, jewelry, a valuable article or thing. So that looks little ridiculous. So whatever is your actual income, show it under the respective heads and offer it to tax if you can. So with this, I think we'll have to now take a quick break for tea before we move into other aspects post tea. Because post tea we are going to discuss penalty provisions. There are some interesting aspects which we'll have to take care that henceforth we are going to have a composite penalty order, meaning assessment order will also have a penalty order, and we'll have an extra ability to ask for waiver of penalty, so that we'll also get immunity from prosecution. Some niceties are associated with this, which we'll have to discuss post tea. We will now look at the amendments to penalty. You will find the amendments parallelly made, both to 1961 Act and 2025 Act. Amendments are broadly three. Firstly, to 270 capital A. Secondly, to the immunity under 270 double A. Thirdly, in the procedure, that is 274. As to how going forward the penalty order will have to be passed. Likewise, you will have the amendments in 2025 Act as well. Now let's go to 1961 Act, section 270 capital A. Subsection 11A has been introduced here, is where you pay the additional tax of 10% for filing updated return in pursuance to notice under 148. See, apart from 25, 50, 60, 70, you pay an additional 10%. That would not be forming part of imposition of penalty, is how they have clarified here. Likewise, you will have an amendment made even under section 439 as well. Now, the other important amendment which is made in section 439, which corresponds to section 270 capital A, is in subsection 11. Look at on the right hand side, the cases of misreporting. You will find the list of this in 270 capital A within brackets 9. You will have that in 439(11), like misrepresentation or suppression, failure to record investments, expenditure claim not substantiated by evidence, recording false entry, failure to record any receipt in the books of account, failure to report the international transactions or specified domestic transactions. These are the 6 instances where if an addition is made and if there is an underreporting of income, and if such underreporting is on account of these one or more of 6 factors, that will be construed as misreporting and you will have 200% penalty. And if it is a simple case of underreporting, 50% penalty. It's a case of misreporting, 200% penalty. Now, if you see 1A to F here, they are all indicating the conduct of the assessee, like misrepresentation, failure to record, not being able to substantiate expenditure, making false entry, failing to record any receipt in the books, or like failing to report the international transaction, SDT. Now they seek to add, as I've said a little ago, the income referred to in 195(1)(b). So wherever the total income determined by the assessing officer would include 102 to 106, that is cash credit, etc. Now automatically it would become a case of misreporting. So that's one thing that needs to be understood here. Now you will have some difficulties here, like let us say assessing officer make an addition on the 102, that is cash credit. You challenge it in the appeal. In the appeal, if the addition is quashed, then penalty would automatically go. On the other hand, if the addition is sustained, can the court say that it is not a fit case of being called as misreporting? Is it possible that you would challenge the addition as well as the penalty? Because going forward you will have a composite order. Your challenge also will have to be composite. You would not restrict your ground only to the addition. You would also raise a ground on levy of penalty. Now that this is an automatic case of misreporting coming as clause G in this particular provision 439 within brackets 11, we will have to wait and see whether a court would show an indulgence in saying that yes, addition is justified, but it can't be called as misreporting, or whether court would say we will have to read the law as it is, and law would say that this is a case of misreporting, that's it, you will have to pay penalty, because the penalty that is levied under 439, question of reasonable cause does not arise. You cannot have a reasonable cause for non-levy of penalty insofar as this kind of a penalty is concerned. Now let's go to 270AA, immunity from levy of penalty. If you go to subsection 1, they have made changes to subsection 1, 2 and 3. If you look at subsection 1 of 270AA as it originally exists, it says, "AO may grant immunity from imposition of penalty." That means he can refrain from levy of penalty. Now they have changed it. He may grant immunity from imposition, or as the case may be, waiver of penalty. Meaning, post levy of penalty, waiver is now permitted. Earlier, if penalty is levied, then he couldn't have waived. He could have only granted immunity from imposition, which is a call which he has to take before he even imposed the penalty. Now, he has the ability either to grant immunity from imposition of penalty, or if the penalty is levied, he can proceed with the waiver of penalty should the conditions of this, conditions of this section be satisfied. Then, the first condition for immunity that remains unchanged, what is it? Tax and interest as per the order of assessment under 143(3) or 147 has been paid within the period specified in the notice of demand. In order that you get immunity or waiver, this condition is a must. Once the assessment order comes, demand notice, whatever tax and interest it states, you shall pay without demur. B is where they have messed around. B is, worded horribly badly. The commas have been placed at incorrect places, and it becomes extremely difficult to understand the working of clause B unless you do colossal damage to the language of this particular section. Second condition which is added now is that where penalty has been levied, or then comes a comma, as the case may be leviable under circumstances referred to in 270A subsection 9, that is misreporting, additional income tax amounting to 120% of underreported income has been paid within the period specified in the notice of demand in lieu of such penalty. So it looks like the way the language is structured, if the penalty is already levied, I don't have to pay 120%. It's only where penalty is leviable under circumstances of 270 capital A9, I will have to pay additional income tax equal to 120% of the amount of tax payable on the underreported income, and that should be paid within the period specified in the notice of demand. How will I get the notice of demand if the penalty is yet to be imposed? Or should I understand this as notice of demand for assessment? So we will not know. They are saying you have to pay 120% of the tax payable on underreported income has been paid within the period specified in the notice of demand in lieu of such penalty. So there is something, like seriously wrong in the way the section is, clause is structured. It ought to have been simply put that where it is levied or leviable, where it is levied or leviable. And in both cases, under the circumstances of misreporting, you shall pay 120% of tax on underreported income before you make the application for seeking immunity, would have been the ideal language. So now they say you'll have to pay within the time specified in the notice of demand. If the penalty is yet to be levied, where is the question of notice of demand? And the way they put the comma, the way they put or is that this entire condition of having to pay 120% may not even apply where the penalty has already been levied. So therefore, it creates some serious issue. Now go to third condition. No appeal has been filed against order referred to in clauses A and B. What do you mean by this? Which is the order referred to in clause A? Assessment order. Which is the order referred to in clause B? Penalty order. And the way they are trying to say is, no appeal has been filed against order referred to in clauses A and B. How would you have a situation where penalty is yet to be imposed, you are seeking immunity from imposition of penalty, you will have an order of penalty. That question can arise if the penalty levy has become fait accompli, order of penalty has been made, number one. Two, they are looking at a composite order, where order referred to in clauses A and B. What they actually mean is a composite order, and they have made an amendment to section 274. But while this provision is applicable from 1st of March of 2026, the composite order under section 274 will apply only for assessment orders, the draft assessment orders passed on or after 1/4/2027. Are you able to get me? See, if you are understanding clause C as a composite order, where you are not supposed to have filed an appeal against an order of assessment and penalty. Clause A is assessment order, clause B is penalty order. They are saying order of assessment and penalty. As I said earlier, this can be possible only when you get a composite order. Whereas composite order to kick in will take some more time, because 274 subsection 4 as is amended, which I am discussing a little later, would come into effect from 1st of April of 2027. So what will you do from 1st of March of 2026? That is the date of enactment of 270AA amendment, 1st of March of 2026. And during this period, what are you going to do would be a big issue. And we have in fact had very lengthy discussion as to if the underreporting were to take place as a result of misreporting during the window from 1st March till 31st March, what will happen? Thereafter, post 274 amendment kicking in, if they pass a composite order, then a misreporting takes place, what would happen? Either way, we are not able to reconcile because of use of these words, that order referred to in clauses A and B. So the best way to resolve this problem is, don't make composite order effective 1st of April of 2027, convert the commencement date of this amendment as well as 274 and make 274 effective from 1st of March of 2026. Or if that is too difficult for you to get the presidential assent or whatever, at least fix it as 21st of March of 2026 and have the same effective date for both this amendment as well as section 274. Otherwise, you will have a very, very difficult issue of reconciling the 270AA along with section 274. Earlier, you couldn't have gone for immunity if it's a case of misreporting. No immunity was available. Now, whatever be the misreporting, you have the ability to go for immunity and you will pay additional income tax of 120% of tax on underreported income. That's the most important change here. And though you would pay 120%, which looks pretty high, it is not as much as 200%. Otherwise, penalty for misreporting is 200%. Penalty for underreporting is 50%. You come somewhere in between, you pay 120%, get the immunity, and also get the immunity from launching prosecution against you. So this is what we have discussed. For want of time, I will not take you through, more in detail what will happen if it is between 1.3 to 31.3 and all that. I've already indicated to you the best way to resolve all these issues is to make 274, that is mandate to pass a composite order effective from 1st of March of 2026. And clause B language has to be changed according to us. Language ideally should be this rather than what is contained there. Likewise, section 440 also is amended, which is analogous to 270AA of 2025 Act. Here there is no problem because this will kick in only much later. Under 2025 Act, first tax year is 26-27. Assessments can happen only after 31st March of 2027, where there is a convergence of date of, the immunity change as well as the requirement to pass the composite order. So there is no difficulty there. Now earlier you had 443, which was analogous to 271 AAC. That has now been removed. 443 has been removed because it is now made part of regular penalty provision 439, and it's now subject to a penalty like any other misreporting penalty. So this section is found missing, and when you read 2025 now, you will find this gap, section gap. Now let's go to this provision. 274 versus 471 of 2025 Act. Now 274, they are amending subsection 1, which will require you to provide a reasonable opportunity of being heard. Now they're stating that reasonable opportunity of being heard by way of a show cause notice to that effect. I will not know how well, sir, a reasonable opportunity of being heard could have been extended. See, some courts have held when it came to limitation under section 275 for penalty, a question arose as to what is the date of initiation of penalty. In fact, there's a batch of writ petitions in the Karnataka High Court where we were arguing that issue of show cause notice is not the date of initiation. Date of initiation in terms of section 275, 1C would be the proceedings during the course of which action for imposition of penalty is initiated, meaning there has to be some principal proceedings, and this will go as a collateral proceeding. Penalty will go as a collateral proceeding as part of the principal proceeding. That is where we would say that the assessing officer will have to record the satisfaction that if there is a concealment or furnishing of inaccurate particulars, the satisfaction has to be there in the assessment order. That according to us is the date of initiation. This is for concealment. For example, you have a case of violation of 269 SS, you'll have 271D penalty, 269 ST, receipt of cash beyond 2 lakh, 271D a penalty. These are the cases where courts are saying, what is the date of initiation? Department is arguing issue of show cause notice is the date of initiation. We are successfully arguing before the High Court that it is not the date of issue of show cause notice, it is the date on which the assessing officer intimates the additional commissioner that here is a case where cash is received in violation of 269 SS or 269T, and therefore penalty has to be started, notice has to be issued. The intimation by the AO to the additional commissioner is accepted by the High Court as the date of initiation. So I really do not know for what purpose have they amended section 274 in this regard. If they are intending to overcome the finding of the court, I do not think this amendment is in any manner help them like solve the problem. Now, look at the amendment they are trying to bring now. This needs to be seen very carefully. Subsection 4 has been brought into section 274. It says, notwithstanding anything contained in any other provision of this act, where any draft of the proposed order of assessment under 144C, draft order, in the case of an eligible assessee, or assessment under 143 or reassessment under 147 is made on or after 1/4/2027 in respect of assessment year 26-27 or any earlier year. So what is the effective date here? 1/4/27. Which act are we dealing with? 1961. When is this act dying? 31st March, on 1st of April. However, in terms of 536 subsection 2 clause C, for all the tax years 25, 26 and backwards, notwithstanding the repealed act only would apply. So therefore, as long as they are trying to assess your income of the previous year 25, 26 and earlier, whenever in future the Income Tax Act of 1961 remains, you will have to be referring to Income Tax Act of 1961 only. So now they are looking at a situation where for assessment year 26, 27 or earlier, you are going to pass an order of assessment under 143.3 or 144, or you are passing a draft order in the case of an eligible assessee on or after 1st of April 2027. Then A, the penalty under 270 capital A, if any, shall constitute part of such draft assessment or shall be imposed as part of such order of assessment or reassessment as the case may be. So it has to come in the same order, either draft order or the final assessment order. And the reference to the assessment order or the penalty order under section 270 capital A, in any of the provisions of the Act shall take reference to such order of assessment or reassessment as the case may be. Meaning, when you pass a composite order, which will have both assessment as well as penalty, if any reference is made only to the assessment, such reference shall be taken from the reference of the composite order. Or if any reference is made only to the penalty, even then the reference will have to be taken from the composite order. Why would they have done it? They would have done it because though it is a composite order, the proceedings cannot be composite. Penalty proceedings are distinct and separate from assessment proceedings. And your appeals will have to be separate. Separate appeals will have to be made. Penalty is a separate appealable order. Assessment order is a separate appealable order, unless they amend those sections also. You may choose not to challenge assessment, you may choose to challenge only penalty, then your appeal is only penalty appeal. So for which purpose, clause B may be relevant, wherein whenever any reference is made to either assessment order or penalty order, it shall always take the reference from the composite order that is passed. Then subsection 5 says, where the approval of joint commission is taken for passing the order of assessment or reassessment after this date, then such approval shall also be deemed to be approval for imposition of penalty. Because if the quantum of penalty exceeds 10 or 20, as the case may be, depending on who passes, it requires the prior consent of the additional commissioner or the joint commissioner. Now, there are some provisions where the assessment orders would require consent of the additional commissioner. Take the case of 153D. Take the case of 148 capital B. These are the cases where prior approval is required for passing the assessment order. Now, what subsection 5 says is, where under any provisions of the Act, like in 153D or 148B, prior approval for assessment is mandatory, then if such mandatory prior approval is taken, that would suffice even for levy of penalty. It's a wonderful thing, you know why? Make an RTA application, get the approval order. See whether it is application of mind by the additional commissioner. If the additional commissioner simply says approved, then his approval is bad for want of application of mind. See, it could be a case of misreporting, it could be a case of underreporting, as to call for records, and we'll have to record his satisfaction as to why it is a fit case for levy of penalty. So he has to display his application of mind, because it will have financial implications on the taxpayer. So therefore, it is incumbent upon the approving authority to keep in mind that as well, although there is no approval required for penalty separately, because the composite order goes to him, it is incumbent upon him to apply his mind not only to the additions made, but also to the penalty. You will have one difficulty now. So at least hitherto, if an assessment order is passed and a penalty show cause notice would come, what you would have done? You would have written to the officer, I have gone in appeal. So therefore, please keep the penalty proceeding in abeyance. So in terms of 275(1) capital A, he would have not proceeded to levy penalty, would have awaited. At least no demand would have crystallized on you. Now that there is going to be a composite order of the assessment as well as penalty, you will have a situation of two demand notices coming. One demand notice for tax, one demand notice for penalty. Then you will have to be appealing against both. When you appeal against both, you will have to be paying 20% for saving you from recovery of the tax. No, that is in the budget. I am saying the position as it stands today. It's like safe harbor, right? So they are so stated in the budget. Maybe they will have to amend the circular to say 10%. So right now, as circular stands, it's 20% of the demand that needs to be paid. Yes, sir? I'm not able to hear you. When you go in the first appeal, 10%. That's what Mr. Narendra was mentioning. But that is not found anywhere in the Act. It has to come through the circular. Now, see, when this composite order is passed, it will give some practical difficulties for the authority. For him to pass the composite order, time limit will remain the same, whether it is draft order or it is the order under 143, 3 or 144, time limit will be the same. And before he would issue show cause notice for levy of penalty, he should have finally concluded the addition to be made. He can't issue a show cause notice for making addition as well as for penalty. That means it is a case of pre-decisional, post-decisional hearing. First, he should hear me on merit of the case. Supposing I am before the assessing officer, he cannot put the fear of penalty in me. He has to first hear me on only the quantum aspect. And he should tell me, after he hears me, that look, I show cause to you as to this is the addition which I have proposed to make. You have made XYZ submission. I am satisfied that it's a fit case of addition of X amount, and I have decided to add. Then should come the show cause notice of penalty. Then you reply to the show cause notice for the penalty saying why it is not a fit case for levy of penalty. And as you would reply to it, the addition on merit has become fait accompli. And after he hears you, only for the purpose of penalty, he cannot vary the quantum addition which he had earlier decided to make. So this would mean that he has to first indicate in no unclear terms that this is going to be the assessment which he is going to make. And thereafter he shall issue a show cause notice for levy of penalty. Then he will have to be heard separately. And after that he has to pass a composite order. He has to keep in mind the timelines for all these, because overall timeline is not extended. And if he misses passing the composite order in time, both would go bad. So this is an extraordinary case that he has to take. But our fear is, now that it is a case of composite order, knowing the assessing officers, they will say, go in appeal, anyway you are going in appeal. Any addition will now be mandatory penalty. So be ready for all the additions to be largely accompanied by penalty. And the carrot he holds is what? 270 AA. You don't want penalty, don't appeal, pay tax. Otherwise, invariably I am going to levy penalty. You file appeal and take the risk. Would be going to be the order of the day, whereby there will be enormous collection under direct taxes, but under the heading penalty. May not be under the heading tax. All orders passed on or after 1/4/2027 will come within this timeline. Now certain sections appear to have been overridden, like time limit under 275(1) is gone now for all the penalty in relation to assessment, under-reporting, misreporting penalty. For rest of the penalties, the time limit would remain, because now it has to be passed as part of the assessment order. And 274 will override 275 now. If you look at 270 capital A, penalty may be levied for under-reporting or misreporting even by the Joint Commission Appeals or Commission Appeals. But the 274 now says, notwithstanding anything contained in the Act, it has to be necessarily part of the composite order. Would that mean the power of the JCIT appeals or CIT appeals to levy penalty is gone? So they may not have seen how 270 capital A begins. It also gives the ability for appellate commissioners to levy penalty. But 274 will override all these provisions. Now, particularly when it is a case of draft order, we will have a lot of practical issues. See, assessing officer will pass a draft order if you are an eligible assessee. Now the law would require draft order also should have penalty. Now take a situation where there is a TP addition of 1 crore and there is an under-reporting of 1 crore. A draft order is passed determining tax as well as penalty. Now you take it to the DRP. Let us say for a change DRP will bring the addition to 0. Right? What does the AO have to do? Within 1 month he has to pass the order in conformity with the directions of the DRP. What will happen to the penalty? He cannot hear you. This is one situation. Take another situation where, like how in most situations it would take place, 1 crore will become 2 crores. DRP will enhance it from 1 crore to 2 crores. Assessing officer cannot hear you. He has proposed to levy penalty. As in fact, in his draft order, decided the penalty on 1 crore. On the addition, will he be levying additional penalty? Answer is no, he can't do that. He has to issue a show cause notice. But show cause notice should not be issued to me under 144C13. Now, does 274 override 144C13? It's only 274(4) will override, not 274(1) which will mandate issue of show cause notice. And 144C will override 274 subsection 1 because it will apply notwithstanding anything contained in the Income Tax Act. So look at this kind of a situation where if the DRP enhances the assessment, then there cannot possibly be any penalty. Third is, forget TP addition. Arguably, DRP may even pick up a non-TP addition and enhance. Whether DRP can do it or not is a big question by itself, which will not debate at this point in time because it's an existing controversy. Let's say the DRP makes a non-TP addition. We'll have similar situation. Take another situation where AO would have called it as underreporting. Can the DRP say, no, it's not a case of underreporting, it's a case of misreporting? Does the DRP have the power of doing it? If the DRP does it, then how is it the assessing officer is going to change the order of penalty from underreporting to misreporting because you're not supposed to hear you. So can you call it a misreporting without hearing you? So these are some practical issues that would arise when the draft order is part. I think they should change. It should not be made part of draft order. It should be made as part of final order. They should give one extra month time to the AO under 144C13. Don't take 1 month, take one more extra month. And if there is going to be an issue of penalty post the DRP direction, here the assess on penalty. So that is how it should be. But to make it as part of the draft order would create a lot of practical issues. So similar amendment is carried out in section 471 as well, which I will not discuss because largely same as this. So with this, there are other penalty provisions. For want of time, we will not discuss. Some of these penalties have been converted into fines now, very cleverly, because penalty, you would argue, not a fit case for penalty and try to avoid. A fee is a mandatory, fee. Fee, as held by Supreme Court, is a quid pro quo for a service. I do not know what service is department rendering to me for me to pay the fee of so and so. So it's a fee now, and therefore there is a deemed quid pro quo, and therefore the question of reasonable cause, etc., does not arise for fee because it's a mandatory extraction. So with this, we'll move on to Mr. Padam for TDS aspects.
Some amendments, but not of much significance in the law relating to TDS and TCS. Section 393 is broken into various portions for the purpose of determination of the TDS obligations. Subsection 1 thereunder talks about when payments are made to residents, under what type of categories of payments are you required to deduct tax at source. Subsection 2 talks about when you're making a payment to a non-resident. So specific, payment has to be to a resident or to a non-resident to fall under subsection 1 or subsection 2. Subsection 3 is the common section when you're making particular type of payments, be it to a resident or to a non-resident, you will have a withholding obligation concern. Subsection 4 deals with those situations where you are not supposed to do any withholding tax. Some referencing error was there in subsection 1 that is sought to be corrected. When I was making a payment to a resident for the purpose of acquisition of the property, where the property value was more than 50 lakhs, I'm supposed to withhold tax at source. But when they drew a reference to the obligation to deduct tax at source, they made a reference to the wrong note or wrong table reference was there, where you're making a payment under a compulsory acquisition of the property concerned, you're going to withhold tax at source where the consideration exceeds 50 lakhs. An individual or an HF does not make a payment towards compulsory acquisition. The government only makes a payment concern. So there's no question of an individual making a payment under compulsory acquisition. There's a wrong reference in the TDS obligation concern that has now been corrected. So where an individual makes a payment for the acquisition of a property, or a HF makes a payment for the purpose of acquisition of the property, and the consideration is more than 50 lakhs, supposed to withhold tax at source. So that is a referencing error that has been corrected. Subsection 4 talks about those situations where there is no need of withholding tax at source. In this connection, we'll have to also be bothered about and look into Schedule 3 of the Income Tax Act in 2025 law, where certain items of incomes are exempted. There is one item called as 38B, which talks about compensation under the Motor Vehicles Act, where a person who gets compensation under the Motor Vehicles Act, the individual who gets that compensation is not liable to pay tax on the compensation or the interest thereunder. Or where anybody else is getting this compensation concerned, any other person is getting, then where the interest amount on the compensation does not exceed 50 lakhs, you're not required to do any withholding of tax. So when these are the exempt situations concerned, technically when income is not chargeable to tax, there's no question of any withholding of tax obligations concerned. But when you're making a payment to a third party where the interest is less than 50 lakh rupees, then you're not liable to withhold tax at source, and that is incorporated into 393 subsection 4, which contains a list of situations concerned where there is no requirement of withholding tax at source. So compensation paid under the Motor Vehicles Compensation Act. Then you're also having interest on securities being paid to a banking company, which is an interest other than interest on securities. When you're making a payment of interest to a banking company, you're not supposed to withhold tax at source. To that list of banking company, they've added a case of a cooperative society involved in the business of banking. So when an interest is paid to a cooperative society, which is involved in the banking business, you're not supposed to, you shall be not obliged to deduct tax source, is a clarification given. One situation that the board has contemplated and explained in the memorandum is that there are small investors concerned who are having multiple folios of listed securities, maybe bonds, maybe securities, maybe units, maybe shares. They're holding it through a depository, and these are all listed. So when they have interest received from, or the dividend received from the various companies concerned, they are required to comply with the issue of furnishing the 15G and 15H to so many companies concerned. So to obviate their difficulties of complying with the requirements of giving to so many companies concerned this declaration, a facility is now proposed to be added that these people who are holders of these securities, who are the recipients of incomes concerned, they may give this declaration to the depository, and it will be the depository's obligation concerned to make or forward the declaration to various companies concerned. So a centralized way of making a 15G or 15H to a depository is a facility being extended to people concerned, and these are people who are able to give a declaration that the income, that the tax payable on the income received on the securities concerned is going to be nil, and that can also be given only in situations where the income from the concerned security is less than the maximum not chargeable to tax. So a facility therefore has been extended that you may give the declaration of non-deduction of tax at source to that depository, such that the depository will then onward give it to the company concerned, and when it is so given to the company, that company which receives the declaration, technically it's an alternative. It's no mandate that you should only give it to the depository. It may be a situation that you may be giving it to the company or you may be giving to the depository. When it goes to the depository will be obliged to give it to the company concerned. And this company, when it receives the declaration from either the individual or via the depository, it has a time limit for forwarding a copy of that declaration to the income tax department. That time is sought to be extended. Now the new time that is proposed is that you get the declaration from the depository or from the investor concerned on any particular date, which may be falling within a particular quarter. So you can await the end of the quarter concerned, and the 7th of the following month shall be the last date for forwarding the declaration to the income tax department. You can also make an application for a lower TDS. That is the provision under 197, make an application to the assessing officer. If he's satisfied that your income justifies nil reduction of tax or at a lower rate, he may issue a certificate to you based on the income position. The facility that's proposed now is to make a statement that you can file an application online, electronically, to the prescribed authority. They're going to therefore have a prescribed authority to whom a format shall be prescribed, and you can make an application electronically to the prescribed authority for the purpose of receipt of a certificate for lower deduction of tax at source or nil rate of TDS. This authority, which has now been so designated, will be able to scan through electronically all the information that is prescribed and grant you that lower TDS certificate unless it finds that the particulars are incomplete, that the form is incomplete, or the particulars that you are mentioning in the form does not justify, do not therefore inspire confidence in the authority concerned to give you a lower TDS. So there is therefore an alternate mechanism that you make an online application to a prescribed authority, the form is yet to be designed, and the board is saying that this will facilitate and ease out the application being made to get a certificate in a faster manner for a lower deduction of tax at source. You then have section 397, which talks about some compliance and reporting purposes, where you are required to have an application for TAN in particular situations, and there is in section 397 a table that is given to say that in the following circumstances there shall be no requirement of obtaining a TAN. The PAN of the payer itself is going to be sufficient for him to comply with the TDS obligations. Number of illustrations are already there in the statute concerned. For example, if you're covered by 194 IB, you're making a payment of rent of more than 50,000 rupees by an individual who doesn't get covered under 194I. 194 IB will say there is a rate of TDS to be done. For that discharge of TDS under 194 IB, you're not supposed to obtain a TAN. You can discharge the tax through your PAN itself. Similarly, under 194M, also a situation where you can comply with the provisions by using your PAN. One more situation that is sought to be added is that when you're making a payment to a non-resident for the purchase of property from the non-resident concerned, you shall make the payment of the TDS. That is, when you're buying a property from a non-resident, you're making a consideration to him. You're supposed to comply with the TDS obligations concerned. When you're doing so, you may comply with the TDS obligations under your PAN number. There is no need for you to obtain your TAN number. The board is saying that this is to draw a parity. When I'm making a payment to a resident concerned for purchase of property, I don't have to obtain a TAN. So when I'm making a payment to a non-resident, I may have therefore a similar facility being extended to me by making a statement that you shall not be required to obtain a TAN. The existing PAN shall be sufficient for you to comply with the TDS obligations concerned. 399 deals with the processing. They're saying now that while doing the processing, the fee that is payable under 428(1) and 428(2) of the Income Tax Act shall be taken into account for the purpose of processing the returns concerned. Section 400 deals with the power of the central government to come out with guidelines for the purpose of giving effect to the provisions of this entire chapter concerned. And the existing provisions talk about that these guidelines that are issued by the central government shall be laid before the House of Parliament. There's no clarity in terms of the actual binding impact of these guidelines concerned. So they're now proposing a change to section 400 to say that the central government, yes, will have the power to prescribe guidelines for the purpose of removing the difficulties in implementation of this chapter concerned. These guidelines will be binding on the tax department as also on the person who is supposed to comply with the TDS obligations concerned, and these rules therefore shall be also laid before the Houses of Parliament. So the binding nature of the guidelines concerned is now a condition that is proposed to be introduced by an amendment to section 400. In 402, there is a definition to the person responsible for paying when they're making a payment in foreign currency, not a very significant amendment. What's important under 402 is under subsection 47, there is a change under 194C when you talk about a works contract. What do you mean by a works contract? The definition of work is sought to be amended by making a statement that payment for supply of manpower, when that manpower is going to work under the control, instruction, and supervision of the person to whom the supply is made, that will be regarded as a work. Now, this is an interesting amendment for the reason that if you look into 194C, as it is, we talk about where a payment is made for the work, including supply of labor for carrying out any work, is the language of section 194C. So a supply of labor for the purpose of carrying out a work is already a work, is already a subject matter of deduction of tax at source under 194C. To that, they have now added by specific mandate or a specific reference in the definition of work to say that a supply of manpower to a person concerned where the manpower is going to work under the control, instruction, and supervision of the person to whom the supply is made. Even this supply of manpower is going to be termed as work. Now, this is because there is under 194J, fees for technical services has a 2% of withholding. On 194C, you may have 1% or 2% depending on the category to who of the nature of the payee concerned. It may be 1% in particular situations or 2% in particular situations concerned. If you go to 194J, it talks about payment for technical services. That technical services draws this definition from 917. If you go into 917, it says technical services, fee for technical services shall include payments towards managerial, technical consulting, and within brackets, including provision of the services of technical or other personnel. So, provision of the services of technical or other personnel was satisfying the definition of FTS, and once it was FTS, it went through 194J. When it went to 194J, you're obliged to do TDS under a 2% concern. They're saying that there is some confusion, that the memorandum says there's some confusion as to what shall be the exact rate of tax, and to clarify that, they're now making a statement that supply of manpower shall be called as work liable for withholding of tax under 194C. How would it impact the treaty concern? Because there is no, you're trying to carve out the supply of manpower out of fees for technical services and call it as a work. This may not have much of implications or ramifications under the treaty because most of the treaties have a specific definition of fees for technical services, and therefore this definition of the Income Tax Act should not have an impact on the understanding of the treaty definition of fees for technical services. The aspect of secondment, the aspect of deputation, all this, therefore, if they're called as supply of manpower, may possibly be called as works contract. Therefore, we may have a situation where the TDS obligation, if you're going to be the domestic law, may undergo a change. If you have a payment to a non-resident concern, possibly you may have a situation where you have to go back to making a statement. This may not be fees for technical services, fine. But because it is a payment to a non-resident, it may not have 194C applicable. Let's go back to the treaty rate to find out. 115A may not be applicable. Let's go back to the Finance Act to find out at what rate the TDS shall have to be done. Although the TDS rate may be different from the ultimate tax liability, it may not make any impact in terms of the ultimate clarification or classification concern, because if the treaty is invoked by the person concerned, he may then ultimately say, this is fees for technical services under the treaty, and therefore possibly under the Act, I may have to go by the governing classification under the treaty, and therefore accordingly, I should find out the rate of tax by applying or invoking 115 capital A for the purpose of understanding the tax liability on these aspects concerned. Some portion Chythanya is talking about the entire aspect of penalty, waiver, all of that. There is a provision under 411 or a provision under 220 subsection 2. 220 subsection 2 is the way we'll discuss. What is discussed for 220 subsection 2 will also be relevant for a parallel section 411 of the 2025 Act. 220 subsection 2 says, or subsection 1 says, where a demand is raised against an assessee concerned, he shall be obliged to pay the amount within 30 days of the date of service of the notice of demand. If he does not pay that, then he'll be called as an assessee in default, and there could be a trigger of interest under 220 subsection 2. If this matter therefore is taken up in appeal, then 220, the proviso to 220 subsection 2, the first proviso and second proviso make a statement that if the amount is increased or decreased, if the amount is decreased tomorrow, in the first appeal order, for example, then the interest amount shall accordingly be reduced or increased. If this amount which is now increased or reduced is restored or enhanced by a further appeal authorities tomorrow, then you'll have to go back and calculate the interest on the increased amount from the date on which 220 subsection 2 interest was leviable. To this concept of 220 subsection 2, they're now making a statement that if there is a penalty that is leviable under 270 capital A or under 439 of the 2025 law, that penalty now may be imposable either for underreporting or for misreporting. But if there is a penalty order that has been passed, then you shall not be liable to pay interest under 220 subsection 2 up to the date of passing of the first appellate order under 250, or if the matter has gone via the DRP, then up to the date of passing of the order by the tribunal under 254. So there is a sort of a bar on the charging of the interest by the AO after 1/3/2026. I'm making a statement 1/3/2026 for the reason that this law comes into force with effect from 1/3/2026. If you look into the memorandum, it says this law comes into force with effect from 1/3/2026, but shall be effective from 1/4/2027. It shall be effective from 1/4/2027, indicating that you shall therefore have some sort of a common order for penalty and assessment being passed. Even under the old act, under the 1961 act, common order is going to be passed from 1/4/2027 onwards only. Till that time, there could be a possibility of split orders, one being an assessment order, one being a penalty order. Therefore, there is a very interesting statement made that this law comes into force on 1st of March 2026, but shall be effective from 1/4/2027. This gives rise to an interesting question. Take two cases now, that a penalty order is already in force, it's already available. For some reason, the SSC has not paid the discharge the penalty. Because he has gone an appeal, he has asked for a stay of the collection of demand. Either in part or in whole, the stay order is in effect, therefore he is not required to discharge the penalty amount. He will be liable to pay interest under 220 subsection 2. But then from 1st of March 2026, this interest cannot be levied, and therefore the interest meter has to necessarily stop on 1st of March 2026. This will continue till the time the first appellate authority passes the order concerned. So at that point of time, you may therefore say the interest is now going to be triggered back if there is any demand that is payable by virtue of the appellate order. This is one situation. Take another situation, that the assessment order has been passed. Now the appellate order, this is for the period, let us say 2023 assessment order has passed a couple of years. It took some time for them to complete the penalty proceedings. The penalty proceedings have culminated now, and the AO is required to pass an order of penalty today. But when he now passes the order from 1/3/2026, is he now permitted to levy this interest at all? He is precluded from levying this interest, because the law would say that from 1/3/2026 onwards, the AO is not empowered to levy interest at all. Therefore, his power to levy interest itself is taken away. The very basis of the authority to levy interest under 220 subsection 2 is taken away. Therefore, he will be precluded from passing the order concerned. So in relation to orders that have been passed, interest meter will stop on 1st of March. For other orders concerned, AO shall be precluded from passing an order levying an interest. There shall be therefore no authority upon an AO concerned to levy interest on this matters. Now, if that's the situation concerned, if that's the situation, there'll be a very interesting aspect of, there could be two elements of demand that may be against an SSC. There could be a 143.3 order on which the interest is continuing to run. There could also be a penalty demand on which now the 220 subsection 2 would say that there shall be no interest that shall be leviable on this penalty aspect. So one interest will continue to run, 143.3 will continue to run. The interest on 220 penalty only will stop. If that's the position, if penalty therefore is, the interest is to stop, could there be recovery proceedings that have to be held in abeyance or they can continue? The mere non-levy of interest for the period post 1/3/2026, does it put the entire recovery mechanism on hold? Does it bar the AO from therefore proceeding to collect other portions of the demand through the mechanism available to him under the recovery proceedings? Technically, only interest is stopped. There is no question of a bar on the recovery proceeding that the AO can therefore start or initiate for the purpose of recovery the demands against an SSC concern. We have already seen at 220 subsection 2 where the demand is varied in the course of the first appeal and again further varied up and down. The interest has to be worked out accordingly. But then this portion of the period, if it is referable to a penalty, there's no question of interest being levied after 1st of March 2026, and therefore to the situation of penalty and interest thereunder, the first proviso and the second proviso to 220 subsection 2 may not be of any effect at all for the reason that AO is disempowered from levying a interest under 220 subsection 2. We've already discussed, Chaitanya has discussed the aspect of set-aside aspects. What happens when the penalty matters have been set aside? And therefore, you are now having a fresh order of penalty being levied. What will happen to those situations concerned? If penalty is set aside, the original demand goes, nothing can happen. There couldn't have been any interest being levied by the assessing officer from 1st of March 2026. Therefore, in a set-aside proceeding also, if there is a set-aside proceeding where the penalty is confirmed and demand is raised, no 220 subsection 2 interest is possible for the reason that interest under 220 subsection 2 can only be levied post the period of order being passed by the first appellate authority, being the case of the CIT under 250 or the tribunal 254 when the matter goes to the tribunal via the DRP. Chaitanya also already made a point that whether the DRP can therefore do or give a finding on the aspect of penalty itself, whether it's possible, because the DRP can confirm, enhance, reduce the variations concerned. Variations generally are in relation to incomes. When talking about variations to incomes concerned, we all believe that till today the DRP had no power to get into the aspects of penalty because they're only looking at variations concerned. We'll have to possibly read 144C a little more closely and little differently for the reason that if anything that is dealt with in the draft order concerned, then that gives the ability for the DRP to deal with the portions or the aspects of the draft order concerned, which order possibly should also include the order referable to the penalty portion, and therefore the DRP should now henceforth be held to be entitled to therefore give its finding on the penalty portion concerned. Our understanding to say that the variations that are discussed are only variations to income concerned, and DRP therefore is precluded from discussing the aspect of penalty may not necessarily hold good if we were to now make a statement that the DRP should give its finding and the matter should reach the tribunal for the purpose of the triggering of the penalty itself or the interest on the penalty. These are the points as far as the TDS and TCS is concerned. We'll now go back to Chaitanya for some other portions of the Yeah, one portion of TCS has to be dealt with. I forgot to deal with that. TCS, wherever the rate of TCS was high, they have reduced it. Wherever the rate of TCS was low, they have increased a little. The impression by virtue of the entire finance bill is that they have reduced the rate of TCS. No. Where there is a sale of scrap, TCS was 1%, they made it 2% now. Alcoholic liquor sale of rate of TCS was 1%, they made it 2%. Sale of some minerals like coal and iron ore, the rate of TCS was 1%, they made it 2%. In other situations concerned where the rate of TCS was high, they have reduced the rate of TCS to 2%. For example, the most two important aspects are when you are having a payment made under an LRS scheme for the purpose of overseas education or overseas medical treatment, you are having a particular rate of TCS at 5%, they have made that 2%, but you're going for some other reasons other than education or for treatment, medical treatment, the TCS is at 20% that continues to remain as it is. When I'm making a payment towards an overseas tour package, the TCS was 2%, was up to 5% up to 10 lakhs of amount, and was 20% beyond 10 lakhs of amount. Both these 5% and 20% have now been brought down to 2% concern. So whatever be the amount paid under the overseas package, once it crosses 10 lakh of rupees, regardless of the purpose for which this TCS amount has been spent, the TCS rate has now been brought down to 2%. These are certain changes to the TCS provisions concerned. Yeah, with this we'll have completed the TCS and the TGS portions.
I'll be doing now. We will not be dealing with cooperative societies. That would take some time, and considering the time available, and we'll have to close not beyond 6:30. So therefore, cooperative societies we would not be doing. Prosecution also we may not be doing because we have two important topics now. One is 292BA amendment and section 522 DIN. We'll have to deal with that, that's very, very important. And then we'll have to do the FAST, foreign assets, FAST and what? DS, disclosure scheme, FAST DS 2026. Then a couple of amendments to Black Money Act that would be very important towards decriminalization. Thereafter we have couple of very important topics which Mr. Padam would be dealing. These are your specified data center. Specified data center is one. The other one is providing plant and machinery to an electronic manufacturer. So these are two very important topics. So those have to be discussed. With that we shall plan to wind up. Now we'll go to 292BA and the corresponding section 522. Very interesting way of making amendments. 292B, you are aware, it says no notice, no assessment, no communication shall be considered as bad merely because there is some mistake, defect or omission, as long as it is in accordance with the purpose and intent of the Act. Now, they issued a DIN circular, circular 19 of 2019. wherein the circular stated that there has to be a generation of electronic generation of document identification number. Document itself shall have to be electronically generated and electronically communicated. It has to be generated in the portal, and communication also will have to be electronic. Then they gave some exceptional circumstances in paragraph 3, stating that where it's in those circumstances not possible to comply with DIN, the circular, then with the prior approval, by stating the circumstances under which he is now issuing the document without the DIN, he may do so, but it has to be backed up by a DIN communication. So this is how, Circular 19 of 2019 worked. In fact, this was referred to in an indirect tax matter in the Supreme Court, and department proudly stated in the Supreme Court that, look, the kind of transparency we are trying to bring in, and the circular was referred to. They were commended by the Supreme Court for this, and they issued a likewise circular in the indirect tax, which they withdrew later on. See, the whole objective is well intended, that you cannot have either assessee's side or assessee's instance or department's own instance creating documents. So there has to be a trial of all documents so that there is transparency, at least to that extent. And we will actually compliment the Finance Ministry for not withdrawing the circular even now. Circular still is in force and not withdrawn. That's a good thing. Otherwise, it would have been easy for them to simply withdraw the circular. At least going forward, they would not have any problem, but it seems the Finance Ministry itself thinks that the circular has to be there. So that's why they do not want to have the circular withdrawn. They want to save the assessments, which have been passed on the basis that the DIN has not been properly referenced in the assessment order. To that effect, they have brought out an amendment to 292BA. Now let's read what is this 292B about. Again, standard conversation is notwithstanding anything contained in any judgment. So how many have we found today? 92C, A, 3AA. Then we will have 4 instances in 144C, 5. Then this is the 6th one. So we'll have at least half a dozen cases where they are trying to undo the judgments. Now, notwithstanding anything contained in any judgment, etc., for the removal of doubts in their own minds, it has to be read. It is hereby clarified, for the purposes of section 292B, this is the extreme limiting factor of this section. If you argue 292B would not apply, this section should go. For the purposes of section 292B, no assessment under any of the provisions of this act shall be invalid or shall be deemed to have been invalid on the ground of any mistake, defect or omission in respect of quoting a computer-generated DIN if the assessment order is referenced by such number in any manner. So what are they trying to say? No assessment under Income Tax Act shall be invalid. No assessment shall be invalid if there is any mistake, defect or omission in respect of quoting the DIN, computer-generated DIN, if the assessment order is referenced by such number in any manner. By merely reading this, what we would understand is a few things. Firstly, it will only validate the assessment, provided assessment order is referenced by computer-generated DIN in any manner. That means there has to be a referencing of DIN insofar as assessment order is concerned. This would not save the notices under 143(2), under 148A, under 148, the satisfaction notes, the DRP directions, the approval sanctions, etc., maybe under 151 or under 153D or under 148B, the transfer orders under section 127, the penalty orders, the orders of Commission of Income Tax Appeals, none of these is saved. Revision orders under 263, revision order under 264 if it is adverse to me, not otherwise. CIT appeals orders if it is adverse to me, otherwise I will not challenge it. Now, these are not saved. Assessment is saved, provided assessment order is referenced by DIN in any manner. So this is the first impression you get on bare reading of section 292 capital B. Now, it would not say situations where you have not generated document electronically, because as I said earlier, DIN circular is misunderstood as simply requiring quoting of DIN. No, read the circular carefully. It would require document to be generated electronically, DIN to be quoted on the document, it has to be communicated electronically. These are all the requirements of the DIN circular. All these are not saved. All these are not saved. And if there is a mistake or defect or omission in quoting the computer generated DIN, it would not say the requirement of having to comply with paragraph 3 of the circular. That has to be complied with. Circular still remains. Para 3 of the circular also still remains. Those requirements cannot be dispensed with. Then the language is computer assessment order is referenced by DIN in any manner. If you just read this, it looks like there can be a document without DIN, then there can be a separate communication, provided para 3 is complied with. Is that saved here in these words? Look at this. Assessment order is referenced by such number in any manner. So, assessment order without DIN is issued today. Tomorrow will come a DIN intimation letter saying that for today's assessment order, DIN is going to be this. It looks so if you read the ending words of this particular section. It is referenced in any manner. It need not be quoted in the body of the assessment order, is how it looks like. But look at the memorandum. If you see the memorandum, as long as there is a reference of DIN in the assessment order. Look at this. Memorandum says as long as there is a reference of DIN in the assessment order. So, in order for them to come under the rescue of 292B capital A, it is mandatory that the DIN has to appear in the assessment order. In all the cases which the department has lost, DIN does not appear in the assessment order. I do not know how, on the basis of their understanding, that they are going to save themselves from this. So, minimum standard for 292BA to kick in is the DIN is mentioned in the assessment order. That is what the memorandum says. Now, very interestingly, circular is with effect from 1/10/2019. This particular section 292BA is effective from 1/4/2026. On that day, Act only is not there. How can they bring in 292BA with effect from 1/4/2026 to a repealed Act? Act is not there. And how will they override the judgments? You go to the court, court will say what was the law then existing? There was no 292BA. Assuming insertion of 292BA from 1/4/2026 is valid, assuming. It is only brought in from 1/4/2026. It did not exist when the court gave the order. How can the court order be negated now? Court order cannot be negated. Court's decision continues to be same. Even now, if you go and challenge an assessment order passed prior to this date without DIN, department cannot take shelter under 292B because it will not exist then. Well, the memorandum says it effects from 1/10/2009. Finance bill says it is existing from 1/4/2026. Now, there is another problem in the memorandum. It says the orders are quashed by the courts on specious grounds. Can IRU say so for the court order? That the court has held against me on specious grounds, it will amount to contempt. So first thing they need to do is to correct their memorandum. So they cannot say the court has held in favor of taxpayer on specious grounds. That will amount to interference with the administration of justice. You can't do that. It's not a constructive criticism of the judgment. So these are the orders which according to us are not saved. So there's an amendment similar to that brought in 522. So anyway, most of which we have discussed, except that some of the problems of effective date would not apply to section 522 because it's an act yet to commence its life. Now with this we will now move on to quickly the FAST scheme. Foreign Assets or Small Taxpayers Disclosure Scheme. This is an important measure, and before I go into this, I'll just discuss two amendments to Black Money Act in terms of section 49 and 50 of the Black Money Act are sought to be amended by section 144 of the bill. See, the difficulty in the Black Money Act is the prosecution. White money not disclosed will also put you to jail, meaning you have a foreign asset, earned through legitimate means, even when you were a non-resident or when you were a resident from disclosed income. Later on, when you became a resident, in your return of income, there is a box called FA, foreign asset. You will have to disclose. If you don't do it, you are liable to be prosecuted, because we are fighting cases in the tribunal where additions made are 10 shares held in Panama Islands. Company is defunct. Some information was received from Panama leak. 50,000 is added under the Black Money Act. He could not have valued it also under the Black Money Act and the rules. It's difficult to value in respect of shares that became defunct even before the Black Money Act came into existence. But nonetheless, he took the trouble of valuing it at 50,000 rupees and went ahead and passed an assessment order. We lost the Commission of Income Tax Appeals. Now we are before the tribunal in respect of this. And I have huge income to support this. Now why are we fighting for 50,000 rupees for a person who owns hundreds of crores? Because we fear prosecution. Otherwise, we would have just paid this tax and we would have forgotten this. Now, they have amended 49 and 50, which otherwise would have put you to bar, not the one which we seek to go in the evening after this session. Even if you miss disclosing the foreign asset, there they have brought in provisos to say that provided further that this section shall not apply in respect of asset or assets, brackets, other than immovable property, where the aggregate value of such asset or assets does not exceed 20 lakh rupees. So in all the cases where the foreign assets not disclosed do not cross 20 lakh of rupees, there is not going to be any prosecution. I do not know when they have a small limit of 20 lakh of rupees, why have they excluded real estate? Even in, like far off place, even in a village, 20 lakhs for land is, is nothing now. So in a foreign country you are owning land, value of which would definitely be, unless you own it somewhere in Bangladesh at some corner, otherwise, in all other situations, 20 lakhs is too small a limit. They could have graciously included immobile property as well, because anyway, they wouldn't have had any great difficulties here. That is one aspect. So no prosecution. Now let's go to the foreign assets of small taxpayers disclosure scheme. It's a very, very important scheme which will have to educate our clients. See, there are many of our genuine clients who are non-residents, who would have kept some of their assets abroad like pension money, etc., would have come and become residents and would have not disclosed it in their foreign assets column. In fact, we had situation of prosecution where foreign asset is disclosed in TA, that is total assets, but missed out in FA, foreign assets. Prosecution was launched. Asset is disclosed in the return, but not under the column FA. So we have these situations. Now let's see how it's going to help. See, under this scheme, if you go to, there are a lot of definitions, let's not bother much about it. Just to be quick, you go to the table. Look at this. There's a table which is given beneath section 117 of the finance bill. Let's look at column 1 here. You may have undisclosed asset located outside India. Undisclosed asset here means not the asset where you have a source but you missed out reporting it. It's an asset you are unable to explain the source of it. It is not only undisclosed, it is black asset. So there's a difference between white asset but not disclosed. That can't be called as undisclosed asset. Undisclosed asset under Black Money Act is an asset which are not disclosed and you don't have source to explain it. If you have such an undisclosed foreign asset or you have undisclosed foreign income, then the aggregate value of undisclosed asset located outside India and undisclosed income does not exceed 1 crore rupees. It should not exceed, that's the condition. Aggregate value of undisclosed asset located outside India and the undisclosed foreign income does not exceed 1 crore. If it exceeds 1 crore, you will not get the benefit of this. Then what you have to do? You have to pay tax at 30% on the undisclosed asset, tax at 30% on undisclosed foreign income, then 100% of that again. Then if you do it, no penalty, no prosecution, nothing. So it is essentially meant for those who have had small assets which are undisclosed and they are unable to explain the source of it, or they have had foreign income which has not been disclosed in their IT returns and would have become part of black money under section 4 of the Black Money Act. So those cases where it wouldn't cross in aggregate 1 crore of rupees can come clean by paying 30% either of the asset or of the income or of both, and an equivalent amount as penalty. If you do it, then you are through. This is one case. This is a case of clear black money. Now let's go to a case of an asset which you have acquired from overseas income. An asset acquired by you from income that has accrued or arisen to you overseas when you were a non-resident. So you were not anywhere liable to pay tax. That means source is legitimate. Source is legitimate. You acquired it when you were a non-resident from income from sources outside India. Later on you become a resident, but you failed to disclose it. So your asset is not black asset. It's white, but somehow you are misreporting it. As I have already indicated earlier, 49 and 50 have now been amended not to prosecute you if it would not exceed 20 lakh. Now here you get a better window to report it now. This is one situation. You are a non-resident, You had income from abroad, not liable to pay tax, acquired an asset, right royally, but when you came and became a resident here, by inadvertence, not disclosed it in your return. One situation. Another situation is where you have an asset located outside India from your income which has been offered to tax in India. White money used in acquiring a white asset, but not disclosed in the return. In these two cases, you can pay one-time fee of 1 lakh of rupees, provided value of the asset located outside India does not exceed 5 crores. It should not exceed 5 crores. So larger the family, better the spread. 5 in the family, 25 crores. This is something which will have to educate our clients, particularly those who have been expats, who have been there, who would have returned here, would have had some incomes, some assets not disclosed, still kept their pension funds, still kept their retirement benefits, some assets kept there. For all these people, it would definitely make sense to now come and disclose it. The limit is 5 crores, pay an amount of 1 lakh of rupees, you are done. So this is one of the wonderful and the most welcome amendments which have been proposed, which will definitely help people come clean. So with this, we'll move on to Mr. Padam for some amendments which are made to the schedules.
Schedule 3 is amended. Disability pension has been added, that the person who has been working in the military or paramilitary forces, where he has been technically asked to quit his job for the reason of the physical disability or the expansion thereof, the aggravation thereof, the amount of disability pension received, including the service component and the disability component, is going to be exempt by virtue of a new item 38A being added to Schedule 3. We've already seen the interest and compensation of the Motor Vehicles Act being exempted under 38B. 38C talks about compensation under the Right to Fair Compensation Law for the acquisition of a property concerned. That award and the amount received under the award shall be exempt under the item 38C to the 3rd schedule. The more important aspects are in the 4th schedule, which talks about 3 types of incomes for a non-resident being exempt from tax in India. And the entire setting becomes interesting for the reason that the first exemption talks about where a non-resident overseas company, foreign company, is giving capital goods, is giving capital equipment, or is giving tooling to a person who is in India, which is an Indian company, which is involved in manufacturing of electronic goods. In that situation concerned, that person who is in India, which is an Indian company, is located in a particular customs area. In that situation, the Indian company, which is going to be the contract manufacturer, produces the electronic goods on behalf of the foreign company. So the foreign company gives the capital goods, gives the equipment, gives the tooling. Ownership is mandatory to be remaining with the foreign company. But the operation, control of these items concerned shall be with the Indian company only. If that is the position, that means the overseas company only has given those assets concerned, technically on a lease, and it doesn't have any control in terms of the operation of the equipment concerned. The control and direction is therefore with the Indian company. And the location has to be in a particular jurisdiction, being the customs bonded area under Section 65 of the Customs Act 1962. And the contract manufacturer who is involved in the electronic manufacturing is now doing it on behalf of the foreign company concerned. An exemption shall be available up to 2030, 2031. Now, what shall be the income of the foreign company by virtue of giving the capital equipment to the Indian manufacturer? And who is the Indian manufacturer? The contract manufacturer. If you look into the finance minister's speech, it's called as a toll manufacturer. Toll manufacturer means technically who manufactures according to the control, supervision, and direction, where even the critical materials for the purpose of manufacture are supplied by the person who is sending the equipment. The technology belongs to the overseas fellow technically, equipment belongs to him, raw material supplied to him, only conversion happens by the Indian entity, and for the conversion, charges are paid by the overseas entity. The question of an income being earned by virtue of the facility of so extended, the income can only happen after the goods that are manufactured are sent back to the overseas entity and those sales are made overseas. But when those sales are made overseas, could any portion of the overseas income be held as taxable in this country concerned? That's the question. If there can be so said, then only there is a meaning for this exemption given or being extended to the foreign company concerned. So I repeat again, foreign company sends the equipment, gets the goods manufactured, pays the conversion charges, gets the goods outside and sells them outside. The income to the non-resident would be exempt from chargeable tax in India. One way would be that I am giving the equipment concerned, therefore I am technically entitled to get rent. I am entitled to get a royalty, because equipment royalty is now chargeable to tax deemed to arise under 916 explanation 2. But the question is this a case where you're giving it as a technology or equipment to whom? Not to a third party, to a person who is a toll manufacturer. You don't expect royalties, therefore, to be earned from a toll manufacturer. He is working under your control, under your supervision. There's no question of he using this technology or equipment for any beneficial manner of his own enjoyment. He is working solely devoted to you, and the question, therefore, of royalty should not arise in these situations concerned. So the aspect of royalty income is ruled out, and technically, even otherwise also, this royalty income is subsumed into the manufacturing, the conversion charges that is paid to the Indian entity. So largely, therefore, only a direct outflow of expenses happens from the foreign entity to the Indian entity. If there were to be, therefore, a goods taken back to the foreign place or foreign country and there are sales outside, would those sales be chargeable to tax in this country? It can be possibly if the Indian entity were in some manner liable to be taken as constituting a permanent establishment of the overseas entity. Would there be a permanent establishment? The law says that the equipment belongs to whom? The foreign company. So the equipment belongs to the foreign company, but it is under the control and operation of the Indian company exclusively. So the foreign company doesn't have a right of operating. Therefore, the question of an equipment fee cannot arise. One. Two, there's no question of a direct fee at all, for the reason that the Indian company is not in any manner representing as an extension of the foreign company. There is no right of disposal available to the foreign company on the Indian company's premises. Therefore, there's no question of a permanent establishment in its normal sense. Could there be a DAPE? Could the manufacturer here be called as a dependent agent permanent establishment? If you go into explanation 2 to section 9, where the Indian company should be having the authority to conclude contracts, doesn't happen. Therefore, he is also not exercising the authority to conclude contracts, doesn't happen. It therefore secures order. No, it has a stock of goods from which it regularly delivers to other people concerned. The stock of goods is there after manufacturing, but not delivered regularly to outside, given back to the manufacturer outside, or the foreign company outside. So it can't be therefore called as a delivery to a third party, delivery back to the person who has supplied the equipment concerned. So the aspect of DAPE on account of storage of goods from where there is a regular delivery to a third party, that test will not be satisfied. The Indian party does not secure orders regularly on behalf of the non-resident company. Therefore, there cannot be a DAPE on this count also. The only thing that can happen possibly is a case of an SCP. The transaction of goods and services between the non-resident and the Indian company can possibly give rise to an SCP, provided the value of the transaction crosses the threshold as prescribed by the government concerned, that threshold is a low threshold. Therefore, they could possibly be in existence an SCP. But then SCP becomes some sort of a limited factor in most of the treaties because we have a treaty concept of a permanent establishment. Therefore, the concept of SCP is to be ignored. That were to be the proposition concerned, the non-resident does not earn any income from out of this arrangement concerned. If that's the position, then to make a statement that the non-resident is being granted an exemption on this count is a statement that remains in the books but not have practical reality or a practical application concern. There is also a statement made that there will be a safe harbor rule that the contract manufacturer, if he has a margin of 15%, then there will be a case of the results of the Indian company being accepted. That's provided there is an A relationship between these two of them. If there's no A relationship with a third party concerned, to say that there's a A relationship to have a safe harbor may itself be a contestable aspect itself. Therefore, only if the Indian company were to be some sort of a subsidiary of the overseas entity, then you will have a situation where you will call the two parties as related parties, and therefore the safe harbor mechanism of 15% margin will then be of some benefit to the Indian entity. Otherwise, therefore, the question of this working in some sort of a manner that they're going to encourage trade. I understand the government is trying to encourage electronic manufacturing. A good thrust has been given to it. But then the way in which you could have attracted either talent or investment concern could have been a better way than having a situation where in reality there's no income that is going to be earned by the non-resident, which is otherwise chargeable to tax. And if there's not otherwise chargeable to tax, to extend the benefit of exemption to that non-resident may not have any validity in terms of the practical utility of this provision itself. There's also a situation where there is a scheme where you want to involve the technicalities, technicians outside coming into this country concerned. And when you have, therefore, a scheme, when you want these people to come into the country, they are likely to become residents because of the physical presence in this country. When that happens, their overseas income will become chargeable to tax, and therefore the government is saying, we will encourage these technicians to come into this country. For a period of 5 years, we will not charge their overseas income, although they have been in this country for a long period of time to qualify as a resident. But for that condition to happen, before the non-resident comes into this country, he should have been a non-resident as far as for a period of 5 consecutive years before he came into this country. If that were to happen, and it is coming under a scheme that the central government notifies, then for a period of 5 years, from his date of entry into this country, overseas income of that individual will not be chargeable to tax. He is going to get an exemption. We had similar exemption for technicians under 10(6) capital A, 10(6) capital B, all the sections were there, and some sort of a reincarnation of those exemption is coming back in the form of this 13B. 13C is again a very interesting proposition. We'll have therefore questions as to the exact purpose of this exemption. Will it serve any useful purpose at all? So we had some moment of discussion on this matter. I'll therefore give the outline and then possibly give certain ramifications of that. A situation where income is going to be exempt if it is by way of procuring data center services from a specified data center. Non-resident, which is notified by the central government. So first thing should be, a non-resident should be notified by the central government. That should be involved in procuring data center services from a specified data center. Therefore, if there is income by way of procuring data from data center services from a specified data center, you're going to get an exemption under 13C. This income, therefore, shall be deemed to occur arise in India or shall be actually arising in India. From what? From the act of, by way of procuring data center services from a specified data center. Now, will this act of procuring data center services itself give rise to an income? It's actually a case where I'm going to incur an expenditure to procure this data center services. This does not give rise to an income by itself. Therefore, you come back to a larger question. If this transaction or this act of procuring data center services does not give rise to income, then what is the fun of this exemption? Possibly, it has to be linked to some other collateral transaction and therefore have to examine the collateral transaction as to what could be the circumstances under which this exemption may possibly have some meaning. Otherwise, by itself, income by way of, now the word by way of is a direct income, cannot be an indirect income. The word by way of refers to something that is directly emanating from the aspect of what? From the activity of procuring data center services from a specified data center. What do you mean by the specified data center? The specified data center should be owned by an Indian company which is also notified by the government. This specified data center should be involved in particular type of activities. Now, there's a data center which is a dedicated secure space within a building, centralized location where computing, networking equipment is concentrated for the purpose of collecting, storing, processing, distributing, or allowing access to large amounts of data. So, the data center in India will be involved in the aspect of collecting data, processing data, warehousing data, distributing data, allowing access to data. Allowing access to data. This possible we were discussing to say that there could be a situation where a foreign company wants to establish and move its data center operations into this country. A foreign company, may take any big multinational, it wants to therefore move its data center operations to this country, therefore establishes a subsidiary, makes an application, gets the foreign company recognized by the government, notified by the government, gets the Indian subsidiary also recognized by the government concerned, and this Indian subsidiary is now involved in the activity of collecting, processing, warehousing, distributing, and giving access to data. So now a lot of computing work therefore is happening at the premises of the Indian entity. If this were to be a situation where a lot of activity of data is now happening or relating to data is happening under the India center concern, and the overseas company may then advertise to the world at large, hey, look here, I have some very wonderful computing facility available with me at a particular location in India. Come to me. If you were to come to me, you can therefore pose your questions, pose your theory, pose your answers, pose everything that you have as a problem, get a solution out automatically in a very efficient manner, and you'll be therefore able to pay the overseas entity for, when the overseas entity therefore poses the question, or gives us data for wanting an answer, that is downloaded to the Indian entity. It does therefore the access to all those data it has computing abilities, it's able to give a solution, as a result of which the overseas entities gets remunerated from the third-party clients concerned. The foreign company gets remunerated from the third-party client, and therefore the question then arises, when the foreign company gets income from a third-party client concerned for the purpose of solving the problems, and that solving the problems is happening as a result of reliance on the data that is available, the computing ability that is available at the India subsidiary concerned, would any portion of the income earned by the foreign company outside be referable to or taxable in this country concerned? For this activity of therefore allowing a computing facility, Indian companies shall have to be paid. That's a different issue. That's Indian company's income. What about the foreign company's income? Can any portion be chargeable to tax in this country concerned? Would be a question. Again, you go back to the fundamental questions. You ask this question, when the foreign company has this type of an arrangement, that overseas clients come to it, it goes back to the Indian entity, has access to data, does the computing work, goes back, takes the solutions and gives it to the clients concerned and gets money. Would the Indian operation be called as a permanent establishment of the overseas entity? The answer may not be in the positive issue for the reason that the law is very clear to say that the foreign company does not own or operate any of the physical infrastructure or resources of the specified data center. So the law is very clear that the foreign company shall not own, shall not operate. That means it is being done exclusively by the Indian company without the foreign company having any sort of a control or direction on the equipment. Therefore, there's no question of a right of disposal over the premises concerned. There's no question, therefore, of a permanent establishment. There's no question of an equipment permanent establishment. There possibly may not also be a case of the DAPE issue coming about. Therefore, the question again is, in the absence of some sort of a Indian linkage to the incomes earned by the foreign company from out of its transaction with clients overseas, how would the Indian jurisdiction be extending to tax any portion of the incomes? One way possibly could be go back to SCP definition, go back to say that transactions in goods or services beyond the particular threshold limit would be therefore giving rise to an SCP, and then go to explanation 3 capital A, where they're looking at the aspect of computing income, how incomes earned by the foreign company overseas, outside, can also be deemed to be referable to the SCP in India. So where data is available, where data is taken from an Indian company concerned, from Indian users concerned, and data is sold or exploited outside by the foreign company outside, possibly explanation 3 capital A would say, some portion of this income may be referable to SCP in India and therefore chargeable to tax in this country concerned. So explanation 3 capital A on a stretched reading can possibly lead to the presence of the foreign company in an economic way, not necessarily in a physical way for a permanent establishment concept, can only be in a situation where an SCP may be said to be generated, and on a stretched reading of explanation 2 capital A and 3 capital A, we possibly come to a situation where the foreign company may said to be having a significant economic presence for it to be exposed to a tax liability in this country. Otherwise, we'll have to have new propositions in income tax law where you're having across the world concerned the automated digital services giving rise to a deemed tax liability like a royalty income in this country concerned. So those type of regulations will have to come into this country. Then you may have, therefore, digital services being taxed in this country merely for the reason that the occasion for such type of income generation is happening from India, therefore there's a linkage from India, or a payment is made from an Indian person concerned. But as on date, the law under the Income Tax Act does not envisage any of these situations concerned. Therefore, to make a statement that income accruing or arising to a foreign entity by virtue of this procurement of data center services from a specified data center, again, in my opinion, remains largely a question in theory, may not necessarily have much of practical relevance. We are therefore under a strained or a stretched imagination of the entire fact pattern concerned, go back to certain provisions of the law under explanation 3 capital A, and only then come to a conclusion that there could be a possibility under those circumstances concerned for the foreign company to have income taxable in this country concerned, and only those situations possibly you may then have some utility of this aspect concerned. Only when DTA is not there. When DTA is there, SCP will be of no use to itself. Or when DTA is there also, they will have to by GAR deny you the benefit of DTA and then say, oh, SCP is there, therefore I'll be taxing you in this country concerned. So denial has to happen of the treaty benefit through a GAR invocation. These are all very, in my opinion, not something that can happen on an ongoing, regular basis concerned. They're only peculiar, extreme circumstances itself. So therefore, there could be some sort of a. There's also a statement that the sales by the foreign entity to users located in India are made through a reseller entity being an Indian company. Now, I procure the data center services. Okay. With this now, I'm possibly able to make certain advantage. For example, let us take a situation where an online seller of items concerned is able to procure data center services, is able to get data about particular profile of consumers concerned. It then is able to make sales to an Indian user, is able to make sales to an Indian user, which Indian user will have to be accessed only by an Indian reseller. It has to be accessed only through an Indian reseller. When that situation concerned, possibly the exemption can apply. So the foreign company has to sell to an Indian reseller, which will then reach the Indian user. Now, there is a difficulty in understanding these terms under this law. All sales by the foreign company to users located in India. Now, when you make a sale, is it to a consumer or is it a user? How do you call a sale to a user? What can be a sale to a user? If goods are sold, the person is not a user. If data is sold, then it's not a sale. Technically not a sale, we understand as provision of data only. So there is some sort of an inelegance in language when they say, sales by such foreign company to users located in India. are made through a reseller entity being an Indian company. So go back to the memorandum. It talks about these sales are talking about provision of services to users in India. They're therefore not talking about sales of goods, they're talking about provision of services. Therefore, the data center services should result in provision of services as the memorandum making a mention about it. Although the words used in the main body are sales by such foreign company to users located in India are made through a reseller entity being an Indian company. So we have some issues in terms of users being located in India. What do you mean by that also is an issue. When you talk about data, you talk about services, you can talk about location in India. Otherwise, who's a person, who's a user, where is he located? You don't look at a consumer in India, you look at a customer in India, you don't look at a user in India in that context concern. Therefore, we have a lot of issues in terms of the entire concept. It appears to be some sort of a hurried proposition that has been introduced into the statute concern, and they are only making a statement that because of the entire surrounding emphasis on electronic manufacturing, on artificial intelligence, on machine learning, on the data center that is happening today, possibly we're having some sort of a proposition now, and we can therefore think about Google having its data center in Visakhapatnam. What is the way in which you could imagine whether the data center that is of Google that is going to be operational tomorrow, how Google will be deriving income, how Google can be exposed to a tax in India concern on this matter. When we discuss, we find it very difficult to come to a logical and a natural taxability of Google overseas to be taxed for this activity in India. You can also look at Amazon or look at Flipkart and their reselling models concerned. We can look at the SAS model, SaaS model, where there's going to be some sort of a computing made available, data is being accessed in this situation concerned. So the concepts are fine, the business models around it are fine, but the entire process of drafting the law to address these issues and to ensure that there is a huge amount of capital investment, fine, technology, fine, skilling of the Indian industry is fine. You may also have this GCC model also coming into this situation concerned, the global capability centers coming. So we are looking at these aspects concerned and finding out, is there some sort of a way in which you are now missing out things concerned? But after deliberations also, we found that there is a problem not in the concept of the entire business model, but in the way which they've imagined to say that how a foreign company is going to earn income, how we can therefore encourage that person to come in here. That encouragement in the current reality of law is a needless encouragement for the reason that those foreign companies appear to be outside or elusive of the tax net in this country concerned. So these are the situations as far as the three amendments are concerned. There's one brief amendment I'll make a reference to in terms of schedule on the PF. On PF for employees concerned, we have Schedule 4 and rule part A, Rule 6, where they say that the employer may contribute. Now, if the employer's contribution is more than a particular limit concern, or the interest that is available or made available to the employee in that contribution exceeds the specified limits, then that extra amount of contribution from the employer beyond the specified percentage or the extra amount of interest beyond the notified rate of interest shall give rise to a perquisite in the hands of the employee. The law is already providing for a cap on the employer's contribution, 7.5 lakhs. Anything beyond 7.5 lakhs is already a perquisite in the hands of an employee concerned. Therefore, the law found it that it's not making any sense now to have any contribution cap. That means when an employee were to make a contribution, how much shall be the employer's contribution? Should it be equivalent to employee's contribution or could it be more than the employee's contribution? They say we will leave it to the discretion of the employer's concerned, because anyway, even if it's more than the employee's contribution, we'll have a cap of 7.5 lakh rupees, beyond which the amounts paid by the employer will be taxable as a perquisite in the hands of the employee. So in the background of the fact that there's already a limit of 7,50,000 rupees of employee's contribution, beyond which it's going to be taxed as a perquisite. So the limitation of the employer's contribution not exceeding the employee's contribution, that limitation has been removed out. So they are making a statement, especially in the case of a low salaried employee is concerned, the employer may contribute regardless of the contribution made by the employee. This need not necessarily be a matching contribution. It can be more than the contribution of the employee for the purpose of the accumulation into the PF account. So that extra contribution beyond what the employee is contributing will no longer give rise to a perquisite, because the schedule has been accordingly changed now to say that only the interest beyond the specified or notified rates of interest, if the interest earned by an employee is beyond that specified rate, only then it will give rise to a perquisite, otherwise it will not give rise to a perquisite. So 2 amendments have been made in this matter concerned, and that is the sum and substance. There is also a reference to section 17 of the Employee Provident Fund Act and the notification or exemption thereunder. There's also some amendment to the LIC business computation, not very significant. With the paucity of time, we'll not go into those questions. Thank you all. Questions, is it? Oh, only one question, yes, sir.
Does the form provide for reference? If you disclose, you're okay now, but what if in the past, assets was acquired long back, your earlier offenses continue? You disclose now. They're happy that you're disclosed now. What about last year, the prior year and all, you're not disclosed, that would still be in an offense. Huh? No. See, you are required to disclose the foreign asset in your return for all the years. Let us say you have had this foreign asset for the last 6 years. Now you file an updated return for 2 or 3 years and disclose. They are happy for your disclosure for these 2 or 3 years. But that would give them food for thought to think, why on earth you did not disclose it in the first 4 years? And they are going to prosecute you for that. So disclosure in a latter year would not wash away the sin of non-disclosure in the earlier year. So as long as there was no earlier non-disclosure, then it should be fine. But at the same time, section 49 and 50, if you see, it doesn't refer to updated return. Because when section 49 and 50 of the Black Money Act was enacted, 139(8)A was not there. They have not amended the Black Money Act. So you may not get the benefit of immunity there also. No. They do mention the section as well. Please go to section 49 and 50. 49 would refer to 139(1), 139(4), 139(5). There is a reference to it. It does not refer to 139(8)A. Of course, when the prosecution is launched, you can plead that 4950 did not obviously refer to 139(8)A because that 139(8)A did not exist. Now it has to be read into it. All that you can plead. But that will be in a court of law, not before the sanctioning authority.
Members, please settle down. Please, we have a felicitation program for the speakers and Prashant. So I request you to please sit down. Before I give my word of thanks, we would like to first felicitate the speakers. Yeah. I call upon all the management committee members. Prashant, please join us. Tumba. Now we would do it for KK Chythanya, sir.
ಅದು ಕೊಟ್ಕೋ ಹೋಗು